Yesterday was a day when the markets consolidated. The Nifty did well for most part of the day, but finally went home off the day's high point, probably on back of some profit taking that could have emerged. In the last 5 days, the Nifty is up about 200 points. So last Thursday, the Nifty was at 24,273. We're closing out or opening at 24,467. Well, as we've indicated a bunch of times over the last few weeks, 24,500 becomes a very important level of resistance, and the bulls have faced that even in trade yesterday. In terms of support for now, that sits at 24,300, which is a very tight sort of trading range that the street will be tracking for the last 2 days of this trading week. Broader markets have done well, so for all that talk about how value remains in the large cap space, it is the mid and the small cap index that continues to outperform as the markets recover in trade. Mid and small cap index was up 1.9%. Banks did well, probably ahead of the RBI rate decision, and so did real estate. Auto and FMCG stocks continue to see some selling in trade. PSU Bank Index has been the star last week and continued to gain very strongly in trade yesterday too, turning out to be the top gainer. And again, this could be attributed to policy action that maybe some parts of the markets believe. In terms of stocks, Oberoi Realty hit a new record high on a brokerage initiation. Zomato, on the other hand, gets a CLSA upgrade to outperform. The counter does well. It's a season of fundraising and QIPs. Wonderla, of course, had a QIP that was launched very successfully. It did come in at a discount, but with the aggressive institution participation seen on the stock, the counter actually went home with gains of nearly 8%. Honasa, on the other hand, gained as the promoter increased its stake in the company, that of course giving faith and commitment and confidence to small investors. So all in all, those are a few big movers, but I think Neeraj, it's all eyes on what comes out of the policy. While most people believe it's status quo, there's a report this morning from Nomura that believes a rate cut cannot be ruled out, and that's the first I've seen.
Yeah, and the extent of the cut that they're talking about is quite interesting, really. Too ambitious, maybe. But I mean, I think somebody I was talking to said that if food inflation were to go down, which is anticipated, the worst case scenario might be CRR in December and a rate cut in Feb. And that person, I mean, good macro analyst, said that that's the worst case scenario. But be that as it may, I mean, the point is well taken that there is all eyes are out on the MPC. But from our market's perspective, I mean, just look at it. The large caps yesterday, after 4 straight days, hit a bit of a roadblock at the upper end, right? 2 attempts to really cross higher, kind of missed that, as you can see on the screen, and therefore ended flat. But the good part is, in technical parlance, the higher high, higher low structure for the Nifty is still intact, and that should give a bit of a bit of a balm really to frayed nerves, if any, really, if you will. The problem at the mid cap end of the spectrum, and not really a problem but a word of caution, because again in technical parlance there's some a retracement of 61.8%, which is what a lot of people rely on, and the mid cap index is very close to those levels, another 1%, and it's right there. So therefore maybe there could be some caution after 9 or 10 straight days of an upmove that we've seen at the broader end of the spectrum. They had a very good day in trade yesterday as well, so that is one. Yesterday was an interesting one, and this, my next comment on trade setup, is purely out of the analyst commentary that came in on India market close, which is from 2 to 3:30. All 5 analysts who were there on the show had a thumbs up for Divi's Lab, and then some of the other CDMO stocks. So, I mean, just watch out for CDMOs. Maybe they have some more steam left. They've already rallied quite a bit, but keep an eye out for some of those CDMO names. Just the last piece that I want to say, we've been talking about it for the last 2 days, that PSU banks can do well on account of an expectation of a CRR cut. Now, if that is the least that is to be anticipated, then never mind the 5% rally that has happened, maybe there will not be a very sharp pullback in the PSU banking names, because even yesterday they had a 2.5% or 2.25% rally. This follows the 2.5% rally day before yesterday as well. So it's been a very sharp uptick in the PSU banking stocks, but may not necessarily crumble unless, of course, the rate activity tomorrow is a complete damp squib. But if there is CRR cuts, etc., some bit of rallies happen, may not be a completely off the cliff move for the PSU banks.
Meanwhile, I mean, completely off, but Bitcoin has just hit 100,000 mark.
Wow.
So I don't think anyone here has any Bitcoin. I mean, at least I don't. I don't know about you, Neeraj. Any crypto exposure?
No, I mean, the exchanges allowed it, so had it for a while, and then, of course, things have gone sour, so it's just better to not be there.
Yeah.
But, well, everybody who's not there must be ruining it.
Yeah,
Their luck.
completely ruining it. So, okay, Bitcoin in focus this morning also. It's that kind of time when literally anything can happen, and then it becomes tough to know what to pick, and that's where the stocks come in.
And it has been a stock picker's market, at least in the last few months. But just talking about the rate cut, Neeraj, even if we do get a CRR action as opposed to an actual aggressive rate cut, don't you feel that it could be buy the rumors, sell the news in some of these banks? So maybe the run-up may continue into today. And I feel like no matter what happens on the policy, sometimes it leads to more of a disappointment, especially if the counters have already ran up in trade, right?
Completely. But what if Nomura
is right?
And then you have a party on the street, right? So
yeah, and maybe this could be one trigger that could make it a good December, because historically Decembers have not been too bad a month.
Yeah. I think more.
Are you feeling a rate cut, Tamanna?
I'm feeling not just maybe or maybe not a rate cut. I'm more curious about the reasons why Nomura is saying it. Because then directionally, what are they seeing? Is this the pressure of the GDP numbers coming in? Will you see commentary hinting towards a softer stance? I think that becomes as important. In fact, Harsh is joining us for more details on that. Harsh, why does Nomura see a rate cut of 25 basis points?
Well, 25 basis points, of course, in this meeting, which is the December meeting, 100 basis points all through the first half of 2025, and therefore they believe that a more structured downtick with regard to the repo is very, very warranted. Two reasons why they highlight that the repo hasn't been hiked. Let me reverse engineer this. So the first reason that they are suggesting is that there could be currency depreciation. Now, the argument here that Nomura makes is that RBI has a healthy FX reserve, which can be used and which they have been using to control the way in which currency and the INR is moving. So they believe that that should suffice. The second piece is with regard to the fact that growth has definitely been on the lower side of things, but inflation has been higher. They believe that with regard to where inflation is concerned, 64% of the 290 items on the CPI basket have an inflation of 4% or lower. So the inflation impact is concentrated in very, very few items, which they believe that the RBI should focus on and policy should focus on to try and taper on those items, which could cool down inflation. So inflation being higher is not much of a challenge according to them. They believe that growth is the larger concern. The 7% expected Q2 versus 5.4%, they believe is slightly lower and is where the concern should actually be. They believe that RBI will actually tweak their full year growth guidance as well, and this is important. 7.2% is the full year growth guidance. They expect that RBI will trim it to 6.5%, and they believe that's where the repo actually makes a case of a downward tick with regard to the repo, and that's where they're making a case that a 1% lower repo in the next 7 to 8 months likely and should at least happen, even if it does not actually translate.
Thank you for that, Harsh. Now, whether or not we get that rate cut in December, but it's 100 basis points all through calendar year 2025 is what Nomura is. So I guess they are hedging themselves as well in more ways than one.
They are, but I don't know, maybe if Harsh is still there, I don't know. But here's the argument out there. I don't know if the note mentions that. Does this hold true if the Fed is not on a rate cutting trajectory but a rate hike trajectory, because US inflation, if all of Trump tariffs come into play, is going to go through the roof? So if the Fed is actually on an opposite trajectory, do we still get 125 or 100 basis points rate cut in India? That's a difficult pill to digest.
No, but then if so far you're saying that you're doing your own thing, and you haven't cut even after
on the markets
Fed.
Here, huh?
Yeah. So then, then the reverse will also hold true. If you are doing your own thing and looking at domestic issues, then even on the upward move, you might. Plus, if the Fed goes on a rate hike trajectory, is still a big if and but. As of now, December 17th or 18th, you're expecting a 25 basis points cut. Then let Trump come, let the tariff war actually begin, if at all, and then we'll wait and see. I mean, I don't think anyone's sticking their neck out that you are going to see the rate cycle reverse anytime soon. It's an if and a may.
If and a may, of course, yeah. But in the US, there's a high probability of that. I just wonder if, Harsh, if you're still there, does Nomura speak about that at all in the note?
They don't actually, Neeraj. They don't talk about the global macro. They just talk about where India is placed, and they make a case as to why RBI should cut.
Okay.
Well, whether or not RBI cuts, there will definitely be a change in commentary. And a more growth-supportive statement from the governor is what the street would be expecting. But talking about whether the Fed could move from a rate cutting to a rate hiking, I think there is a path of status quo before that happens, because otherwise, with the central bank swinging so aggressively between cuts and hikes, could actually disturb the markets. Let's not forget that they took about 3 to 4 quarters to go from neutral to a rate cut when the market was already concerned about the Fed moving too slowly. So I would be mindful. I also don't think that the rate cut is only dependent on what happens in terms of GDP growth or mixed signals on the inflation. Remember, the the rate differential between the US dollar and the rupee is also very significant. And the fact that we daily talk about foreign inflows in the market only means that if India cuts rates and the Fed doesn't do so, what it will do is that India becomes even less appealing to outside investors. The risk return or risk adjusted returns will not look as phenomenal. So I don't know whether the RBI would want to ignore that and cut rates, even though we've had a quiet or disappointing GDP reading. But supportive commentary cannot be ruled out from the RBI for now. Well, let's quickly move on to the stocks to watch this morning. And QIPs usually tend to confuse most of us. We don't know what direction they move in, but nevertheless, Bharat Forge is one to track. The demand for this QIP has been healthy. Now, how the stock reacts is one to watch, because it was up 2% yesterday. And of course, the company has announced that they're looking to raise 1,650 crores at a floor price of 1,323. That is at a 5%, nearly 5% discount to yesterday's close. The funds will be used to repay debt, which is a positive, and of course to fund the recent acquisition that they announced of commercial truck axles. In my opinion, may get a flat start and actually move up, because the overhang will be behind them. The fund utilization will be towards repaying debt, and of course funding an acquisition that was already in the know. So there was an indication that they would look to raise money, and they're coming in through a QIP. I think Neeraj is nodding at me. I'm assuming you've got something to add on this.
The only thing to add to this, the North American Class 8 truck sales numbers are just out, right? Yeah. And they are at 11-month highs. So that's
a thumbs up on Bharat Forge this morning.
Yeah, the QIP, if it's got the demand that you're talking about and this number, all of that could actually aid.
Should be a positive. And I think, so yes, I think Bharat Forge is a positive. Maybe flat. Let's not forget that the start may be quiet, but as the day goes along, this could make a good trading opportunity. Well, the other one that was very interesting and has been in the works now for so many months has been Vodafone and Indus. I'm giving a thumbs up to both those counters. Vodafone is looking to sell its last chunk of stake it owns in Indus Towers, which is 3%. The proceeds from Indus stake sale will be used to repay Vodafone Idea's borrowings. Now, this sale, of course, completes Vodafone's phased divestment in Indus Towers, which began all the way back in June 2024, when they sold 18% stake in Indus Towers for 15,300 crores, reducing its holding to 3%. Remember, Bharti Airtel has increased its stake in Indus Towers to 48.95% during that sale by Vodafone. Earlier in 2022, Vodafone has offloaded 7.1% stake in Indus Towers. Now, Indus Towers stock price actually closed in positive territory yesterday at 359 rupees. This came in ahead of Vodafone's announcement last evening. The stock has been a strong performer. It's up 92% in the last 1 year, now bringing its current market cap to 94,000 crores. So you keep all that in mind, and you know that this is a positive, not just for Vodafone as they will raise this money, close out the stake they own in Indus, but also a positive on Indus Towers. CLSA puts out a watch report with an expected indication of an increase in target price by 35% on Indus. So a couple of reasons both those counters should do well in trade this morning. This is a smaller one, and it's a newer one actually, Bondada Engineering. They won an order, and these counters, like we've said, usually react to order wins, are ordered to the tune of 109 crores from Bihar Renewable Energy. So watch out for the counter. It didn't do well in trade yesterday, but maybe with this order win, you could potentially see an uptick on the stock, Tamana.
Okay, so Bondada in focus, order wins and this entire space also in focus. I'm starting with transformers and rectifiers. They will be acquiring a controlling stake in POSCO Poginamp Electric Steel. The size of the agreement is under consideration and it has not been revealed yet. The acquisition is expected to be completed within 7 days of execution. So the company they're acquiring is in manufacturing and processing of CRGO, lamination essential material. This is used in the cores of transformers and it contributes, this is the important bit, the company they're acquiring makes a component which contributes to 33% of raw material cost in transformers. So that's cold rolled grain oriented. So this is why I would say this is a thumbs up. The company that they acquire will become fully integrated to process these requirements and could aid in up to 100 basis points to 150 basis points in margin expansion. So which is why I would say this is one stock that you can keep on your radar for today. Muthoot Microfinance is the other one. It's not great news. They've announced a third interest rate cut reduction this year. Lending rates will reduce by 25 basis points for income generating loans to 23.05%. Rates reduced by 125 basis points for third party product loans to 22.7%. Could have an impact on yields. Growth has also been tough and I think regulatory concerns are going to be something on the horizon you have to watch out for the entire space of microfinance. We're already talking about the quality of debt in this space. Brigade Enterprises is the other one that I'm talking about and we'll actually play out in just a bit the conversation we had with the management and my colleague Haripriya caught up with them in Bengaluru. The group is seeing a slow progress towards achieving their target of a gross development value of 10,000 to 11,000 crore rupees. This is simply because approvals are getting delayed and this is a statement made by them in an exclusive interview to NDTV Profit. Which we will run in just a bit. Meanwhile, just a backdrop, the pre-sales growth of 46% in Q2 was driven by commercial spaces. In the first half of the year, the pre-sales growth of 29% was driven by better price realizations. But you know, this at the end of the day with real estate, it's a lot about what the policy environment is in the state they are operating in. And for Karnataka-based companies, this might be an overhang.
Yeah, I mean, the last 2 quarters, both Pavitra Shankar and Nirupa Shankar have been talking about slower approvals being a key concern. So, well, watch out for those. I'll stick to a real estate company. It's a small name, Suraj Estate Developers. Gets a thumbs up because they've purchased land in Mumbai for 101 crores with a gross developable value of 525 crores. Remember, this is the company that owns that premium plot of land in Bandstand in Mumbai, which has got a large developable value as well. And now they are doing this. So could be an interesting one to watch out for. I'm choosing Ratnamani Metals and Tubes because the exit is by Nalanda. I mean, Pulak Prasad and team hold stocks for a really long time. So when they get out, it comes to the notice. Even if the buyers are SBI and Tata Mutual Fund, the fact that Nalanda has sold about 7.85 lakh shares, maybe that's why the stock was down yesterday as well. Could be interesting to see if it is down today as well or no. I'll add a PG Electroplast to that list of the fundraisers. So QIP opens today. The floor price is at 705, which is a very sharp downtick to the current market price. Remember, they've done a tie-up with a global auto company to manufacture bikes as well as battery assemblies for the Indian markets. It's a hyper-competitive space, but they have done the tie-up to manufacture it in their facilities. Maybe the fundraising is for that. Could be an interesting one to watch out for. So those are my top 3. Actually, there is a very interesting note by Axis Securities. Maybe I'll come to that after the stocks are done.
Yeah, just 2 more that I quickly want to add there's another QIP. I don't know whether we mentioned that, but PG Electroplast is highlighted by you in Torrent Pharmaceuticals. So I think that might also see some movement. Remember, pharma has largely been in focus. They've entered in an agreement to acquire 3 anti-diabetic brands. We don't know the size of this acquisition, but it's expected to be completed by 2025. And remember, Torrent has been marketing these brands since 2022 as part of an existing co-marketing agreement. But now, of course, with this agreement that gets completed in 3 months, this becomes part of their core portfolio. So Torrent Pharmaceuticals could be in focus on back of that. Apart from that, I think everything else is fairly fairly small, but you also had a small sort of microfinance company that reduced its lending rates by 25 bips, and that's Muthoot Microfinance. So this could be ahead of the central bank meet or decision on the rates tomorrow, but Muthoot already going ahead and cutting rates.
I actually spoke about Muthoot, and I mentioned that it's a thumbs down because they're cutting rates.
Could this also be an indication of what's coming tomorrow? I don't know.
But they are struggling. I mean, that whole space is struggling, which is why I spoke about Muthoot.
Another bad news.
Yeah, no, just one it may be worth nothing, right? So you can call it for whatever it's worth. But here's an interesting data point from Axis Securities. They say that over a 25-year period starting 1998, when they've analyzed the Nifty, it reveals that in years ending in an odd number, 2021, 23, 25, whatever, what have you, the Nifty has averaged a return of 22.9%. And of the 12 instances where there has been an odd year, the Nifty ended higher in 10 instances and lost ground in 3. So it's a 77% win rate.
This is which research?
Axis Securities.
So they've now numerology.
But banking on history.
Mix of astrology and numerology. Historic data.
Historic data. But 77% win rate. So that's about, I mean, it's a fairly telling for if bulls needed some crutch to hold on to for a positive 2025. Here's one.
Okay, Happy New Year in advance from Neeraj and Co.
Only if it was that easy, huh?
You never know.
It never is, but it was an interesting data point.
Yeah. Just one more finance or BFSI focused company before we play out that Brigade bite. So Jefferies has maintained a buy on Shriram Finance. I thought this was interesting and just popped up with a target price of 3,670 because asset quality is holding up. So it's among their top picks. They see steady credit demand, higher used vehicle prices are supportive, and they see an AUM growth at 18%. The industry stress inched up in autos in Q2 but can ease in Q4, and the auto space very important as a vertical for Shriram Finance. Provision levels are healthy too. But as central banks around the world signal a potential shift in monetary policy, interest rate cuts are becoming a key topic of discussion. We caught up with Nirupa Shankar, joint MD of Brigade Enterprises, about the kind of impact they're anticipating. Listen in.
Housing demand is pretty strong. Despite whatever interest rates are, I think housing demand is there. And it's the first time in a long time where despite increasing prices in homes that the demand remains strong. Usually there's an inverse relationship between price and demand, but we are seeing like very strong demand now despite all the macroeconomic factors. And I think right now the entire industry, all sectors are doing well. Again, normally you see some sectors, maybe hospitality, office not doing well when residential does well, but right now all the sectors are doing well. It's been going okay, slightly slower than anticipated, mostly because of a bit of slowness in approvals. But we are expecting to receive a lot of our approvals, in the next couple of months. So hopefully we'll be able to launch a lot of the projects that we'd wanted to launch earlier in the quarter. But yeah, if we're able to do our launches, then we should be able to hit the targets that we originally envisioned. But if launches get delayed, then of course we'll have to push out our targets.
Okay. Well, that's the long and short of it. But, because there are so many QIPs, just a quick conversation on qualified institutional placements and the resultant moves that we're seeing with Mayuresh Joshi, Head of Research at MarketSmith India. Mayuresh, so good having you. We wanted to talk to you about this spate of QIPs that are happening, right? And what happens thereof. So yesterday, Wonderla, post the QIP, had this massive uptick in trade. We have a Bharat Forge QIP open today, wherein the demand is expected to be 2x, 2.5x. And of course, aiding that is also the North America Class 8 truck sales. There's a PG Electroplast QIP as well. And there is a spate of QIPs that have happened in the recent past. What do you make of what's happening on these fundraisers? And any thoughts on either a Wonderla, a Bharat Forge, or a PG Electroplast?
Morning, Neeraj. Again, I think a large part of the fundraisers and the intent of the management obviously is to expand capacities to a certain extent. And therefore, as they embark upon this fundraising plans, the capacities will probably largely go up, which largely means that all expanded capacities with expected demand expected to remain stable for the industries that they are catering to. a large part of the fixed asset turnover should start getting replicated on balance sheets over the next couple of years as the expansion starts happening. And therefore, I think for what purpose is this fundraise is extremely important. Is it in high growth areas where earnings will show significant improvement? That is something to be seen. Again, I think in terms of the recent QIPs, the ones that you mentioned, Bharat Forge probably looks a tad bit more interesting at this juncture, along with PG Electroplast. Reasons are very simple, as you pointed out. The expectations in terms of Class 8 are expected to be very, very strong at this juncture. With expectations of the US economy remaining strong, with expectations of corporate tax cuts expected to come through, I think a lot of commercial and corporate activity is expected to improve. And therefore, I think a large part of their business coming from the US as far as Class 8 is concerned, and even on the Indian context, getting into defense and other areas, I think that should keep up their earning momentum. Same for PG Electroplast, they have upped their revenue guidance, they have upped their EBITDA guidance as well. The expanded capacities are truly and are truly probably in the right direction as far as the earning momentum is expected to be concerned. So I think PG and Bharat QIP probably will be best in this.
Okay, Mayuresh, just since we have you here and wanted to get an overview of how you're looking at the markets right now at this inflection point, some trickle in from FIIs coming in. Do you think now the base has been made for the next leg of the rally?
Morning, Tamanna. Probably. And again, I think everybody's expecting a Santa Claus rally to probably come through in the last few weeks of December. Maybe that becomes a base case scenario, because looking at how the Fed governor or the Fed chairman has probably put out the statements relating to the state of the US economy, I think that looks to be in a fine state. Obviously, I think how the rate cut cycles will evolve is something to be seen over the next 2 to 3 months. But even in our context, I think tomorrow's RBI meet is going to be extremely critical, whether we get a CRR cut in terms of liquidity infusion and the statements thereof. If the statements are dovish and supporting growth, I think the markets will take it with both hands. Obviously, I think earnings is something that the street will probably look out for. Earnings have been soft. They're expected to remain soft in Q3 as well. But that's a different ballgame. I think those earnings will start on Jan 10th. Till that point of time, I think markets, in my opinion, have probably made a base of sorts. And one can expect a Santa Claus rally to come.
Mayuresh, hi, good morning. It's Amina joining in as well. What I find very interesting is that we get a very strong reaction or response to some of these QIPs. And I land up talking to one of the promoters who had a successful QIP and the stock did exceptionally well. And I asked him, I said, if there is supply, if there is demand, then why come at a discount? To which he responded that saying that every institution is still seeking a discount. What do you make of that? Do you make of make that the companies are expensive? Because demand is there, and 5% is not that much of a discount, right, that a company offers. So I simply want to understand what that really means, and how should one view the counter as a minority shareholder?
So I think there are two aspects to this, Samina, one to you as well. I think when a discount probably comes through, I think that has been a general norm over the last few years. Having said that, I think the kind of volumes that probably get transacted, if that happens through a general market in terms of liquidity infusion or dilution, there will be an impact cost as far as prices are concerned. And institutions obviously like to have a little bit of a discount compared to the market price. Obviously, I think a lot of these stocks under consideration have moved significantly higher, and therefore the promoters also would not mind better institutions coming at a lesser rate compared to what the market price is. Secondly, as far as minority shareholders are concerned, I think the stocks themselves have given decent returns, and if good quality shareholders are coming onto the balance sheet as institutional holders, as long-term investors into the stock, I think they are not perturbed at all. So I think the overall growth dynamics that probably guides the company in terms of numbers.
Thank you so much for that, Mayuresh. Great to chat with you at this point in the morning. Let's take a look now at what the watch list is showing for NDTV Profit and what's on our radar. Vodafone Indus Towers stake sale and fundraise. So expect a good day for Vodafone today. Of course, for Indus Towers, improved dividend visibility as well for both companies. Bharat Forge, QIP of 1,650 crores is the funds they want to raise, launches at a 4% discount. Plus, data coming in from the US is pretty positive. So Bharat Forge could have a good day. Fusion Finance, an 800 crore fund raise is why it's a positive for us. And for TRIL, Transformer and Rectifiers, they've acquired a stake in POSCO Pojanamp. I'm not sure I'm saying it correctly, but an important acquisition which will help them reduce raw material costs, can add up to 150 basis points on margins.
Yeah, quite something really. Expensive stock, but could do well today as well. Remember, Dynamic Services is an SME stock, so please be mindful of that, but has won a large order and therefore could be interesting. Suraj Estates, small cap stock, but buys a land in Mumbai for 101 crores. More importantly, that land has a gross developable value of 500 crores, and which is why it is in the green. Brigade, on the other hand, has said that there is a slow progress in approvals, as a result of which it's a bit of a revenue warning that the company is given for FY25, and that should impact the stock. And Ratnamani Metal, Nalanda sells about 1.1% stake, may see a further down day today.
When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed. It is our job to bring you news that truly matters. At Profit 360, we cut through the clutter, the Wall Street deals, finance and policy news that could shape your tomorrow. The newsmakers, the trendsetters, and the innovators. In 30 minutes, we've got you covered. So stay ahead, stay informed, and stay profitable with Profit 360.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV.
All right, back with India Market Open right here on NDTV Profit. Remember, the pre-open session, it'll start in about 5 minutes from now. The implied open may be suggesting a downtick, but you never know how the markets do. The last few days, the implied open has not been a true indicator of what the markets do on open itself. Forget what it does during the course of the day. But the last few days, post-results, are days of some very well-written brokerage notes. We've given you a sample of a couple thus far. Let's give you one more. JP Morgan has come out with a note on the Adani Group, and Agam Vakil joins in to talk about what are the key highlights of that particular research note. Agam, good morning again. Take it away again.
So overall, the note is positive, seems sanguine on all the bonds that are floated by the Adani Group. On a stable liquidity basis, well, they are saying that there are no problems here. In fact, liquidity seems to be manageable when it comes to the Adani Group. They talk about a handful of specifics as well. So when it comes to Adani Group's bonds, which have been volatile of late, now seem to have stabilized with the spreads well, widening to no more than there in about 100, 200 basis points. And they also say that they prefer the short end bonds for now. Of course, they've also moved one of the company's bonds of 2026 to overweight, and they are also overweight on Adani SEZ bonds. They prefer the 2032 bonds out there in that case. And they have also, in fact, initiated an overweight on Adani SEZ bonds. These are the 2032s. And as far as the 2041 bonds are concerned, well, they remain neutral. All in all, the positive here is that for many of these companies and the many long tenured bonds here, they remain either overweight or neutral, more inclined to overweight, and they're suggesting that the liquidity is manageable. So overall, the sentiment continues to be positive, even in terms of the Adani Group debt at the moment.
Thank you for that, Agam. That's Adani Group stocks and JP Morgan's view on that. Dharmesh, you want to comment on that one? The counters have seen some very heavy activity in the last few days. In fact, it's been the top performing stocks despite the weakness that was seen in the early part of last week. Any view and anything that you like across the Adani pack, your favorite pick here?
Yeah, definitely. I mean, such kind of a market activity in the Adani Group gives you opportunity to do your cherry picking, and there we think Adani Ports is a very nice business to catch up at lower levels, and the valuation comfort is also there. And the other company which I like in this entire group is Adani Power. So these are the two companies where there is a huge valuation comfort, and the business has been doing fairly well with nice cash flows coming into play. So such opportunity should be utilized to get into and acclimate Adani Ports and Adani Power.
They're definitely nice, Dharmesh, nice fundamentals and nice cash flow, but Adani Ports is what Dharmesh does like. We'll have to wait, I guess, in a technical view, but a quick check on how and what we're expecting. A whole lot of counters will be in focus this morning. Largely a few big IPOs. You've got the Vodafone Indus news, which will be important in terms of how those stocks react. And maybe even a move on Bharti on back of everything that's happening on Indus Towers. Remember, they own a significant stake there too. 38 points low on implied Nifty. Global Qs were positive. Crude was trading flat. The FIs have been buying into our markets, which of course is a sign of some positivity and hope for the bulls. But 24,500 is an important level that the markets will try to take out in today's day of trade. On the upside, on the downside, of course, it's 24,300 that will act as an important level of support. Well, you have a few brokerage reports as well. So on counters like Zomato, Nomura recently, in fact, yesterday had a call on Oberoi Realty. The stock was did hit a life high on back of that. Well, now I believe there's also Bernstein after yesterday's note on Zomato. It's Bernstein this morning that has come out the note on Zomato versus Swiggy, the eternal debate these days. Mahima is standing by with more on that. Mahima, is it Zomato or is it Swiggy for Bernstein, or is it both?
Well, it's Zomato for Bernstein as well, and they've rated it outperform with a target price of 335. So this poses a 20% upside from its yesterday's closing. Now, we've already seen that, in terms of operational metrics so far, in terms of YOY numbers, Zomato is still way ahead of Swiggy, but QOQ, that is sequentially, Swiggy is catching up. But there are some operational metrics as to which, the Bernstein notice pointed out. They've said that Zomato has a wider presence than Swiggy, and they have a deeper penetration as compared to Swiggy in terms of tier 2 cities. It is also said that Swiggy has higher frequency of users. So Swiggy is better in terms of this because it has one integrated app, which is why it has higher frequency of users. But in terms of quick commerce, they've said that Blinkit has 1.5 times higher monthly transaction users than Instamart. So clearly in the quick commerce space, we've already seen that YOY it has seen a 136% growth versus that of 57% growth in terms of gross order value for Swiggy. So Blinkit is right now 1.5% higher in terms of monthly transaction users than Instamart. In terms of gross order value per restaurant, for that Zomato is winning the game. And lastly, Swiggy has stickier customer base than Zomato, and this is because once again it has one integrated app versus that of 3 different apps for Zomato. So this is the overall view of how these two stack up against each other, and a very interesting note coming out from Bernstein.
Okay, so first pre-open rates are hitting. Zomato, all right, doing okay. Zomato, Swiggy actually is not in flavor. What's in flavor is Indus Tower. We were talking about it in some details earlier as well, and we will have a deeper view on the entire space at 9:30 a.m. So watch out for that. Indus Tower doing well in the first few minutes of trade, of pre-open trade. So is Vodafone. What else is popping? Adani Energy on the back of that JP Morgan note. We talked about it just a few minutes ago. IGL making a comeback, and city gas distributors have had a tough time with I would say policy moves, but IGL not half bad. PVR Inox, we were talking about that CLSA note, which has been quite bullish on media, and we'll get our colleague Rucha to give you more details on that, but that's doing okay. Yeah, so those are some of the movers this morning that you see. So is M&M Finance. I'm just wondering what's happening to some of the stocks on our watch list. Let's look at a Bharat Forge and how Bharat Forge is behaving this morning. Let's pull up a Muthoot and see what's happening there. Transformer, rectifiers, some of the stocks that we've been tracking. Bharat Forge, we told you would be a positive. Muthoot Microfinance also up at this point, and so is transformers and rectifiers. So some of those counters doing fairly well. Apart from that, let's just get a quick view from Dharmesh on, what is the space that he is looking at next. Dharmesh, in terms of banks, are banks something that is on your radar right now? Would you be looking at banks more closely, and which ones ahead of the rate meet tomorrow, or the rate decision that we will hear tomorrow?
Yeah, definitely the one. We have been looking at banks for last 2 months, and post the Q2 earnings update, public sector banks were a clear favorite after the earnings update was there. The prices have moved up, but still the valuation comfort is pretty high. So whether rate cut comes or it doesn't come, I don't think that will make much of a difference to the fate of public sector banks, given in the current macroeconomic scenario. So they are the clear buys. Apart from that, metal is another sector where we think action will begin soon. So there, Hindalco and Tata Steel looks pretty well. So these are the two sectors where the focus is high. And in the public sector banking space, the stocks which we have been recommending quite aggressively is Bank of India, Canara Bank, and Bank of Baroda. These are the three topics from the space. Relatively, we are a bit neutral on SBI.
SBI, but a couple of those counters look good to Dharmesh from a fundamental view on policy action. A quick check of pre-open is playing out. It should be a flat morning. Don't expect too much on either sides of the benchmark. It could be a tight trading range in the range of 24,300 to 24,567 now on the index and pre-open trade. Not sure that's how it's going to play out. That's too much of a gap up on a morning such as this. But Qs are outside are positive. There is a report this morning on a rate cut, so maybe that could cheer the markets up to some extent. But it might just be better to wait and watch. Vodafone Idea and Indus become important stocks to track. Vodafone is up 8% in pre-open trade. Indus is up 4.5%. PVR ahead of a release is looking pretty solid in pre-open trade. Bharat Forge 3.5% on PVR Inox. Bharat Forge could be one to track on back of the QIP. PG Electroplast also on the QIP. Bundada Energy on back of an order win. So it's actually not looking too bad in early morning trade setup as we see it. Well, Zomato, if we can quickly pull that one up and see what it's getting up to. Remember, CLSA has said that they prefer Zomato to Swiggy. Counters like Brigade Enterprises will be lower on back of the commentary coming in from the management there. So I'm still looking good, 1.5% higher on the counter. Sitting rate sensitives largely could become a good trading opportunity or a trading idea intraday ahead of the policy action tomorrow is what the street is expecting.
All right, let's look at the big brokerage call on NDTV Profit. 9:05 is when we give you the top brokerage call of the morning, and we've picked CLSA on persistent systems. Why do they have an outperform, Harsh?
Well, not only do they have an outperform, they've hiked their target price substantially. So earlier target price 6,154, current target price 8,462. Reasons: first off, they believe that strong market positioning of Persistent should aid numbers going forward. They also feel that exposure for Persistent to faster growing segments, which is one, data analytics, second, Salesforce implementation practices, as well as product engineering. These three verticals should drive growth further. They believe that in terms of revenue, Persistent Systems is at a sweet spot, $1 to $2 billion in terms of revenue, and therefore growth can really come through on that kind of a base. They've increased their revenue estimates across their industry verticals. They've also increased margin assumptions due to various factors. Now, in terms of the EPS estimates, they're expecting FY 25 to 27 an EPS CAGR of 27%, which is quite strong. And they call Persistent their top pick within the IT space. They've hiked the multiple as well as the target price, a 41% upside from here.
Thanks for that, Harsh. That's the top brokerage call this morning. The stock is up 1.5%. But guess what? We have Aditya Agarwal now, Head of Research and Investments, joining in. Aditya, our viewers are very upset that we haven't had a technical call till 9 or 10 this morning. So very quickly, a call on the Nifty and Bank Nifty.
Apologies for that, Sarmina. I was running late.
You have to promise us you'll be on time next time. More importantly, in public. Aditya's got
I promise that.
He promises. Okay, go on. Call on Nifty, Bank Nifty, and your top trades.
So I still feel the upside is intact in the market, and as far as Nifty and the Bank Nifty is concerned, I'm quite constructive on both. Especially the Bank Nifty, I think can test levels of 53,800 to about 54,000 as well on the upside. And this rally is going to be fueled by the PSU banks, which have been participating big time. And a few of these private sector banks, like the Axis Bank and the HDFCs of the world, can also trigger that rally. So the uptrend is still intact. I still don't see any signs of maybe a consolidation or a minor pullback as well as far as the Bank Nifty is concerned. On the Nifty, definitely, I think there can be a bit of a consolidation. But yes, having said that, 24,800 is something that I'm eyeing on the Nifty as well. But I have to bet on one index, it has to be the Bank Nifty.
Yeah, hi. Let's quickly get your picks. And now you can see what's been happening in the first few minutes of the pre-open session as well. What are you liking this morning?
So I've got a couple of buy recommendations. The first one is APL Apollo. This is something which is looking very interesting to me on the chart setup. At current levels, I would be a buyer in the stock for a target of 1750 with a stop loss at 1550 on the downside. The second is Cummins. We've seen this entire segment correct a bit, and now it's formed a base and it's inching higher. So it will follow maybe the route of the Siemens. So Cummins is a buy at current levels for a target of 3750 with a stop loss at 3430 on the downside.
Well, we also have Rucha who's standing by very quickly on media stocks. Rucha, what does CLSA have to say on media stocks?
Right, so basically it has come out with its review on second quarter, and that is when it talks about PVR, Inox and Zee. Well, talking about media as a whole, it says that media saw continuing soft advertisement environment, and this was led by the headwinds faced by the FMCG, because largely ad industry is led by FMCG sector. But it also says that India box office collections saw a strong bounce back of about 40%, largely led by Hindi movies. Therefore, moving on to stocks, talking about PVR, Inox, the brokerage house has an outperform rating over here with a target price of 2,450. Now this implies a 53% upside over here. It says that PVR Inox re-release strategy is also successful with about 6% of admissions coming in from the re-release in 2Q. But talking about Zee, it has an outperform rating, target price of 170 rupees, upside a little less than PVR Inox at about 21%. It says that Zee valuations are cheap and is also therefore positioned to capitalize on the ad spend recovery. Alongside PVR, Inox will also benefit from content and occupancy improvement. But let's look at what our analyst on Bloomberg saying. Talking about PVR, Inox bullish stance over here is what we can see with 16 buy calls, 4 hold and 2 sell calls, return potential of about 24.5%. But then we also look at Zee with 9 buy calls, 4 hold calls and 7 sell calls. So kind of a 50-50 stance over here in terms of bearish and bullish calls, but return potential positive 14% on Zee.
Okay, thanks a lot. Not too much of a reaction thereof, but Rucha, thanks for bringing us that piece. Now, I just want to see if Adani Energy is indeed reacting post the pre-open rates having settled as well. About 1% higher, because there's a newspaper report which says that the Adani Energy might be a preferred bidder for a high voltage DC transmission project, roughly 25,000 crores bid. Could be interesting to see what happens thereof. Wonder what Bharat Forge and PG Electroplast are up to, considering that both of them have a QIP. Depending on the relative demand, you might see the stocks moving up or down. For now, Bharat Forge about 1% higher. PG, 0.25%, so nothing too dramatic. It's the telcos which are actually doing really, really well in trade. We've discussed the telcos with on the fundamental side already with Dharmesh. But Aditya, very quickly, if Indus Towers starts off at 375, it seems to be the case. Would you be a buyer at those levels into Indus?
I don't mind, Neeraj. Actually, this is one stock which is still showing strength after a decent correction. Stock has bounced back. So for a target of maybe 420 to about 450 as well on the upside, I would buy the stock with a stop loss at 340 on the downside.
Aditya, just a few more stocks that are worth talking about this morning and could see trading activities, real estate and banks. Anything over there in the PSU banking space specifically that could make a long trade intraday? I know I'm making this slightly tough, but I think most traders will want to take profits or losses off the table today before we go into rate action tomorrow.
I think well, let's first talk about PSU banks, and within the PSU banks, I'm like I mentioned at the start of the show, I'm a little constructive on the PSU space. SBI is something which I think has a lot of catch up to do, and if somebody is looking at an intraday trade, maybe SBI is something one stock that I would bet on with a stop loss closer to about 854 on the downside, or maybe 850, a slightly deeper stop loss, and look for a target of 880 to about 890 on the upside. So this is one stock which I will still participate and still has room on the upside. As far as real estate is concerned, it's very selective bet there, Samina, and I think the only stock for me that stands out within that space is Oberoi Realty. And we've seen the stock actually come off quite a bit from the lows from 1950 odd levels to about 2164 at current levels. So I'll wait for the opening trade, how it is panning out Oberoi Realty. If I get the stock somewhere around 2120, 2140 types, then I would be a buyer in the stock with a stop loss just around 2100 on the downside and look for a target of 2250 on the upside.
No, Wonderla is not in the F&O space, but definitely worth a mention. So quick word on Wonderla in terms of trading activity today. How does it look on the charts? And I'll also add, Oberoi you've already talked about. I'll talk to you about a Zomato because the counter did well yesterday. Today again, there's a brokerage call coming in on the stock. So both the stocks. And if you want, maybe a PG Electroplast and Bharat Forge if you've not already discussed that with Neeraj and Tamanna.
So let's first talk about Wonderla, because this is we had seen massive up move in the stock yesterday on the back of very good volumes, trading above the 200 DMA. The immediate resistance for the stock is somewhere around 923, 924. So that will be the first target for me if I'm looking to buy the stock, and I would be looking to buy the stock, Samina, I can tell you, because it's a good looking chart setup as far as the longer term chart setup for the stock is concerned. Above 920, maybe I look for a target of 1000, 1050 on the upside. So I would take a positional bet on Wonderla at current levels and continue to hold on to the position. Talking of Zomato, to be honest, I would not look to buy the stock at current levels, sitting at overbought levels. I still feel there's a consolidation in the stock which will happen somewhere around 790 to about 800 is the resistance. 290 to about 300 on the upside is the resistance for the stock. On the downside, 270 is a support. So stock is continuing to oscillate in this narrow band, and I would look to buy the stock on decline, not at current levels. Talking of Bharat Forge, yes, this is one stock which I really like, and I think
Aditya, I'll come back to you because just about 15 seconds left. So come back to you on Bharat Forge, and we'll go to Dharmesh on Wonderla Holidays as well, because post the QIP there was a sharp rally. Wonder what Dharmesh thinks of it. But here's how the markets are starting off this morning. Okay, about to sneeze. That's me. Markets hopefully not sneezing and doing okay. Yes, it is. So again, the implied open was deceptive to a small extent, but 1/3% in the green. Banks not participating. Wonder if IT is participating. Salesforce had a good. The read-through from Salesforce is to be positive for a bunch of Indian IT names, so the Persistence and the Mindtrees of the world. 0.5% higher for Nifty IT. Mid cap about 1/3%. Small caps about 0.4%. Pull up the heat map. Wonder if LTI Mindtree is amongst the list of gainers. Well, Infi and TCS certainly are. Wipro is as well. Tech Mahindra too. So I reckon this is the Salesforce read-through effect. But let's wait and watch. Bharti Airtel about 0.5%. Hero Moto 0.5%. No big gains and no big losses. I think that's the other thing. So maybe auto, yeah, because Maruti, Eicher, Bajaj Auto, all of them slightly soft. But it's almost an even Stevens market. Nothing much to talk about in the large caps, Tamanna. Save for, like I said, IT starting off okay in trade.
Yeah, so a couple of factors which I think would lead to careful trade this morning. One is you have weekly Nifty expiry, you have the rate cut made, the RBI monetary policy announcement tomorrow, and now this sort of X factor saying that could there be a rate cut, with one brokerage, Nomura, saying that they think they could be. Let's pull up the sectoral indices for the morning before we move ahead and see what's happening there, because the broader markets also not showing too much of a move this morning. So quite a flat day. You have a pullback on PSU companies compared to yesterday when reality is down, but more green than red. So we could say that at least looking good. IT is the story of the morning through and through. The mid-cap just about 1/4% up, the mid-cap index. So nothing major happening there either. If it's stock specific, then let's talk about stocks. Vodafone and Indus Tower on focus today. Is this going to be the winning combination? Vodafone selling part of its stake in Indus Tower was roaring in the pre-open session, not so much right now. Vodafone actually has opened about 1% down. Remember, they also have fundraise plans. Indus Tower, on the other hand, a lot of brokerages now saying this becomes a good dividend play as well. Indus Tower actually doing well this morning. Torrent Pharma was in focus because of new acquisitions, mildly up in the green. Persistent Systems, we talked about positive view from CLSA. Has it helped the stock at opening bell? Just about 1.5%. So no runaway gains there either. Let's look at the pair trades, Swiggy and Zomato. Bernstein has done a comparison of both, likes Zomato over Swiggy. One is in the red, one is in the green, but mildly on either side. So no big deal there. Shriram Finance, we talked about positive brokerage views. A positive view from Jefferies, if I'm not mistaken. And that stock not reacting either. Bharat Forge is raising funds. Some good data has come in. Stock is completely flat. All of my picks are flat this morning. Samina, are you noticing anything which is showing some action, or is this a very quiet morning?
It's quiet, and that may not be such a bad thing. As long as we're not selling off, I think the bulls may be okay. But like Tamanna said, it's as quiet gets. The Nifty 500 is up slightly, doing better than the Nifty itself, up about 0.2%. The gainers have come out of nowhere, interestingly. So HEG is your biggest gainer on the Nifty 500. It's up 4% in trade as we see it. You've also got Kaplan. That doesn't look too bad. So that's the other counter that is up and about on healthy volumes this morning. Tejas Network is up 5%. Fertilizer companies aren't doing too badly, and I'm not sure why. Deepak Fertilizers is up 3.5% as we see it. Aster DM, this has been that acquisition story from early this week where they've acquired Care Hospitals. Maybe the news continues to go into the markets, and of course investors may be looking at acquiring the stock on back of that development. The stock is up 2.7, 2.8% as we see it. Max Healthcare is up 3%. Krishna Institute, very light volume, so I'll skip that for now. Swan Energy, Sapphire Foods, Indus Tower, not seeing the kind of rally that it was earlier expected to see on back of Vodafone Idea stake sale, but still looking good with a 2% up move in trade. You've also got KEC International that's been on a good run on back of order wins all through last week and continues to gain as we see it. But I think the trading idea for today could be fertilizer stocks. Fertilizers across the board aren't doing too badly as we see it. On the sell side, DVs, Cochin Shipyard, Honasa, Adani Green, a whole bunch of PSU banks are seeing some profit taking. The Phoenix Mills, Saregama, Concord are trading lower in today's session. But HEG is the stock of the morning. It's a large trade that's hit the street with 172 crore rupees, has changed hands at an average price of 600. So on back of which HEG is seeing some movement in trade. Aditya, you want to come in a few of those fertilizer names, not too many in the F&O space, but it seems like the trading activity could be focused around these counters because they're all moving on pretty large volumes as we see it.
Oh, yes, and it's not just today that it's moving. It's been some time that the fertilizer stocks have been on a roll. From the F&O space, I think a couple of names stand out. Chambal definitely is something which is looking interesting, has broken out from a downward sloping channel. On the upside, stock can immediately test levels of 550 to about 560 on the upside. But one trade that I think can be taken at current levels is Deepak Fertilizers. Stock is yet to see a sharp up move and see a follow-through move like a Chambal Fertilizer. So I think that will follow. At current levels, I am looking to buy the stock for a target of about 1450 on the upside and a small stop loss around 1320 on the downside.
Technically, these fertilizer stocks are looking good, but is there enough reason to buy into the fertilizer story, or you would avoid it? Dharmesh, that was for you on fertilizers. I know they've had a good earnings season, but looking ahead, would you acquire any of those fertilizer names?
Yeah, I mean, the business cycle is looking good for the fertilizer space. And usually you see before the budget, there is always a rally happening in these counters. But the second good point about this is monsoon has been very good and the moisture in the soil content has been really high, which is always a very good and sign for a fertilizer company. So I think with a lot of problems, settling in the Russia-Ukraine region, so the supplies of the input material commodity, all the potash and everything which they need as an input is now getting at a cheaper price. So going forward, their operating margins are likely to improve. At the same time, the demand will also be good from the farmers as the Kharif crop has been much better. So I think net they are set for a good cyclical run. Valuation wise, I think Chambal Fertilizer has the best valuation comfort out there. So that's a topic from that space.
Okay, there's some development on DV's lab. We'll try and get the details, but apparently one of their large products has got some negative read-through. That's the faint news that I'm gathering. Not quite sure. There's no exchange announcement at least. But the stock is down about 4.5%. So amongst the stocks that was highly recommended in trade yesterday. But of course, a negative development can't be foreseen on the charts. So that's to be kept in mind. The one which is really revving up is Persistent Systems. 1.5% higher in trade. So that one too is starting off on a good note. So keep a couple of these stocks in mind. But Dharmesh, like I said, I want a quick check with you on Wonderla Holidays. A QIP yesterday got successfully subscribed. The stock zoomed in trade. Do you like the business? Would you be an investor here?
Yeah, good morning, Neeraj. I mean, this space has not picked up the way it should have picked up in India. I mean, there were a couple of attempts by different business groups into this space, but nothing like, say, a Universal Studio or a Disneyland kind of a concept did not, materialize. That is what I was looking forward to when initially these concepts were brought in India. It's a highly capital-intensive kind of a business, and you have a long gestation period before the actual cash flow starts trickling in once you set up a facility. Wonderla Holidays, I mean, very geographically specific consideration is there. Hyderabad, Kochi, and Bangalore is where they have been operating primarily, and Bhubaneswar is another place where they are falling into. But the trajectory, I mean, the run rate on the revenue and profitability is not that high. If you look at the CAGR, it's only 10% for the last 10 years, and that is the region where it is likely to be. Margins has been fluctuating. Having said that, valuation wise, it looks a bit stretched. I mean, 30 plus P multiple it is having with an ROE of 13-14%. So that's the business mix. So it's a steady state kind of a thing. If a good correction has happened in the last 3-4 months, if you get that opportunity, it's a good trade. But as a house, we don't like this sector because it's not shaping up the way it should have shaped up. That was the initial thinking.
I just want to look at one of the movers this morning, which was expected to do well, but is actually not. Vodafone, 2.5% down. Now, here's the news. They've sold their part of their stake in Indus Towers for $300 million. Also news that they want to raise funds. Should have been sort of a positive view, but clearly is not. And before I get a fundamental view from Dharmesh, just on the charts, what are you seeing on Vodafone? You had a positive view on Indus, I recall, before the markets opened. So that continues. And what on Vodafone, Aditya?
Yes, Indus Tower, I'm still constructive. In fact, it's a good time to look at the stock. After a gap up open, it has seen some bit of a correction. Coming on Vodafone Idea, Tamanna, I'm still not too sure. I'll give it some time and see whether the stock is really turning around and making higher highs, higher lows. Even at current levels, after all positive news flows, stock tends to form lower lows after a blip on the upside. So I would still avoid the stock. If you already have it, maybe then you can place a stop loss somewhere on 775 on the downside. Otherwise, fresh entry at current levels, I would completely avoid in Vodafone Idea. There are a plethora of opportunities out there, so why not take a look at them?
HEG is up 6%, Kaplan Point is up 4%, Aster DM is looking good. And look at Zomato, 294 on Zomato. It's up nearly 3% after a sharp up move in trade yesterday as well. Dharmesh, I know we talked about this, but at 294, long trade on Zomato, or it's in a void for now?
See, I would prefer a Swiggy rather than a Zomato just on the valuation comfort. Business-wise, I mean, both have proven they're returning to their profitability path quite aggressively, and the business have picked up really well, shaping up well. So that has been established. The only thing is the valuation part. So Zomato, I think, is now fairly priced. I know rather on expensive side. Swiggy does offer you a comfort as the management has guided if things roll out that way. So there's a lot of comfort, and this gap between the two is likely to be, converse in favor of Swiggy. So as a trade, I think one should be taking on Swiggy rather than a Zomato.
Swiggy rather than Zomato, Dharmesh. So
Yes.
actually not what Bernstein is saying, but interesting take. All right, where Aditya, any view there? I mean, you will not have much data on charts for Swiggy, but for Zomato?
Like I said, 300 is a major hurdle for the stock. I mean, I'll wait for the stock to cross 300. I'm not in a hurry to go long on Zomato just at current levels. It's just sitting at overbought levels on higher time frame charts.
Thank you so much, Aditya and Dharmesh, for joining us today on this leg of the show. So, quiet start, but one focus which is, one sector which is in focus is definitely defense. Several counters have seen multiple acquisitions. My colleague Anushi, who tracks the space closely, is joining in with the same. So, what is the buzz for defense stocks right now, Anushi? Why are they in action on most days?
Hey Tamanna, so yesterday we spoke a lot about the capital acquisition proposals which took place of the size of 21,772 crore that continues to be in focus. This was the Defence Acquisition Council approving the 5 proposals both over the number that I've just mentioned. Now this includes procurement of 31 new water jet fast attack crafts for Indian Navy, which is Garden Reach Shipbuilders, Cochin Shipyard, Mazgaon Dock. All the stocks were gaining in trade yesterday. Even if we look at the procurement of electronic warfare, next generation radar warning receivers also is another area to be focused on, where some of the key players include Bharat Electronics, Data Patterns and Astra Microwave. Other than that, procurement of 6 advanced light copters for surveillance to strengthen the coastal security and surveillance, wherein this brings focus to a stock like HAL, Hindustanic Aeronautics. But even if you look at the previous update of what has happened, the Defence Minister also greenlit 10 capital acquisition proposals worth rupees 1.545 lakh crore. So this gets the total sum to about 1.65 lakh crore that we are looking at. And this was for the procurement of future-ready combat vehicles, air defense, fire control radars, and for the Indian Coast Guard capabilities that we see. Just to give a brief sense on how the defense spending over the years have been from the government side, allocation for this year 6.21 lakh crore, 18% of growth compared to last year. FY24 about 5.94 lakh crore, which is 13% of a growth. So this is what we are looking at, higher focus on the acceptance of necessities for the second half that we are looking at, because if we see in the first half there was a slowdown in defense ordering as we speak. So defense sector back in focus after some correction which had happened earlier in the last 1 to 2 months that we'd seen.
Right, thank you for that. That's, of course, perspective into what is happening in the defense pack. Remember, defense stocks have been called the Modi trade for really long. And even recently, with the sweeping victory in Maharashtra state, defense became a great trading cue for a lot of investors and traders on the street. Today might be a morning when some of those counters are quiet, but remember, with significant order wins in the last few weeks and the fact that these counters have been wealth creators, even though most big institutions don't actually have exposure to the stocks, it's been transient and made money for traders. Amit, and I'll start with that. Amit Anwani, research analyst of PL Capital, joins in. Amit, I want to start with just that, right? Defense as a space, while has been a wealth or a money bagger in the last many years, it's not been part of many institutions or mutual fund portfolios. A lot of people have viewed this sector very transient in nature. Right? So they've come in, bought the counter, made some money and checked out. Do you feel like that's about to change now? Or should change?
Right, thanks. Yeah, thanks for having me. So I think first perspective, you see there's a lot of IPOs which came 6-7 years back in defense, including HAL, and we saw GRSC IPOs coming in. So all this, I think broadly, there has been a major change which has happened in the government stance in past 10 years to really open up the defense sector, localize in a big way in all the components which goes into defense, and try to reduce the import so that the sector becomes self-reliant, which is a lot of for a lot of components still dependent on the global supply chain. So you see major transition, I would say, or disruption has happened in defense in past 7-8 years. Now, coming to the ownership, if you see gradually before all these IPOs came, Bharat Electronics used to be the mainstream defense stock, and where the government ownership is, I think, about 51-52%, and largely broadly owned by the institution for the longer term perspective. I think the issue with few of the companies might be the larger government ownership at 75-80%, with which might come down with OFSs, but it will be a long run. But having said that, specific to sector, if you see for many years, past 2 decades, there was a lot of focus on engine developments, and then LCA came, which all these programs were running for 20 years. But we saw major breakthroughs happening in past 5 years, and a lot of orders came in for production in past 2-3 years, and this very robust and strong order book finally coming for many defense companies to actually utilize their facilities for the faster pace of execution. So strategically, I would say the government policies has been very critical and focused to really open up the sector, and that has actually changed many things for the sector. Yeah.
Okay, so let's get specific, because and just give our viewers perspective about why this is important. So the Defence Acquisition Council has approved these 5 proposals worth over 21,000 crores, nearly 22,000 crores. So every year the defence budget earmarks how much the government of India is going to spend on the sector. This step of the DAC, that's the Defence Acquisition Council, actually approving it is the key important step. I mean, liken it to the tiny budget being granted. So these are the funds that you can buy. These are the proposals that we will do. Let's come to that specifically. And Amit, I want to get your view on what companies will benefit. Is it going to be HAL which benefits the most? Do you see a BEL? Because they're looking at electronic warfare suite, next generation radar warning receiver, and the focus more and more has been on Make in India. So in your view, which are the biggest beneficiaries of these proposals being cleared?
Right, so I think the proposals which were cleared yesterday, there's no broad-based breakup, but what I can understand, there is a 6 ALH advanced light helicopter deal which is cleared. So definitely where HAL fits in, so there are a lot of helicopter orders in the fray, where HAL is going to be the prime beneficiary in coming quarters as well, as and when these orders are cleared. I think apart from that, there's as you said, rightly highlighted, EWS, Bharat Electronics is the key beneficiary, and to some extent Data Pattern has some electronics which goes into EWS. But Bharat Electronics primarily is focusing on radars, EWS, and a few of the defense electronics orders which are yet to come, and the current one which they received. So definitely Bharat Electronics will be the beneficiary from here. BML specifically, I read that there's an overall opportunity for T70 to T90, which we have been talking about since long time. And BML is looking for the major opportunity in the mobility vehicle space in defense. So definitely pretty strong. This kind of orders would be pretty strong for BML. And we saw in budget also the government increasing the allocation within the defense budget to the mobility vehicle significantly in the last budget. So definitely the mobility vehicle again coming back in focus. And we have seen all this aging fleet, more than 30-40 years of aging fleet, and defense mobility vehicles requires a lot of overhaul. And I think this is the first step, and there could be subsequent orders coming in here. So broadly speaking, I think for us with this order, Bharat Electronics, HL and BML in parts would be beneficiary in our coverage. Yeah.
Amit, sorry, just to break this down, and I know a couple of stocks that you mentioned already in the focus, and BL has been a buy call, I think, across the board. I want to add a few more to that list. So, and I want you to divide this between private and government sort of run companies. How do some of the smaller private players look to you? So a Zen Tech, for case in point, a Data Patterns, a Paras Defense. Is it an opportunity for investors to make money here? And maybe not for today. I'm talking about this from a 2 to 3 year time horizon.
Right. So I think if you see the way defense electronics sector is shaped, the government is very critically focusing on localizing a lot of defense electronics, including optics, where the Paris operates. So we have just Bharat Electronics under our coverage. But talking in general about the sector, if you see, DRDO has been very critical of collaborating and giving chance to all the private sector to also come forward and research on a lot of defense electronics. There's been focus on upgrading defense electronics, which is typically 5 to 15% of any defense deal, I would say, broadly speaking. A focus in terms of capability upgrade, which is coming in with a lot of OEMs. So, for example, LCA moving from Mach 1 to Mach 2 to Mach 3 in future, and increasing the maneuverability of the aircraft's OEMs, making them much faster from Mach 2, Mach 3, Mach 5. This requires highly advanced defense electronics where we are focusing to really improve locally. And there's a lot of private collaboration which has happened. DRDO on the research side also, DRDO giving opportunities to private players. There's a lot of startup programs from the DRDO side. So definitely the defense electronic ecosystem for private players is also highly conducive, I would say, for next 3 to 5 years. And we have seen profits for many companies you highlighted going up 2x, 3x in past 3 years because of the opportunity which that they have got and they're sensing. So definitely for me, within defense, where the OEMs is one part and defense electronic is the other section, definitely defense electronics will be more consistent and accelerating in next 3 to 5 years for sure for me.
Thank you so much, Amit. That was Amit Anwani on the opportunities in the defense space, and definitely that looks exciting. One big tranche has been cleared by the Defense Acquisition Council, and which is why that focus has grown. But let's talk about a stock that is not buzzing, actually, a negative news, positive news flow, but negative reaction this morning. Vodafone will be selling its 3% stake in Indus Tower for over 300 million. Rucha joins us with more. Rucha, why such a negative reaction? I mean, Indus is doing fine. We'll talk about Indus as well. Do we know who's acquiring this 3% stake? Do we know why Vodafone has reacted so negatively?
So Tamanna, as you rightly mentioned, Vodafone is selling up its remainder 3% stake in Indus Towers, and this will largely happen for about 2,800 crores. In addition to that, it will also raise new funds in terms of equity of about 2,000 crores, and all of these will be used to repay its $101 million in debt, and that amounts to approx 855 crore rupees. And balance from this will be used to pay off Indus Towers. Remember that Vodafone Idea owes around 3,500 crore in debt to Indus Towers, and this is why Citi believes that this will be an additional cash flow for Indus Towers and hence increased dividend payments for the shareholders. But talking about what you largely asked about the Vodafone Idea's reaction, yes, about 3% down in trade today, but you know what the street is expecting is that Vodafone Idea to revive. Even Goldman Sachs has given about 2.5 to 3 rupees as the target price, and it says that Vodafone Idea is yet to show, and it is not able to maintain its stance in terms of competition. But back to Indus Towers, well, Citi believes that this one is positive and therefore expects about 35% upside with a target price of 485 rupees, because increased dividend, increased cash flow would of course benefit the shareholders. So largely, even if we look at what Bloomberg analysts are saying, bullish stance on Indus Towers with an upside of about 13% based on consensus target price, but Vodafone has a bearish stance with a downside of about similar levels.
Okay, thanks for that, Rucha. Well, Piyush Pandey, telecom analyst at Centrum Broking, joins us right now. Piyush, let's divvy up the chat into the two that matter right now. And of course, we can add Bharti, Reliance, etc. They've been sulking as well. But first, I want to start off with the mild positive on Indus, which was believed to be very strong because some of your peer sets believed that this is a great dividend yield play by virtue of what's happened, that Vodafone will sell stake, get cash, put money into Indus. Indus gets cash, they will give a large dividend in second half and then FY26 and 27. Do you subscribe to that thesis, or is your thesis different? And what's the call on Indus Tower thereof?
So we are positive on Indus Tower, and we currently have buy rating on Indus Tower. So broadly we believe that CapEx of Vodafone Idea would broadly help to improve the number of towers and tenancies for Indus Tower. And as well as cash flow issues, because there is, I said, Indus Tower a reasonable amount of receivables from Vodafone Idea, and this cash inflow would help to sort out these issues. So broadly, we are positive, and we think that the number of tower addition should pick up in the coming quarters because of these cases by Vodafone Idea.
Okay. So you believe it's a dividend yield story according to you, Piyush, as well, or is it something else for Indus?
Okay, it's like a dividend yield story, but I would say in the next couple of quarters, you would see strong numbers also, like. So generally for Indus Tower, growth has been an issue, like. So if you see over the last couple of years, revenue growth has been quite muted. But I would say that in the coming, I would say next 1 year, you should see reasonable, I would say, pick up in revenue growth. So in fact, and that should come at a slightly better margin also.
Okay, I'm trying to understand, Piyush, how you look at Bharti Airtel in the middle of this, because Bharti has got a significant stake in Indus. It's not clear yet who is picking up Vodafone's stake, and it's 3% at this point. So in this mix on the telecom landscape, how are you looking at Bharti Airtel as a play?
Bharti Airtel remains long-term commodity, so it is like it has an industry-leading ARPU at rupees 230 rupees, plus very good mix of 40 customers. So broadly, we feel that Bharti would continue to gain market share at least for the next 1 to 2 years at the expense of Vodafone Idea. Plus industry-leading ARPU, good customer mix, and plus its capex will also moderate in the coming quarters. So you might see strong FCF generation from Bharti Airtel, and that would be good for the stock. Yeah.
Just very lastly, between Bharti and Vodafone, where is your preference and what would you buy today if you had to?
So see, I have an add rating on Bharti Airtel and I have a reduced rating on Vodafone Idea. And
buying the telecom pack at all?
So my two topics would be Bharti Airtel and Indus Towers.
Bharti Airtel and Indus Towers. Thanks, Piyush. Have a good day and we'll speak to you soon. Bharti Airtel is Piyush's topic. He has a sell rating on Vodafone and a buy on Indus Towers as well. And that's how the stocks are doing. Vodafone taking it to the chin, down 4%, while Indus Towers is seeing a 1% gain in trade. It's well off the day's high point too. A quick check on how the index is doing. Remember, it is expected to be a morning of consolidation. The last 3-4 days this week haven't been too bad. The Nifty is up 200 points between last Thursday and this Thursday. 24,500 is an important sort of level that the bulls have been facing resistance at. Yesterday as well, we did for a short period of time spend some time above 24,500, but that didn't last too long and profit taking emerged at those levels. On the downside, the range is 24,300, which will act as an important level of support. The breadth of the markets deteriorated just a teeny-weeny bit from the get-go this morning. You have a few gainers and you've got lots and lots of losers now. Bharti Airtel is up 1%, Tata Consultancy, Axis, Dr. Reddy's are some of your gainers in early trade. In the broader market universe, your top gainer is HEG and Castrol, and BSE, I mean, look at that. BSE is up 4.5%, and I have no idea why the stock is doing that. What I do know, though, is that NSE in the private circle is available at 1580, and the demand is not as phenomenal as you would have thought at that price. But of course, there is one stock that's on the sell side this morning off the day's low point, but still trading weaker, is Divi's Lab with a 3% cut. Varsha is standing by with more on why Divi's is coming under pressure this morning. Varsha, tell us what we know. The stock is weak. It's off the day's low, so there is some buying that's coming in at low levels, but I believe there is some news that's disturbed investors this morning.
Yes, Amina. So actually this news has been going since months now. Now US Federal Circuit Court rejects Novartis' bid to block rival Entresto. Now all this is revolving around a product called Entresto, which is a hard drug product which is manufactured by Novartis, the innovator company, and Divi's make API for this product. Now the story is that Novartis tried to stop MSN Pharmaceuticals from selling a generic version of this heart failure drug Entresto, claiming that it violated their patent. However, the court ruled against Novartis because they couldn't prove that MSN's product used the same specific form of the drug's active ingredients that their patents protects. Thus the judge agreed with MSN and said that Novartis didn't provide enough proof. Now, why this is important for Divi's, or why the Divi's is down? Because Divi's CDMO contract with Novartis for this drug contributed almost 8% to the overall revenue and 19% to the CDMO sales for FY24 for DVs. Now, few days back, Citi had came out with a report around this product, but Citi said that even if generic version comes out of this product by MSN Pharmaceuticals or by any other company, DVs shouldn't face any problem because DVs manufacture this product in a large volume, in a large quantity, and DVs is the only company which has a cost competitive advantage when it comes to every API because it manufactures products on a scale. So even if generic version comes out in the market, DVs will be a preferred supplier for this API as well.
Okay.
So just one follow-up there. Varsha, so just one quick follow-up here. Now that this has happened, what is the way ahead? Maybe you spoke about it, but these US court cases, and there is retrofiling that happens at times as well. So in this one, do we have clarity of what happens next now that this bid has been rejected of Novartis?
Right now, we do not have this clarity because US will, the court will come out with whether they'll allow the generic version of this product to come. But if the generic version comes out, DVs, I don't think so DVs will have a problem with this because of the volume that they make. But yeah, no such verdict as of now.
So bad news for Novartis, for DVs actually, because of the Novartis patent infringement suit this morning. So that has been under pressure. But I think the excitement on BSE is something which is definitely worth noting. Even some of your auto anchors not half bad. Look at all your tire stocks. Apollo, MRF, all doing fairly well this morning. The other space which is looking exciting, I would say, is hospitality. We're going into that season and this quarter generally good for the space. Patanjali Keswani joining us now. He's chairman and MD Lemon Tree Hotels. Great to speak with you, Mr. Keswani, and great to have you on NDTV Profit as always. Let's start with your outlook and a sense of the kind of demand that you're seeing and what is a crucial period in December.
So, good morning. I'm seeing very good demand compared to last year for Lemon Tree. And as you said, typically winter is obviously the better part of the year. So H2 is typically 15-20% better in revenue terms than H1. So that is very much playing out. And in fact, I think it will be better than significantly better than our relative performance last year on a year-on-year basis.
Saying this quarter, Q3, will be significantly better than last year on a year-on-year basis, is it?
That's right.
Okay. And then also the other news flow which we keep hearing about Lemon Tree is all of the new signings and I think rapid expansion geographically. What is the strategy there?
So actually, there are two parts of the strategy. One is owners. So one is reactive. Owners reaching out to us to be included in our network, where they get the advantage of obviously brand access to distribution, to customers, to our loyalty members, and also our cost structures and so on. So which is a purely outreach to us from a financial network perspective. Then there is a strategic aspect, which is where we make specific outreaches, which is very proactive, where we think there are markets where we should be present and we are not. And these are primarily because they are relevant to our network. They also enable us to access new consumers who are in those cities who are not so familiar with our hotels and our network. And therefore, it's a combination of both. And we are accelerating it. We've signed over 20 hotels in the last 3 to 4 months. I expect we'll sign another 20 in the next 3-4 months. And ultimately, all these will become operational in the next 2 to 3 years and take us to our announced target of 20,000 rooms by 2027.
Mr. Keswani, good morning. Neeraj here.
Morning.
Trying to think out loud, I mean, some of your peer groups have said that while this industry has largely remained a structural or a cyclical industry, there is every likelihood that it may not remain so and may actually become structurally a long-term, non-cyclical industry if indeed India continues to grow 6.5%, 7%. You've spoken about the 3-year targets of the numbers that you reach. Typically, that would mark the end of the cycle which started 2-3 years ago. Do you believe this time around might be different?
I absolutely believe it. And whatever my peers are saying is based on actually the inflection point of India's GDP per household, where we are currently. So we are roughly at $2,700-$2,800 per person, or about $12,000 per household. But if I do this across a distributed set of income earners, then the number of Indian households, so see there are 32 crore households in India, and only about 3-4 crore households are actually what you and I would consider real consumers of discretionary items. So when I look at India's GDP per household today, and I just project a 6% growth over the next 5 years, and then I overlay it with some very interesting indicators like the fact that the number of airlines in India, the number of aircraft in India or aircraft seat in India is going to grow nearly 3x in the next 5 years. The number of airports is going to nearly double. The number of runways are going to more than double. The number of 4-lane highways in India have doubled in the last 5 years, and I'm informed will double in the next 5. The number of SUVs that are sold in India are skyrocketing with hatchbacks. The number of Vande Bharat trains, and then I overlay it with this income shift. I think that the number of consuming Indian households will grow from maybe 5 million or 6 million or 8 million to about 30 million, which means that there will be enablement from income and from connectivity, which means obviously that there will be a huge uptick in demand, and it will not be an annual demand of growth of 7-8%, but more like China and other countries who went through the same change, where there will be a growth in demand of 20-25%. And then after 5 years or so, that will be the new reset. And then we will go back to this cyclical thing, because there'll be high demand and by then I hope some high supply additions. This will happen not only for the discretionary sector of travel and tourism, it will also happen for a bunch of other discretionary sectors. For example, athletic wear, for example, footwear. So I'm very bullish over the consumption sector. And we who are part of it will benefit enormously in my opinion.
So Mr. Keswani, if indeed it's about 20-25%, the number that you spoke about for the next 5 years, what does that do to one of the market leaders like yours? I mean, would your earnings growth or revenue growth actually be northwards of that for the next 5 years on a CAGR basis?
Absolutely. So see, demand for hotel rooms where supply is fixed, any industry where supply is fixed, which is, for example, it could be coal, it could be oil, it could be buildings like hotels. A 1% change in demand leads to a 10% change in pricing, because you can't add supply in the short term. So my expectation is we'll go back to the last upcycle we saw, which was actually not for these reasons. It was just due to the economy expanding fast, which was in 2004 to 6, where every year the average rate changed by 30-40%. So when I look at it very, very rationally, in absolute rupee terms, our average rate today is 30% less than what it was in 2007. And I have no doubt, absolutely, that in the next 5 years, average rates in India will start trending towards average rates of Asia, which means they will increase 2.5-3x.
Keswani, it's also Samina joining in. And now let's talk a little more company specific, right? You did indicate to Tamanna that the wedding season, this season generally is a good season for hospitality. The other standout has been that in the previous quarter, while occupancy had declined, your average room rate had actually gone up by over 3%. Now we are in a season time when the outlook looks far more promising than the previous quarter. How are you feeling about ARR? Will that continue to improve? Could we expect the average room rate also to go up in the next couple of quarters?
So asking me about ARRs is like asking an airline about, ASK or asking Bharti about ARPU. I would not look at it strictly from just average rate perspective. Average rates have gone up and will continue to go up quite significantly. What will actually change is the revenue per available room. Ultimately, when you have a lot of owned hotels or you're managing hotels for other owners, what the real metric you want to look at is the return per square foot. Okay. And what is your fixed and variable cost below that return per square foot, enabling you to get some kind of a return on your investment in these assets. My view is that average rates and occupancies are going to continue growing. Occupancy will grow by maybe 7, 8, 10% from, from say 70% to 75, 80%. But rates are where the future lies. And as I said, rates will grow by 10, 15% every year, in my opinion, in the next 5 years. And 90% of that will go to your bottom line.
Swani, a little more company-specific conversation. You've reduced your debt by about 20 crores. What is the roadmap to turning debt-free? Because I know that's a priority of some sorts. And also, what will that do to future capex plans that you have? Is that built in?
We will cross a cash flow generation of 100 crores from this, 800 crores, $100 million from this year. That will be our EBITDA. So earlier we were allocating this capital to a bunch of initiatives, which is catching up on renovation for our portfolio post-COVID. We were also focusing on heavy investments in digital transformation. So all these will kind of get done in the next 1 year. And then this cash flow will simply become available for debt reduction. So I think we will 100% be debt-free in the next 3 to 4 years. However, if we list our asset company, which is in a joint venture with a Dutch pension fund manager, where 80% of our debt resides, then we will go debt-free the week after we list, literally. And that I have said quite openly and publicly is something we intend to do in the next 12 to 24 months.
So has that timeline, and the last time we spoke, Mr. Keswani, also you gave us this timeline. Has that timeline remained the same, reduced?
Yes,
are you going to see it in calendar year 25?
Well, you see, it's a process. It'll either be an IPO or it'll be a scheme of arrangement. We have a certain, well, we can't be 100% certain about, the time because it goes through various agencies. But certainly in the next 18 months, we should list it, in which case the debt-free will be in the next 18 months. Otherwise, in the worst case, we'll be debt-free in the next 3 to 4 years.
Just want to get your outlook on the management fee component. If I'm looking at your Q2 numbers once again, and management fees saw an uptick. You've also obviously signed a lot of new companies on, or now have a footprint in large parts of India. Meghalaya, government of Meghalaya was the recent one. How are you seeing revenues from management fees growing overall and for this financial year?
So the government of Meghalaya was actually we've taken an existing hotel on lease. We intend to break it, and it will be a part of our own portfolio, so to speak, with the land given to us on a long lease. And it's a market we are very, very bullish on. Plus, we want to grow more aggressively in the Northeast. As far as the managed portfolio goes, our managed fee income this year will be about, from non-owned hotels will be 70 crores, and from owned hotels will be maybe 120 crores. So maybe about 200 crores. If I look at all the hotels we are signing and the likely addition of new hotels, then my best guess is that in about 3 to 4 years, our management fee income will be north of about 350 crores. Okay, maybe even 400 crores. So that's something that is, nearly certain. And if we aggressively add more hotels, as we hope to, especially under the franchise route, then this could be a high number.
Also, could you provide some more details on the shift toward the 70% plus asset-light portfolio? By how much will this impact profitability and operational efficiency over the next couple of years?
So see, today we have 6,000 owned and about 4,500 managed rooms. We've said we'll hit 20,000 in the next 3 years. at 20,000, really this 6,000 owned rooms will grow very marginally. So we will anyway be 70-30 there. Typically, we earn, if I just take a simple number, we earn 13-14 lakhs per owned room in terms of EBITDA. So these 6,000 rooms should give us an EBITDA of about 800-850 crores, which is what I was talking about $100 million. The managed portfolio, for every 7 rooms, we get the EBITDA of 1 room because that's our share of the fees. Now, the fees is typically 1/6 of the EBITDA. So we have 13,000 rooms under management, or 14,000 to hit this 20,000 number. It is like owning 2,000 rooms, roughly. So 2,000 rooms will give me another 250 crores of EBITDA. So add the two together, we are talking about 1,000 to 1,100 crores of EBITDA in the next 3 years. Take out the below the line expenses, and by then I expect interest will be nothing. So you're really talking non-cash depreciation and corporate expenses. So you should have, and then take out tax, you should have free cash of about 800-900 crores a year, which is why I said we will be debt free anyway, and it will be more than enough to also solve for any capex requirement for growth in the asset company, which is a subsidiary currently of the main Lemon Tree.
Lastly, Mr. Keswani, of course, we would love to understand, and I know there's enough and more demand in our country, so very little reason to look outside, but any global expansion plans, anything on the international market? Because I'm just assuming that while revenues may be one piece of it, those businesses may be a little more profitable, right?
So, if you look at the top 5 hotel companies in the world, you can really look at their growth using an XYZ axis. I don't know if I'm making sense, but most hotel companies started with one brand in their home country. They grew that brand, then they expanded across brands, that is price points in that country, and then they moved to other countries where their loyalty members were going. And then over time, they saturated all markets. So this is roughly, and there's no rocket science, this is what Marriott did, this is what Hilton did, this is what all of them did. India is no different. Now, the interesting thing about India is India has only 11-12 million foreign tourist arrivals coming in, but 25 million Indians are traveling out. And it is my expectation that if I look at this structural shift in consumption and this growth in airline traffic, I think these 26 million Indians will start hitting insane numbers, like 100 million Indians will be traveling overseas by the end of this decade. What does this mean? It means India will become one of the most important outbound markets in the world, like China was some years ago, Japan was 15 years ago, America continues to be, and so on. Which means hotels worldwide will start catering more to the specific needs of Indians, whether it's in cuisine or, in multiple ways. Now, if we are growing our loyalty program within India for Indians, and we are very, very focused on being an Indian brand for Indians, then certainly we would like to go to those cities where these Indians are going. So we've identified about 12 cities. I think on a Pareto basis, 80% of Indians travel to the cities we are all familiar with, whether it's, Dubai, whether it's Nepal, whether it's Thailand, the cities there like Bangkok. It's a no-brainer that any Indian brand with a strong loyalty program should be there to attract those customers when they leave India. So strategically and partly opportunistically, we will grow there. We will grow in an asset-light way, and it will be linked directly to the growth of the Indian household income and the growth of this bunch of Indians who will travel internationally.
Thank you so much, Mr. Keswani. Pleasure speaking with you as always. That's the outlook for Lemon Tree and the space, actually, looking quite positive in a season which is generally good for the hospitality sector. We'll take a very short break. On the other side, we put the spotlight on all of the buzzing stocks this morning, but we're also bringing you a very interesting conversation with Gautam Shah, founder at Goldilocks Premium Research, about markets and more. Stay tuned.
When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed. It is our job to bring you news that truly matters. At Profit 360, we cut through the clutter, the Wall Street deals, finance and policy news that could shape your tomorrow. The newsmakers, the trendsetters, and the innovators. In 30 minutes, we've got you covered. So stay ahead, stay informed, and stay profitable with Profit 360.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed. It is our job to bring you news that truly matters. At Profit 360, we cut through the clutter, the Wall Street deals, finance and policy news that could shape your tomorrow. The newsmakers, the trendsetters, and the innovators. In 30 minutes, we've got you covered. So stay ahead, stay informed, and stay profitable with Profit 360.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed. It is our job to bring you news that truly...
Hi, good morning. Thanks so much for joining in. You're watching Ask Profit on NDTV Profit. My name is Alex Matthew. With me is Mahima Vajrajani, and we will take you through the next 1 hour of trade. It's been a great couple of weeks because we've tried a new thing and it has worked. We've opened the phone lines for you and you've been calling in. We've gotten some fantastic questions and hopefully we've been able to help you as well. It's been amazing speaking to you directly, and to that end, if you've got questions for us, you can call us on that number that you see on your screen, or you can send us a message in case you don't want to bother holding the line, which sometimes you have to do. But let's take a look at the markets and see how they're faring right now before we get to the questions that you've already sent us. And we've got a very narrow range for the Nifty 50 and indeed for the markets right now. We've given up about 0.5% on the benchmark Nifty 50 over the course of the morning so far, and we are trading with cuts of about 0.2% or thereabouts. Similar story for the broader markets as well, where the mid-cap index is currently losing ground, and you also there just about at yesterday's close, and you have the small cap index that is also more or less treading water at this juncture, up about 0.33%. But the market breadth is tilted in favor of the declines as we speak right now, and in fact that is visible in the sectoral picture, where you see only the Nifty IT index that is trading in the green, and most of the indices are in fact trading in the red. So you also have so in terms of the sectoral indices, only the IT index is trading in the green, and most of the other indices, as I pointed out, trading in the red, but not very significant losses. So you have energy that's down about 0.7% or so. The Nifty Bank index has lost a bit of ground, 250 odd points from the high point of the day, and now trading in the red as well. But there are several stocks that we've been looking at in the morning, and a few of them, of course, having also lost ground. One of them, the Indus Tower, news that came out not too long back, but it's only trading with gains of about 1% or so. What else is standing out to you?
Right. So both the telecom space stocks were buzzing in trade today. In fact, they are buzzing in trade today. Let's pull up Vodafone Idea and see what it's doing in trade today. It's set to sell another 3% of stake in Indus Towers, and it is also raising funds of around 2,000 odd crores. And Citi on Indus Towers is an interesting note to watch out for. They've given a target price of 485. Indus Towers is currently trading at 364, up around 1.3%, and Vodafone Idea is also faring well, comparatively well in trade today. Let's pull up that. No, but it is I think lost its grounds, and it's now trading at its day's low point, down around 4.95 odd %. Let's also pull up Zomato and Swiggy. Interesting note coming from Bernstein about Zomato versus Swiggy. They've given a target price of 335 for Zomato, so their pick remains Zomato in this space. Something like Torrent Pharma, Indraprastha Gas are some of other counters that are, faring very well in trade today. But let's welcome in Samir Dalal from Samir Dalal and Natwalal Sons, and also Khush Bora, who will be taking us through our funda and technical queries. For viewers who are just tuning in, you can ask all your stock related queries on the number that is flashing on your screen. The number right now that's flashing on your screen is the number on which you can reach out to us, call us and ask all your queries. Moving on to the first query of the day. I cannot see the I cannot see the name.
I got it in front of me. We've got Rajendran who's written in and is asking about IndusInd Bank. He's got 30 shares at a price of 1,004, and he's asking whether he can hold on at this juncture. He hasn't specified his time holding. He's more or less where the stock price is right now. So let's go across on the technicals to Khush Bora. Khush, morning to you, and morning to you as well, Samir. Khush, I'm coming to you on IndusInd Bank. Would you hold on to this?
Hi, Alex. First, very good morning. Morning, Samir. Well, look, a bulk of the damage is done, on this one, reeling under pressure. But I'll take heart from the fact that, the recent lows that it has made, it's now starting to form a base around it, had gone to the oversold territories and, rebounded from there on. So I think bulk of the damage is done here. From a risk reward standpoint, it looks very, very attractive. So with a stop loss of 960, I will continue to hold IndusInd Bank. On the way up, the first hurdle will come at 1,020, but once that is taken out, you could see some acceleration towards 1,080 as well. So IndusInd Bank is a hold.
All right. The next question is from Raj Shekhar, who's from Bangalore, and he wants an explanation as to why TCI Express is falling down. He has bought 100 shares in TCI Express at around 1,260 a piece, and he's saying that it's almost 35% down. Can we pull up TCI Express and see at what price it is trading at? Currently, there you go, it's trading at around 834. So he's incurring a loss of around 42,000. Samir, I'll come to you on this one. Is it the fundamentals that's hurting the company, or what's the reason, and what should be the next step for Raj Shekhar?
So unfortunately, we don't have TCI Express under coverage, so it will not be possible for me to say why it's been falling.
According to you, TCI Express, does it look attractive on charts, because it's fallen quite a bit?
Sadly, it doesn't look attractive even now. I'll only take heart from the fact that, the lows or the congestion zone that the stock has around 800 to about, 850 is where the stock is currently. And, this was the level where it had consolidated late 2020, early 21. But despite that, there are no signs of any kind of a revival or a recovery. The stock's seen selling pressure at every rise. So I wouldn't be too optimistic, on this one. Any slip below this 800 mark could actually further accelerate the downside that has begun nearly about 2.5 to 3 years ago. So I'm not very optimistic on TCI Express, even after the kind of fall that it has seen.
Okay, all right, so it's not looking very good, Rajshekhar. Hopefully that answers your question, and I would think that is an exit based on what Khush has said. Subhadra is calling in from Hyderabad, and he's holding Borosil Renewable. Subhadra, thanks so much for calling us. You're our first call of the day. Good morning to you. How can we help you?
Good morning, sir. I have bought 150 shares of Borosil Renewables at the rate of 485. My view is very, very long term. I can hold it long.
Okay, what is the definition though of very, very long term, Subhadra?
Maybe 6 years, maybe 7 years also I am willing to hold.
Okay, and so I'm guessing you bought this. When did you buy this?
About more than a year back, probably 1.5 years back.
Okay, so Borosil Renewables, let's pull up the chart, 1 year chart, and see how it's done. It's up and about in trade today. So Bhadra, I'm just curious, when you bought this, what was the thinking behind it? You must have read something about the company.
Yes, in fact, I was in a hurry at that time, but at that time again I have bought it for a very, because whatever I purchase it with a very long term view.
Got it. I understood. All right, let me take this question to Samir on the fundamentals then. Borosil Renewables, would you hold on? It's doing quite well in trade today, Samir, but the longer term perspective, 5+ years?
So actually, it's a very good investment from a longer term perspective, right? Why? Because the solar space in India is only going to keep getting traction. We are working on Make in India. We are having panels made in India, and Borosil Renewable is making the glass that goes into a lot of these solar panels, right? Which covers this the top layer. Now that is a very key component for that business. So as we get more production of the solar panels made in India, the demand for the glass will keep increasing. Now, if you know, Borosil Renewable is going in for a capacity expansion or has already started it, and they should augment the capacity, I think, in the next 6 months. So once the capacity comes on, what you will see is the top line and the EBITDA and the margins start doing better. And that will lead to growth in profitability. The company did report a loss in the last couple of years, but I believe that is about to change. So hold on. I think the long term for the entire solar space is very good. Borosil is one of the key players when it comes to this glass manufacturing. I think they will do really well. Hold on.
That's the view coming in on Borosil Renewables. It's a hold from. Moving on to the next query. Next query is on Paytm, and Kavita from Bangalore is writing in. She has 51 shares of Paytm bought at 1,200 a piece. She's saying that now that the price is rising, she wants to know till what extent will my share value increase. Kush, I'll come to you for this one. What do you think should be the next target for Paytm, and what should be the stop loss as well?
So I think she's bought it at a fairly high price. I think she'll take heart from the fact that the stock has seen a stellar recovery from the lows that it had made around those 300, 350 mark. I think this one is a hold. Around 1,000, there is a rounding bottom formation on the weekly setup that gets completed, which means that once that is taken out, you will see further momentum on the upside come about. There could be a possibility that it might be a while before she sees her buying price achieve and then some profit. But with the kind of trajectory that there is and the moves that it has seen on the back of very strong volumes, Paytm is a very clear hold. I would suggest irrespective of her buying price right now, the targets of 1150, and once that is taken out, you're looking at a 1400 kind of a level as well. So continue to hold Paytm. It's got a strong trajectory above 1,000. The momentum might pick up even further.
All right, we'll take one more question on WhatsApp and then we'll go to our next caller. Satya, you called us, I know, from Hyderabad. Do stay with us. We'll come to you in just a minute. We've got Mamta joining in from Chennai, who's written in and is asking about NTPC Green. She's gotten an allotment in the IPO and the stock has been gaining quite substantially. In trade today, it's under a little bit of pressure, but put into context, and I would like you to pull up the weekly chart if you possibly can. All of this week, it has been absolutely buzzing, and we had actually a story on the website, ndtvprofit.com, that I would encourage you to read. Some part of it, can we pull up the weekly chart, please? Okay, so because that will give you a sense of why the stock has been up. It's 30% higher, and some part of that has to do with the free float in this counter. At least that is the analysis that we have here. Samir, just about 6.6% of free float, and in fact that might also be a little misleading because institutions have bought and are holding. So therefore, one would say that the demand is far outstripping the supply. Is that leading to this kind of a price movement, and would you book out right now?
So personally, I would book out. And you're right, there is a bit of a shortage of free float. Like you rightfully said, at the end of the day, it's a new issue. The people, the institutions that have just bought are not going to come out in a rush to sell because they bought it from a 3 to 5 year perspective. And why do I say that is because, look, like I discussed earlier when we were discussing Borosil Renewable, the growth opportunity in the entire renewable space, forget solar, in the entire renewable space is extremely large, and NTPC Green, which is setting up a lot of those capacities, will stand to benefit. Now, this is a business which requires a lot of upfront capital, and they have very low operating costs for running their business because it's at the end of the day using natural resources like the sun and the wind to generate the electricity. So their margins are going to be stellar. Now, given the fact that it will take them the next 5 years, 7 years to really gain significant capacity and start getting the profitability and the cash flows to start working for them really well, I think it's a long-term play. At 100, when the issue came about 110 was okay. We thought it was a little bit on the expensive side, given where they stand on the capacity, and of course valuations you can't compare because, like I said, the profits are yet to come. But I thought it was expensive then. So at this point, personally, I would not be a buyer. But if you have a 5-year horizon, you can probably stay put. But if you're a trader, I would say take your money off the table right now.
Okay, that's an interesting analysis coming on NTPC Green from Samir. We have our next caller, Akshita, who's calling from Hyderabad. Akshita, good morning. Thanks for calling. How can we help you?
Good morning. Actually, we have bought a Carbonum Universal at 1406 for 1000 shares. Should I keep it, hold, or sell?
Okay, what's the time horizon that you're looking for?
For medium term?
Can you define medium term for me?
Like 2 to 3 months or 6 months, yeah.
Okay, and how long ago did you buy this?
Like we bought 2 days back.
Okay, 2 days back. Kush, I'll come to you for this one. Carborundum is the stock. How does it look on charts? Kush, I believe you're on mute.
I'm sorry for that. Kind of a consolidative move with a mild negative bias. And what's happening is that around this 1400 to about 1460 odd mark, there is this congestion of all the key averages, 20-day, 50-day, 200-day, what all have you. So around that, you would find the stock perhaps resisting for some time. Now, the good thing is that there is a very good base formation around this 1350 to 1380 zone. So as long as that is held, the stock could consolidate, and any kind of an upswing beyond the 1450 mark will actually take it higher to 1520. So my view would be continue to hold because it's not too far from her buying price. So 1350 should be a very strict stop loss. If that is taken out, the stock could see further downside. With a stop loss of 1350 for a time horizon of 2 to 3 months, continue to hold. Momentum will be seen beyond 1450, and then the stock could very well head to 1525 kind of levels.
Okay, I'm coming back to you, Kush, on this next one. Avenue Supermarts, the stock is currently trading at 3,838. It's given up quite a bit of ground from September of this year, end of September, in that kind of drop that you saw. Broader markets as well losing ground, but quite a few frontline companies losing quite a bit of ground. This is a question coming from Vaibhav, and he's writing in from Bengaluru. He's bought at prices of 4,183, so losing quite a bit of ground as well. Would you hold on to this?
Alex, did you mention the time frame on this one?
Yeah, so he's looking to hold for the next 6 to 8 months.
Oh, 6 to 8 months, I think the stock could see a goodish kind of a recovery. I know the fall on this one has been very steep, but if you see, there's a very clear base formation near the 35.50 mark where the stock is now attempting rebounds. Also, on the way down, the volumes seem to be thinning out. So, there's a possibility that, the selling pressure might be abating now. The recovery and the delivery marking on certain days has been, very encouraging. From a perspective, or a time horizon of 3 to 6 months, you could continue to hold on to this one. There is a possibility here again that, this stock could once again move to his buying price, but may not move much beyond that because that's where the 50-day moving average resides, and there is also this gap resistance that might come in. So hold on, but there is a possibility that you may have to exit this one at cost and maybe not at a substantial profit.
Interesting. That's an interesting view coming in on Avenue Supermarts. Although fundamentally, Alex, we've seen that Avenue Supermarts is losing a lot of ground because of quick commerce and e-commerce. Yeah. But moving on, the next question is from Revati Gopal, who's from Pune. And I believe she has a question on Rashtriya Chemical Fertilizer. And I think she wants a fundamental view on this. So Samir, I'll come to you on this one. Do you have a view on this counter?
So not particular in RCF, but on the entire fertilizer space, I think, look, the opportunity is still quite good. The monsoons have been very good this year. So what you're going to see is the demand for fertilizers will continue to increase going throughout the year. Now, what you got to look at is where the valuations for many of these companies stand. And also one more thing that, look, the government is eventually going to ensure that they get some amount of subsidies and benefits to the farmers. So the demand for fertilizers, of course, is only going to keep increasing. I would look at where valuations for particular companies stand. Now, for example, PI Industries in a space is trading at much higher valuations compared to a stock like UPL, United Phosphorus. United Phosphorus is trading at about 10 times earnings. So personally, the way I look at it is I would like to buy companies that are trading at fair valuation. United Phosphorus, of course, has a global presence apart from India. That is something that will also benefit eventually over the longer term because of diversification of regions. So if ever there's a slowdown, You're getting it at a good price. The company is taking care of the problems that they have, which is the debt. They're selling part of Advanta. They are raising a QIP. So, they'll be able to repay almost 6,000 crores of debt, which will help the interest cost going down, which will obviously help the leverage plus the profitability increase automatically. We believe that is the right way to play. I don't have coverage on RCF, sorry.
Quick follow-up to that then, Samir. In terms of a turnaround for something like a UPL, do you anticipate that happening sometime in the next financial year?
I think the turnaround has already started to happen. What you're talking about is the profitability that has been a little affected because of the kind of dumping that has been happening from China. I get a feeling that will soon come to an end, especially after Donald Trump comes in and makes a lot of noise regarding, putting in customs duty on a few products here and there. And I get a feeling that what will eventually happen is that, look, the dumping that China has been doing will probably ease. And once that happens, UPL will turn around. I think the days for UPL, the worst for UPL is done. I think what you're going to see is a bit of consolidation before a run-up. So this is a great time to get in personally.
All right. Let me get across our next caller. We've got Raj from Kolkata joining in. Raj, good morning to you. And how can we help you today?
Good morning. Myself Raj from Kolkata.
Nice to speak to you, Raj, this morning. Thanks so much for calling NDTV Profit. How can we help you?
I am holding Mishtan Foods.
Okay.
At the rate of 14.85.
Okay.
5,000 shares.
Sorry.
I want to know the fundamental of this company.
Okay. So can you tell me the buy price?
I have already researched that, but I want to confirm from analyst.
Okay. Can you tell me the buy price, please?
My buy price is 13.85.
13.85. Okay. Since you've researched the company, can you tell me what drew you to it? As I can see, it is a basmati rice producer.
Basmati rice, and I think future they are making ethanol plant. I think so.
Understood. Okay, Raj. All right. Let me try and see if there's a coverage that Samir has. It's a pretty small company. It's actually just about 1,300 odd crore company. If not Mishtan, Samir, let me put it this way. If not Mishtan, then do you like any other rice companies that are currently available?
So the other rice company that we did look at in the past and we did track was LT Foods.
Yes.
But again, there the problem we face is the valuations have run up quite a bit. Of course, it's going through a bit of a consolidation now, but if you look at it, it's not cheap. At the end of the day, you're just buying rice, branding it and polishing it and selling it. So it's got to have some amount of competitive pressures which will come through. We don't believe that these high valuations are justifiable at this point of time. The other company in the space is Kohinoor Foods, where we have not been very optimistic in the past, but LT Foods was the one we like, but the valuations don't justify.
Right. I think what Raj mentioned is quite right, Alex. So it's a rice producer, but it's expanding into ethanol project, and they are targeting 1,000 kiloliters per day facility construction in Gujarat by FY26.
So this is part of the government's move to have
ethanol blending.
Yeah, but apart from sugar-based ethanol, right?
Yeah,
so you're talking about other grains and the feedstock that you get from that.
So since they already have something as a byproduct, they'll be probably using it for ethanol.
I'm actually curious. Okay. Samir, just to follow up on this, and Raj, hopefully this helps you out as well. Since he's intending to play that ethanol space, and traditionally over the last couple of years, people have looked at something like a Praj, not necessarily an ethanol maker itself, but somebody that facilitates that story. So would you rather play something like a Praj as opposed to someone like, what is it? Yeah, Mishtan Foods.
So Praj is something that people have already played, and if you see, the stock has run up quite significantly. Yes. It's captured in the expectation that over the next many years, a lot of ethanol plants will be put up for various different kind of commodities which you rightfully put up. So would I like to play something else? Yeah, I think that is the right way to play. But then you have companies in the sugar space that are already have those plants up and running, which are manufacturing the ethanol, which are supplying it to these companies for blending. So I would much rather invest in them. And so one of them I have is Ugar Sugar, which is a sugar company, but they've expanded a lot into the ethanol space. we believe that government push towards increased lending will only keep increasing. So as that keeps happening and prices move up, I think the operating profits for these companies will keep moving up. So that is one way. The other way is, of course, you can play it through the larger players like Balrampur Chini and Bajaj Hindustan, who have large ethanol blending capacities. And if ethanol blending picks up the way everyone is expecting to, I think they will stand to benefit the most, because on a small capacity, how much can you make as a profit versus what you can with these companies that already have these huge capacities set up and have basically the raw material, have everything in place to expand that business.
That absolutely makes sense, Sameer. The next question is from Karthik, who's from Hyderabad. He's holding 110 Zomato shares bought at 230 a piece, and he wants to know whether the share will cross the 350 mark by the end of April month next year. And he also wants to know, can he keep holding this from a longer term perspective, or probably sell it off once he achieves his target? Sameer, I'll again come to you for this one. And he's also saying whether he can buy more stocks in this particular space. So I believe he's asking whether he should also invest in Swiggy or not, because both of these stocks are seeing good gains today. So your view on both of these counters?
Okay, so first up, I'm a shareholder in Swiggy, and I'm quite positive on that over the longer term perspective. Why I like both the businesses, I'll tell you, is look, it's eventually a blue sky kind of situation. You have these huge markets in India which are still untapped for food delivery. You have these huge markets in India which are still only getting used to the quick commerce kind of space. At the moment, of course, quick commerce is not making money because there is a bit of discounting to ensure that they are able to get their clientele. But once they are on board, and once people find the ease in doing these businesses and the operations start turning profitable, the profits can go significantly. The problem I have with Zomato is that the valuations have already run up too much. So again, I am also a shareholder in Zomato, but at this point of time, I'm not looking to add. I'm in fact thinking whether I should convert some of my Zomato to Swiggy from this fact that the valuation of Zomato is moved up so much. But I mean, I'm just holding on because I already have Swiggy. But net, if you are a long-term investor, I think these companies can do really, really well over the next 5 years. Is it going to become 350 by April, Zomato? I mean, that is something I really can't comment on, because I mean, I wish I knew it was going to become 350. I'd sell everything else I have and just buy this, come back and
Yeah, I know that is a point, but then a simple question from my end then, would you still be a buy on Swiggy right now at this price?
I'd wait for a correction. It's again, it's the discount to Zomato is narrowing, but the discount is going to remain. Now, if I believe that Zomato also is overpriced, then I think Swiggy will also take a little bit longer. Look, at the end of the day, it's still making losses. They're setting up more of these dark stores all over, which will allow them to get the operating leverage, which will allow them to break into profits. They're targeting December 2025. Of course, as the losses keep coming down, maybe people will turn positive. But a lot of the positives that are expected by December 2025 are priced in at this point. So I would say wait for a correction in both of them if you want to add Zomato closer to 200 and Swiggy closer to maybe the issue price. I don't see that happening, but I would say at least if nothing else, maybe 400, 420.
Yeah, I mean, I guess the positives were priced in yesterday and it's up another 8% today. So I don't know whether you're going to get that price. But Sameer and Kush, to stay with us, we are going to take more questions on the other side of this very quick break. Unfortunately, we're going to have to keep some of you on hold. Do stay with us. We'll be back before you know it.
When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed. It is our job to bring you news that truly matters. At Profit 360, we cut through the clutter, the Wall Street deals, finance and policy news that could shape your tomorrow. The newsmakers, the trendsetters, and the innovators. In 30 minutes, we've got you covered. So stay ahead, stay informed, and stay profitable with Profit 360.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed. It is our job to bring you news that truly matters. At Profit 360, we cut through the clutter, the long street deals, finance and policy news that could shape your tomorrow. The newsmakers, the trendsetters, and the innovators. In 30 minutes, we've got you covered. So stay ahead, stay informed, and stay profitable with Profit 360.
Headlines you start your day with.
Welcome back. You're watching Ask Profit, a show where we answer all your stock-related questions, whether they're fundamental or technical. For viewers who are just tuning in, you can ask all your stock-related queries on the number that is flashing on your screen. You can call us on this number, or if you're not a caller, you can ask all your queries on the WhatsApp number that is flashing on your screen right now. And we have our next caller for the day. Narsimha from Hyderabad is calling us. Thank you for calling, Narsimha. How can we help you?
Hi. Thanks for taking my call. So I hold Gravita India. Hello?
I can please go ahead. Go ahead.
Yeah, Gravita India. Quantity is 1192.
Okay.
Investment price is 961.73.
Okay. How long ago did you buy this?
I want to understand.
Yeah.
Sorry?
How long ago did you buy this, and what's the rationale behind buying this?
I have been averaging it for last 4 years, and I want to hold it for long term, maybe 5-10 years. So, is this a good hold? How are the fundamentals?
All right, Samir, I'll come to you on this one. It's in a very interesting space, waste management, and it's something that an industry which is actually coming up now. Your view on Gravita India?
No, you're absolutely right. It's a very interesting space, and they have a good amount of capacity, and they're also adding on to capacity, which will allow them to grow their profitability. Given the fact that the world is moving more towards doing reusing of products, I think companies like Gravita will continue to do well. The problem simply, look, fundamentally, everything is great. Companies' profits will grow. Since the question was on fundamentals, the profits will continue to grow. The capacities will keep increasing. The leverage is not so bad. Decent management that we have running the business, all of that is great. Everything's in place. Where I find difficulty is valuation. Look, at the end of the day, this is a company that takes a certain amount of products that are going to get disposed, recycles it, and resells it in the market. It's basically a converter. When a converter is trading at 75 times trailing earnings and maybe 60 times forward earnings, difficult to justify. So I would not be in a rush to add on. If in fact anything, I would say take some profits off the table if the stock comes closer to the 1500 levels we had. The problem with that is that, when you book this profit, he's going to end up paying a short-term capital gains tax of about 150 rupees given his cost purchase price about 900. So then what ends up happening is he really doesn't make that much money, because even if he buys it back at 15, he's only made about 250, 300 rupees versus the government taking away 150. So hold on if you can. However, if you have something else you want to invest in, book some profits for the time being, because I think valuations are overdone.
Yeah, but based on FIFO, he would be long-term, I would think, Samir, on some of the stuff that he's bought, right, early on. So first in, first out would mean that if he's bought 4 years back, he would sell some bit of it. But maybe he should look at the post-tax implications of that and then decide. A couple of banking stocks, Bank of Maharashtra, one, and this is a question coming in all the way from the Windy City, Chicago. This is from Srini. He's writing in and asking about this. He's bought at levels of 100, and no, actually he's not given us a buy price. Let's pull up the stock and see where it's trading. So he's not given us a buy price. He's asking whether it can be accumulated. And the second one, I want to club with this. Kush, this one's for you. Both of these actually. This one's from Warangal in Telangana. Bhaskar is wondering whether Bank of Baroda should be exited if he's bought it at a price of 274.
Alex, just a quick 30 seconds on what Narasimha has done. He said he's averaged, and that's the kind of averaging that I like. If he said he's been averaging it for 4 years, which means his first purchase would have been somewhere around 100 rupees, and his average buy price is 961, which means he's averaging on the way up. By the way, this is also known as pyramiding. If any of your viewers want to look this up. So this is how you average. So I'm not against averaging, but I'm just against averaging on the downside. So kudos to Narasimha. Stellar purchase, and even better strategy to keep adding on when the stock has has kept going higher. So kudos to him on that. Now to come to the questions on Bank of Maharashtra first. The PSU pack is seeing a bit of a move up, correct? But for me right now, the preference does remain, with some of the larger private names. So HDFC, ICICI, these are some of the names that I would consider if I'm adding a fresh. I think the street is divided, but that's where my preference lies. On the way up, Bank of Maharashtra could see resistance around the 60, 62 mark, and it's fairly close to that. So I think any fresh purchases should be made once 62 is taken out. Now, as far as Bank of Baroda goes, very longish period of consolidation. In fact, the entire year has been spent in consolidation. Now there seems to be some traction picking up on this. So you should hold on to this one with a stop loss of, or rather a trailing stop loss of 235. On the way up, there's a good possibility that the stock could move to 275, and once that is taken out, 295 levels also. So a good move after almost a year of consolidation. I think you should hold on to this one and keep trailing your stop losses up until the levels of 295.
Okay, we've got the next caller. Oh, apologies.
No worries.
Sorry, we lost track of the anyway. Debashish Ghosh is calling us from Kolkata. Debashish, good morning to you. And how can we help you today?
I want to purchase CSC at this level for long investment. It is good or bad?
Okay. When you say long, how do you define that? Are you talking about more than a year, Debashish?
More than 5 years.
More than 5 years. Okay. So what about this company drew you to it? Why do you like CESC?
Yes.
Okay. So, all right. So you read about it. Let me go across to Samir on the fundamentals. So, Samir, have you studied CESC? Would you buy?
So yeah, we do have CESC that we do cover, and look, the power space is going to continue to do well, especially when it comes to the distribution of power, including the generation, which CESC does focus on to some extent. Now, where we believe that the risk lies again for them is, if you look at it, they're trading at a valuation higher than most. Barring the Adani Power, if you look at NTPC, if you look at some of the other private sector power generation and distribution companies, CESC is trading at a slightly higher valuation multiple. So that could be the risk. But apart from that, I think the growth opportunity, the story is quite good. One can make an investment. Small corrections, maybe 5-7% closer to 175, 180 levels would be a good purchasing price for that stock for a longer term view.
Right, so that's the view coming in on CESC. It's a buy from Samir on this counter. The next question is from Siva, and he's writing in to know about RIL, and he wants to know whether this is the right time to enter or not. Kush, your view as to how Reliance are faring out on charts at present?
Well, look, if you go by the near-term trend, you are going to be disappointed. But if you look at, how the stock has shaped up after seeing, the drubbing it has seen in the recent past and what it has done in the past, from the 200-day moving average, or rather, the 200-day weekly moving averages, it'll be quite encouraging. So from my perspective, if you've got a view anywhere from, let's say about, 6 months or longer, this is a good entry point. The returns on the upside could be fairly significant, at least for a big stock like Reliance. I am looking at levels of 1430, and once that is taken out, even 1575 as the targets for the next 6 to 12 months. So Reliance for me is a good purchase at this point. The risk reward ratio gets extremely favorable, and the stop loss for this one comes in at 1225, around the recent lows that the stock has made.
All right, we'll take the next question from Deepika. She's writing in from Hyderabad and she's bought a significant quantity of Vodafone Idea, 2,248 shares at an average price of 8 rupees 55 paise. The stock is currently at below that price, down about 5.4%. It's a high risk strategy, Samir. In the telecom space, you're buying something that is now effectively a penny stock that is controlling what, less than 18% of the telecom market, is facing problems in terms of retaining subscribers. Would you hold on to this?
Personally, no, I would not hold on to it. And I'll tell you why. But what you asked me the question, look, their market share is declining. They are limping along. They are struggling for funding. They're not being able to get the debt that they require for transitioning to 5G also. There's constant requirement of equity infusion by the promoters. When you have a situation like that, it becomes very difficult for them to deliver good ROEs, because what's happening is the equity base is continuously becoming bigger. And the more the equity size keeps becoming bigger, you need your profits to grow that much more to generate that ROE, right? That the return on equity that you want as an investor, which is going to be very difficult. Look, there are a lot of expectations that they will turn around, they will get this, they will get those benefits, government will convert their debt to equity, which will reduce the interest burden. I'm not denying any of that, but to service that equity is going to take a lot. They're not able to grow their market share, and that is going to be something that is very important. And we are constantly talking of risk of entry of the Starlink for telephones within India, which Elon Musk wants to bring. If something on that news comes, then I think Vodafone Idea is going to go through even more pressure. So for me, as an investor, I'm looking to invest to make money with a lower risk. Vodafone is a very high risk strategy, like you rightfully said. If something were to change drastically and they get some benefits from the government, blah, 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 and it turns around, yes, it can become 15, but that's not an investment I like to make.
Right, interesting take on Vodafone Idea, but quickly, Kush, your view on Vodafone Idea. Do you agree to Goldman Sachs target price of 2.4 for Vodafone?
Who am I to debate that? But my view is very clear and has been since the 16 levels, which is avoid Vodafone Idea at all costs. No matter what it does, the price doesn't seem to show any kind of a sustainable up move. So, I mean, who knows? But for me, Vodafone Idea is an avoid.
Right, we have our next caller. Murugan from Chennai is calling us. Murugan, thanks for calling in. How can we help you?
Good morning.
Murugan, unfortunately, your phone line is not very clear, Murugan. Hello? No, unfortunately, Murugan, your phone line is unclear and we can't make out what you're saying. Please ensure that you are in a place with network. We were just speaking about the telecom space. Let's talk about the next question. It is on, it's on Hitachi Energy, I believe. And, okay, this is Murugan's question. Okay, it's on Hitachi Energy. And he's bought so the buy price is 8,200. He's bought 37 shares and he's wondering whether to hold or exit. The stock is currently at 11,000 plus. All right, so close to 12,000. What would you do with this? Kush, on the charts, would you book some profits at this juncture?
Alex, I'd continue to hold. He's already sitting in a profit, which is a very good thing. The major trend, if you see, is actually quite positive. It's only along with the markets that the stock has actually started correcting. I mean, of course, it had gone into overbought territories and there were negative divergences. But, along with markets, it had started to come down. So the broad trajectory, if you see, is positive. Some profit booking was around the corner that has come about and the stock has very comfortably held above the 200-day moving average. So what I would do is I would place a trailing stop loss around that 11,000 or 10,900 zone, which is a medium-term support zone as well, incidentally, and also the 200-day moving average, resides there. So don't be in a hurry to sell. Even if you sell it, let's say about 700, 800 rupees lower from here, you'd still be in a profit. Plus, you're giving yourself that chance that the stock could regain, the higher levels of 14,000 and 16,000 that it had. So for me, Hitachi Energy is a hold. Stop loss comes in at 10,900.
It's a hold at present for Hitachi Energy. The next question is from Gauri, who's writing to us from Dubai. She's bought BSC Limited at 4,700 a piece and she wants to know whether she should keep holding it or exit at the current levels. The stock is currently trading at 5,021. So, Samir, I think let's get a fundamental view on this. Your view on BSC Limited?
So I like the businesses that these are, because these are very low capital. You know, it's like a platform kind of a business. Once you have the system in place and once you get the users to come on and the volumes keep increasing, the business profitability keeps increasing. BSE has seen a stellar run from 400 odd levels from a couple years ago to about 5,000. This is because, you know, they have been able to capture now almost 22% of the derivatives F&O volume. Look, the bulk of the F&O volumes happens in the exchange, in the indices, and 20% of that has now moved to BSE, which is a huge thing, because of which the operating leverage is playing out and the profitability is increasing. That apart, you know, the valuation of CDSL has moved up, which is a subsidiary. That stock of ICs, I mean, the clearing corporations being demerged and separated out, which could lead to some more value unlocking. And these are the things that are triggering the stock to run up. But simply put, these, you also got to remember, these are transactional businesses. And I've said this before on your channel as well. Any business that is transactional basis, where, you know, where things like right now are hunky-dory, where volumes are increasing continually because more and more people are investing in the market because it's become easy money. Then that changes, and when a bear market actually comes, it may not happen now, it may happen 6 months, 1 year, 2 years down. What you will see is that there'll be a drastic drop in the volumes. When that happens, the negative operating leverage starts playing out. So for me, valuations are very expensive. Company is great, business is great, but I'm expecting whenever the bear market hits the stock to have significant problems. So for me, I would sell out and take my profits and find something else which is more of a long-term growth story rather than a cyclical business which BSE could turn out to be.
Okay. If you are trying to call us, I want to tell you that we are shutting the phone lines right now because we've got 5 callers on wait. You can send us a message on that WhatsApp number, and towards the end of the show, what we'll do is we'll do a rapid fire round and we'll try and take as many questions as possible. Sriram from Chennai is calling us. Hi Sriram, good morning to you. I believe you've got a question for us on Coal India.
Yes, good morning, and I'm a repeated caller. And today, I really like both of the panel here, Push and Samir, my favorites. I've been listening a lot of good advice from them.
Glad to hear that.
My question is on Coal India. Considering the India's power demand is increasing, and I see the valuations are also good at this moment. I'm holding 500 shares of Coal India, which I bought recently. Should I buy more, considering the current level, and or go with the power grid? Both of them are equally dividend-paying stocks, and they are in the power sector.
That is an interesting question, certainly. Thanks so much, Sriram, for that. It seems that you've done your reading as well. Samir, so a nuanced view here, because Power Grid is a stock that has run up quite a bit. Coal India, not as much, 8% I think in the year to date. But as he's pointed out, he's just bought. We're talking about the outlook for thermal power not going anywhere. Despite the increase in renewable capacity, we're still going to be using thermal for some time. So would you hold on to Coal India?
So I don't think we are going to stop thermal capacity at all, totally. Eventually, look, this is renewable energy has certain limitations where power is only generated at particular hours when the wind is blowing or when the sun is shining. Whereas thermal power can be run all through the day, as and when demand and all is required. And I don't think solar and wind is going to be enough alone to take care of all the needs of India's power requirements as we keep moving towards electric vehicles, towards various other things. We are going to need various different kinds of energy sources. Now, Coal India is the largest producer of coal in India. I mean, the demand for which is only going to keep increasing. Like I said, apart from that, cement companies need coal. Steel companies need coal. So it's something that's only going to keep increasing. The problem where the difficulty for coal happens is the prices of that are obviously linked to how crude prices move. So if crude prices come down, that becomes that kind of has a negative impact on coal price, because at the end of the day, energy is used for generating power, and if one form of energy price comes down, then the other form obviously also follows suit. But we believe that the next few years, Coal India will continue to do well. Growth in volumes will happen. Prices are stable. Profitability is good. Dividends are decent. So from the next 2 to 3 years, I think it is interesting to maybe make an investment in Coal India. I would assume a target price of 550 would be a fair price 2 years down the road. So at that point, of course, we have to review the situation, but I would buy it right now and with a target price of 550.
Right, that's the view coming in on Coal India as well as Power Grid. We have our next caller, Vardhan, who's calling from Bengaluru. Vardhan, thanks for calling in. How can I help you?
Hi.
Hi, Varun.
I have a stocks of Tata Motors. I purchased at 780, and I have a quantity of 135. So how should I look at it? I mean, short term or long term? How should I go about it?
Okay, when did you purchase it and what was the rationale behind purchasing Tata Motors?
So I believe it has a great potential looking at the future and the kind of vehicles and EV investment that they have. So I believe it has a great potential. However, it is holding for long at 780 for the last 1 month. So I believe it might go up. And for that basis, I'm looking forward to, should I take a short-term benefit of 800 or 810, or should I wait for long-term to go up above 1000?
All right, point noted. Kush, I'll come to you on this one. Tata Motors on charts.
I think this is more of a tactical, opportunistic kind of a trade that he's made. The stock's actually seen a lot of dropping, now consolidating, with some sort of negative bias. I think, it's not a bad idea to continue holding on because, bulk of the selling that had to happen seems to be getting over. So with a stop loss of 760, continue to hold. I quite like the target that he's mentioned from a near-term perspective, which is 810. That is the first level of resistance. But I think he should continue holding once the stock gets past that as well, because beyond that, you're seeing a level of 850 come about. So this is more from a trading perspective. The risk-reward ratio is extremely favorable. With a 20-point stop loss for gains of about 60, 70 odd points. It's not a bad trade to make. So continue holding on to Tata Motors. 760 is the stop loss. Targets 810 and 850.
That's the view on Tata Motors, and I think a couple of other viewers also had a question on that, so hopefully this answers your question. Nagaraj from Andhra Pradesh is calling us. Nagaraj, good morning to you. And Graphite India, you bought at prices of 602. What is the perspective that you had that caused you to buy this?
I bought a Graphite India, sir. Price of 602.
Yes.
The number of shares 50.
Yes.
Shall I hold or sell, sir? Accumulate more, sir. Then I have no problem.
So you're looking for a short-term view on this?
Short-term, sir. Short-term.
Okay, short-term. So it's a trading view that he has. And remember, Graphite India usually moves in tandem with the outlook on steel from a fundamental basis. Also, as Mahima was just pointing out, China +1 plays into this entire theme. It's down as much as 6% in trade today, so under pressure. Kush, on the technicals though, would you hold on to this?
Alex, I would, for targets of the levels that it has achieved recently, which is 615, and once that is taken out, you're looking at 650 also on the higher side. Today's profit booking is not at all surprising because if you'll recall, the stock has actually had a vertical rise, a near vertical rise from 460 levels all the way up until the 610 mark in what about 8-10 odd sessions. So this profit booking was due and par for the course right now. Now support zone comes in at 545. That's my stop loss. If that is held, then the stock, after absorbing this profit booking, will start the second leg of up move. So as I said, 615. 610 and 650, those are the levels to wait for. May not be a very big profit, but there's a possibility that he could exit this one in a profit around that 650 mark.
All right, that's the view coming in on Graphite India. The next caller is Ravi Chandran from Chennai. Thanks for calling, Ravi Chandra. I believe you have a question on Mishra Dhatu.
Correct. I bought it at 88 or 89 during the IPO stage. So I'm still holding it. Though the company is in a niche area, the EPS and the bottom line and EPS, they are not very good. But is it advisable to add more at the current level for long term? Long term, I mean more than 5 years.
All right. I think kudos to the patience because you've been holding it since the IPO. Samir, I'll quickly come to you on this one. Should he add more at the current levels?
No, I don't think he should add more. If he wants to hold, he can. I find valuations again. Look, I'm not denying the fact that the defense space is going to do really well over the next many years, and Mishra Dhatu does focus on that. But simply put, buying a stock trading at about 72 times, I think, FY25 projections, and 60 times maybe FY26, it leaves very little room for margin of error for the company. So if for some reason order flow doesn't come to them and goes somewhere else because they've not been competitive in their pricing, for whatever reason, I'm not saying it will happen, I'm just saying it does happen, then the risk reward is quite unfavorable. So I would not be buying at this point. If he wants to hold on, continue to hold. Like I said, next 5 years will be good, but expect the stock to go through a period of consolidation before you expect any big move. And it could even go through a period of further downside. We've already seen a bit of downside, but I wouldn't be surprised if it moves down closer to 240 odd levels where maybe then valuations start looking a little better.
Okay. So we've got one more caller, but Praveen, we're running out of time, unfortunately. So I'm going to take your question at the start of the rapid fire. You want to know about Aster DM, which you bought at levels of 480. You've got a long-term perspective. Samir and Kush, quick answers, 2 minutes. We're throwing more questions at you. So would you hold on to Aster DM bought at levels of 480?
Yes, hold on.
All right, the next question is from Mahendra from Baroda. His question is on Welspun Living. Again, a long-term one. Samir, your view on this one?
Which one?
Welspun Living.
I don't have coverage, sorry.
Kush, quickly, then your view on Welspun Living?
Hold. Stop loss comes in about 155.
Okay, Samir, IDFC first bought at levels of 64. Would you hold?
Buy.
Okay, Utkarsh, that answers your question.
All right, Aadhar Housing is the next counter, bought at 444 level. Gopal Krishnan from Bangalore is writing in. Samir, your view on this one?
Book out of this one.
Okay. Lavish is asking about TD Power System. He wants a technical view. He's bought at levels of 455. Kush, would you hold?
Continue to hold. Consolidation, 415 is your target. May not see momentum, but continue to hold for stop loss of 415. Sorry, stop loss of 415.
All right. The next question is on Canara Bank shares purchased 15,000, bought at 108 is the average price. Kush, would you keep holding it or sell off?
No, I'd continue to hold. For me, the stop loss on this one comes in at 102.
Okay. Balaji Mines is the name of the counter. We've got Chandrasekhar asking, Samir, on the fundamentals, if you bought at level of 3,135, the stock is at just over 2,000. Would you hold?
I would buy more. Look, the long term is very good. They're setting up a new factory for certain chemicals, which are going to be an exclusive manufacturing in India, so buy.
Tejas Networks from a long-term perspective, good buy, Samir?
No coverage.
Kush, then your view on this one?
Buy.
Okay, the next one is on Paytm. We've already taken a view, I think, on the technicals, right? But on the fundamentals, would you hold if you bought at levels of 1,376, Samir?
I think one can hold on.
All right, CDSL is the next counter, bought 30 shares at 461 a piece. Long-term view, Samir?
At this point, at this price, I would look to book some profits. I think overvalued.
Okay. Hyundai Motor, would you hold on if you've gotten allotment in IPO? This is Awais who's asking from Nagpur, Samir.
Yeah, you can hold on.
Okay. IOB, 1,300 quantity bought at levels of 59. Sujata wants to know, would you hold, Kush?
Hold, stop loss at 55.
All right, that brings us to the end of the rapid fire round, and in fact, it brings us to the end of this show as well. Samir and Kush, thanks so much for joining in. We've answered quite a few questions, taken a lot of calls. Appreciate it.
Thank you.
All right, and that brings us to the end of this particular edition of Ask Profit from Mahima and myself and the team that put the show together. Thank you so much for watching. Do stay tuned. Lots more coming up on NDTV Profit.
When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed. It is our job to bring you news that truly matters. At Profit 360, we cut through the clutter, the Wall Street deals, finance and policy news that could shape your tomorrow. The newsmakers, the trendsetters, and the innovators. In 30 minutes, we've got you covered. So stay ahead, stay informed, and stay profitable with Profit 360.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed. It is our job to bring you news that truly matters. At Profit 360, we cut through the clutter, the Wall Street deals, finance and policy news that could shape your tomorrow. The newsmakers, the trendsetters, and the innovators. In 30 minutes, we've got you covered. So stay ahead, stay informed, and stay profitable with Profit 360.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed. It is our job to bring you news that truly matters. At Profit 360, we cut through the clutter. The Wall Street deals, finance and policy news that could shape your tomorrow. The newsmakers, the trendsetters,
Hello and welcome to KYC, a brand new show at NDTV Profit. In the fast-paced world of stock markets, investors are bombarded with information, but what they often lack is deep, comprehensive understanding of companies that they invest in. KYC, Know Your Company, is a show designed to give you regular investors a powerful, actionable insights into the fundamentals of a single NSE-listed company every day. Today we have with us on our radar, well, JSW Energy. Now, we do know about this company. It's been around for the longest times. It's also, in fact, changed gears considerably over the past 5 years and veered from thermal generation to renewables. Well, we do know that it has assets located across the board. If you consider, well, many states like Karnataka, and Maharashtra as well. But moving on in terms of the presence that it does have in thermal as well as renewable capacity, do remember that over the past 5 years, with the sharp pivot towards renewables, we now have renewable sector, in fact, contributing to, well, a significant amount, and now majority of the capacity is also from renewables. Thermal, of course, stands where it is. But even in terms of the planned added capacity, as you can see, the majority of the addition, or rather that which is under construction, is from solar, wind, and hydro and hybrid. Not so much for thermal, as you can see, which clearly gives you an idea about the plans that the company has on its anvil. Now, what we usually tend to do is that we take the performance of the company and we rate it on several parameters. So right at the top, what we do keep an eye on, as first is we talk about the income statement, the balance sheet. We also take a look at the return ratios and along with cash flows. And among the handful of other parameters which are also in focus, we have shareholding, street cred, as well as the dividend payout along with street coverage. And that should give you an idea about how the company is done, how the street looks at it, and we will rate the company based on all these parameters. So right at the top, let's start off by taking a look at the income statement. Now, as far as your revenue, your top line and your profitability is concerned, the company has done very well. So if you consider the last 3 years, it's seen a 18% CAGR for your revenue. We have an EBITDA growing at 23% CAGR. One might ask, why is it that the EBITDA has improved? That is solely because of their pivot towards, well, renewables, which is more cost efficient in general. And in fact, the company has seen an expansion of 370 basis points expansion in their EBITDA margins as well over the course of the last 3 years. So this certainly is going to be a thumbs up from my end, rather NDTV Profits end. But let's also take a look at the balance sheet. Now, if you just consider the first half of this financial year, what we have seen is a little bit of a reduction in debt. And while the company continues to put in a lot more in capital expenditure, the company has also, well, done what it can to keep debt levels at reasonable levels. And because of that, well, its gross debt, which stands at around 30,000 crores, if you consider cash in bank, your net debt will be sub that number. And if you consider the net worth of the company, that would in fact take your overall debt to equity to the mark of below 1. And that's always a positive as far as a capital intensive company like JSW Energy is concerned. So that's a thumbs up as well. What about return ratios? Now let's pull up and talk about how things are faring as far as your return on equity and return on capital is concerned. What we have seen is that over the course of the last 4 years, we have seen an improvement in these ratios. And fair enough, you have your return on equity, that is ROE, moving from 6.1% all the way to 8.7% in FY24. Similarly, your return on capital has also, largely been, range bound. But the reason why I'm still giving it a neutral and not a complete thumbs up is because an ideal return on equity ratio would be, about 15 to 20%. It's the same for a return capital as well. Sure, we must realize that, this is a capital intensive business, which is why your return ratios can be lower. But, as far as the street's concerned, this number, at least as far as JSW Energy specifically goes, the number could have been a better one, which is why I'm giving it a neutral, only because of the fact that we are in fact seeing improvement in return ratios. Moving on to cash flows, the company has actually done very well in terms of operating cash flows, especially given the fact that they are continuing to invest in a lot of the newer capacities. And if you consider what's happened in the last 4 years, cash flows have improved. Then this is cash flows from operations, which actually for FY24 stands at around a plus of 4,100 odd crores. So that's a thumbs up too. Then from there on, we talk about shareholding pattern. Now, we will realize that very clearly the company does have a scarcity premium. And the reason for that is the fact that nearly 70% of the company is held by promoters, but the balance maybe, about 24% is held by institutions. So DI is holding about 10%, but another 15% held by FIIs, which of course is that leaves not much with the public. So that means there's just about 6% left with public. And hence, because of this, it's a very, very tightly owned company, or as you can see on your screen there, which is why this is also a thumbs up. Now, perhaps let's talk about the most important thing, something that a lot of investors keep an eye on, and in terms of how the company has done over the course of the last many years. So firstly, in terms of the way its share price has moved, it's given you a return of 8.8 times over the last 5 years. So that's a tremendous jump, a tremendous, capital appreciation, wealth creation as far as investors are concerned. And even in terms of 1 year, we've seen a substantial jump in your share performance. What about its dividends? Has it been reasonable? Well, we've seen the dividend come out to a certain extent on a year-on-year basis, but we must remember that because the company is in a growth phase, we won't really be expecting too much dividend dole out anyways, which is why I'm not giving it a thumbs up or a thumbs down. I will stay neutral on this one, and hence just half a point instead of a 1 full one. And finally, coming down to street coverage. Now, this is where we have, again, in general, positive coverage. So if you consider the analyst ratings on, JSW Energy, we have about 6 buys, 4 holds, and 2 sells. And along with that, on a 12-month consensus return potential of around, 11%, which is also not terrible, and which is why I would give this one a thumbs up as well. So on all the 8 parameters that we have spoken about right now, how does the company fare well? So it's certainly a thumbs up for the income and balance sheet, return ratios, neutral, cash flows also positive. And in terms of the next set of parameters, we only have a neutral on dividend payment. Otherwise, shareholding, street cred, and street coverage are looking reasonably good. And if I give just half point for the 2 neutrals, that gives us a total score of 7 out of 8. So certainly not bad for a company of this stature. And with that, let's move on and talk about very quickly the SWOT analysis of the company as well. So if you consider the strengths, we do know that it has strong operations coming in. There's a strong pipeline as well with respect to, the agreements that it signs with various governments and a robust balance sheet. In terms of weakness, what we are seeing is, debt levels which have been increasing to a certain extent. But if you, this is perhaps a temporary phenomenon, as the management will point out in the conversation which just follows. Of course, return on assets has been slightly weak, but that's something that we've been talking about as well. In terms of opportunities, it has a strong capacity visibility of 14 gigawatts by FY27, and that certainly is going to be a big one for the company, which should continue to drive growth for the top line. In wind turbine manufacturing is again a big one. Let's not forget that the company has also entered into this energy storage segment. So that is another up-and-coming sector where the company is looking to take advantage of. Moving on to threats. Well, we have slow or delayed commissioning of some key projects, or that's not really come through so far, but that could potentially be a threat, and weaker than expected operational performance of assets, or as something which could also weigh down on, the operations of the company. So all in all, it's the company has done fairly well, and that's evident in the kind of price action that you've seen for the company as well. What can we do with the company? Well, we are going to try and get you an analyst, and if we do have, Manish Chaudhary, he's the head of research at Stocksbox, who joins us on the show. Manish, good afternoon. Thank you so much for joining in. Let's start off with your view on JSW Energy. How does it stand one by itself, and how do you rate it in comparison to some of its peers in the sector?
I think the first and foremost point, I think JSW Energy has a very strong parentage. So that comes to the mind, I think, first. Secondly, the pivot of JSW Energy and other companies in the power sector towards the renewable thing, I think it has a lot to do more with the cost economics of the solar and wind. I think at this point in time, the renewable cost economics is around 2.5 to 3 rupees per unit, vis-a-vis thermal, which comes around 4 rupees per unit. I think that is the main pivot where every company is trying to move towards the renewable space. And also, the time of commissioning of a renewable project is much faster as compared to a thermal plant. So as we see currently, with the capacity of JSW Energy standing at around 7.7 gigawatts odd, and they're trying to move it to 10 gigawatts by FY25, most of it coming from the renewable space. So I think they are better placed in terms of the quicker commissioning which would happen with the projects. Yes, there is some delay in few thermal power plants, but I think those issues could be sorted out. One more point which comes to mind is the streets was seemingly worried about the EBITDA performance in the second quarter. But my sense is that in the second quarter, mostly the power demand overall was very flattish. I think it stood around 435 billion units on a India level due to the heavy rainfall all around. So JSW Energy, the part of the power which is not under PPA and that's sold through the merchant tariff, there the revenues were impacted. So my sense is in the next 2 quarters, the demand would pick up and the impact which we saw in the second quarter due to the merchant tariffs would go by, and we would see strong financial performance also on the EBITDA level. The generation has been strong and it grew by around 14% YOY, both on the thermal as well as the renewable space. And I think with the commissioning of more projects, they should pick up. So overall, the outlook for the revenues and EBITDA with the kind of commissioning which is likely to come in the next 2 quarters, I think it's on track.
All right. Manish, let's talk about the sector, Jen. Then, how does JSW Energy stand with respect to perhaps a larger peer like NTPC? and perhaps also comparable to a certain extent to Tata Power too. In the preference matrix, how do these companies stack up for you?
I think the overhang with NTPC vis-a-vis JSW Energy, I would mostly give it to the execution. I think the street looks more confident about the execution capability of JSW Energy vis-a-vis NTPC, which comes with a baggage of the PSU tag. So in the order of preference, if I want to talk, I would rate JSW Energy as the first, second Tata Power, and third NTPC. Yeah.
Okay. Manish, very, very quickly, are you concerned about the valuations of JSW Energy?
I think, yes, if you look at the price to earning multiples of JSW's Energy at this point in time, it's hovering around somewhere around 50 times. So I think, yes, that's expensive. But I think I would give more preference to the kind of commissioning which is likely to happen and the kind of earnings growth which would come in the near future. So I think I would still be a buy on this counter despite some valuation discomfort at this point in time.
All right, point taken, Manish. Thank you so much for joining us and giving us your insight into this particular company. But now, as is the custom, let's shift focus and hear from the management itself. I earlier spoke to Sharad Mahendra, who is the joint MD and CEO of JSW Energy, who laid out the company's capacity utilization plans and the road ahead. Listen in.
If we talk of our current capacity as we are talking, the total operational capacity is close to 7.7 gigawatt, and out of which only about 47% is the thermal. Right. It is more than 50%, half of the capacity is in the renewable energy space, including the hydro as well as the solar and wind capacity.
Right.
And maybe as we have already informed earlier also, by the end of the current fiscal, by March 25, we will be reaching a capacity of 10 gigawatt with more than 60% of the capacity in the renewable space and slightly under 40% will be the thermal.
Right.
So our focus in last few years has been to increase our share in the renewable energy space.
Right.
And we have been moving in that direction. And beyond 10 gigawatt, as you asked for, we have an order pipeline of in excess of 9 gigawatt, and which is 100% renewable. Right. So we are on track of 9.2 gigawatt capacity addition beyond 10 gigawatt, and out of that 9.2, slightly under the 6 gigawatt, we have already signed the power purchase agreements with the utilities, and which are to be executed in 18 to 24 months timeline as per the PPA terms.
Right.
So that is the timelines we see for next 2 years from 10 gigawatt beyond March 25 to add another 5 to 6 gigawatt of capacity, taking us in maybe close to 16 gigawatt of total capacity in maybe 24 years from March 25.
Sure. Mr. Mahendra, you spoke about the addition in the renewable space as well, but will most of it be towards solar, or and how much of an extent will wind and perhaps some of the others will contribute?
See, a change in the trend, if we see the bidding space in the current year in first half or first 8 months, 9 months of the current fiscal, what we have seen is till last year we have been seeing majority of the bids coming in the plain vanilla solar or plain vanilla wind.
Right.
But this year there has been a significant shift that the utilities, the DISCOMs, the various states, they are looking for not just a power supply, but a solution-based supply.
Right.
Which is a mix. They came with first hybrid, which is a wind plus solar hybrids. Then it transformed to RTC renewable,
right,
which is certain maybe meeting 60%, 70% of the requirement on round-the-clock basis, which was coupled with wind plus solar plus battery energy storage.
Right.
And now seeing that the solar power addition which is happening, there is a sufficient availability which is happening during the daytime, but evening peak shortage is increasing.
Right.
During the peak hours. So this year we are seeing solar plus battery energy storage with discharge during the off-solar hours during the evening peak to take care of that demand deficit.
Sure.
So these are the various customized solutions. and also the FDRE, which is the firm dispatchable renewable energy on an hourly basis, based on the patterns of different states and utilities, what is their usage pattern, depending on, like if we see states like Maharashtra or Tamil Nadu, if we compare it with states like maybe Bihar or Jharkhand, here industrialization and the manufacturing portion in the overall economy is significantly higher in Maharashtra and Tamil Nadu. So their usage pattern as compared to states like Bihar, Jharkhand, where the manufacturing portion in the economy is significantly lower, is very different on an hourly basis.
Absolutely, yes.
So there is a solution base. Each utility will have a different requirement on an hourly basis. So those kind of FDRE bids also have been coming. So that is where we have been focusing more.
Mr. Mahendra, that actually leads me to the next question around, firstly, demand. What do you envisage from the nation and all the geographies that you are present in? And secondly, we have a lot of newer investors tuning into the show. So I also perhaps wanted a better idea of how the pricing mechanism works in the kind of contracts that you sign here.
Yeah. See, first, when we talk of demand, like last 3 years, if we see the demand has been growing at year on year, maybe 7.5 to 9% growth. This year, we have seen slight moderation in terms of the demand growth. Like November figures have just come, which is 5.14% demand growth year on year in November. But we see that we have to realize that first half of the year, in the current year, H1 has been exceptional in terms of the elections and other things, which definitely in terms of the investments, always see the capex also, the government spends also have been slightly lower in H1 as compared to last year.
Absolutely, yes.
So, but we are confident that the basic fundamentals remain strong for the country. And this growth rate, the economy growth will be there. And power plays a very significant role. So, but yes, assuming that a conservative estimate of 6% demand growth only, I'm not talking of 7.5 or 9.5, what we have witnessed. Which means in terms of energy requirement, what is the increased requirement year on year? If we say next 5 years, it will be a 6% year on year growth, which is conservative in my estimate, which means the country needs close to about 25 gigawatt of fresh capacity every year. Assuming 6 to 7 gigawatt or 8 gigawatt is coming from thermal. So balance leftover is about say 16, 17 gigawatt, and wind and solar, if we say, combined load factor of 30% only, not like thermal, which is at 70, 75%, which means we need 3 times the capacity of, even if we say 15 gigawatt. So 45 gigawatt of, 45 to 50 gigawatt of capacity addition is required in the country. And government also announced that 2 years back, that every year 50 gigawatt. And the first step last year was that the first time ever the bidding took place for 50 gigawatt. And in the current year also H1 in excess of 22 gigawatt bidding has taken place. So we see that this is the area where the focus is going to be there for us. And as you asked for that number of players entering into this space, and also the tariffs I will say that have stabilized. If we see last 6 to 8 months, barring 5 paisa, 10 paisa here or there from one bit to other. But I think the current levels of tariffs have stabilized. And we feel that this is not going to change significantly. Because the size of the cake is so big that anyone who comes, for everyone there is a space.
Absolutely.
So there is not going to be, we see that a bid war or anything to be unreasonable. What we witnessed, that famous Badla 2 rupees a few years back, that is not going to be the scenario is what we feel, and that is how we are preparing ourselves. We have prepared ourselves. In addition to that, as I told just some time back, that solution-based supply. So customized solution, that is where a lot of innovation, a lot of planning needs, a lot of engineering is required to provide a solution which is best for the buyer. So these are the areas we are focusing, and we are sure that the tariffs we feel will remain range bound only, not any significant change is what we see.
You know, Mr. Mahendra, keeping that in mind, and I was going through your cash flows as well, and your cash flows have improved, certainly have seen an improvement, but you do have a lot of capital expenditure which will come into play over the next few years. Based on that, I'm looking at your debt to equity ratio, which has come off to a certain extent for the quarter gone by, or rather the first half. But how does this play out now, considering your cash inflows, also the kind of debt levels at which you are currently, and the capital expenditure that you put forward?
See, when we see that at the current capacity levels, with the free cash which we are generating is in excess of 3,700 to 4,000 crores.
Right.
And also with reaching 10 gigawatt by March 25, the operational capacity, our free cash generation will further increase.
Right.
And also we know that this is a 3:1 debt equity business.
Right.
So if I have maybe 5,000 also only, so raising 15,000 is not at all a challenge.
Right.
So maybe 1.5 to $2 billion investment every year from the present cash flows is definitely not at all a challenge for us. So we feel, and also like the thermal assets which give a lot of good returns, that also we can deploy in increasing our capacities in the renewable energy space.
Right. And the kind of capital expenditure that you have earmarked over the next maybe 2 or 3 years, does that start to moderate after maybe 2 years down the line? Does it come off quite a bit because by then you have put in enough capacity? Or does that mean that it's going to potentially increase because you envisage a lot more demand to come through?
Yes, we see that the country, we all know that the 500 gigawatt of renewable energy by 2030, what the government of India has already announced, and that is on track, maybe a few gigawatt here or there. It is moving fast in that direction, and we see this as a huge opportunity.
Right.
And about 2.5 years back, when we announced our strategy 2.0 of reaching 20 gigawatt by 2030, and in the phase 1, 10 gigawatt by FY25, we are well on track of reaching 10 gigawatt as the phase 1 by end of the current fiscal.
Right.
So, and with the order pipeline of 9.2 gigawatt which we have, out of which more than 2/3 of the PPA is also signed.
Sure.
So we are quite confident that this 20 gigawatt which we had said earlier by 2030 will be happening significantly earlier.
Right.
So to accelerate this growth, maybe you may recall that in April of the current fiscal we had raised a QIP. Which has also enabled us to, it was just to accelerate our growth. Otherwise, we are comfortable with what free cash we are generating and what we had to go up to FY30.
Right.
So now to accelerate, this has also helped us. So that will not be a constraint with our strong balance sheet. Because industry, if you see the sector operates at a debt equity, maybe a 5.5 is a very comfortable number.
Sure.
Presently, if you see at the end of the H1, our debt to equity is at a rate at 4.1.
Right.
And if I remove the work in progress, which will start giving me the cash once the capacity gets commissioned, if I take the net debt to EBITDA, removing work in progress debt, then it is only at 2.2.
Right, much lower, yes.
Much lower. So this gives us a lot of cushion and headroom to accelerate our growth. So, and beyond 20 gigawatt, as we said, that will be happening significantly earlier. We will be continuing to take part in the country's growth.
Right.
And that is not the place where, at the time where we will like to slow down or stop.
All right, there you have it, the management of JSW Energy telling us about how things could potentially plan out over the course of the next 3 years. Strong demand is envisaged. Well, at least as far as the ratings of the company concerned, it's certainly a good one based on its past performance and what the street is making of it. But on that note, it's a wrap on this edition of, well, Know Your Company. Lots more lined up on the other side. Stay tuned to NDTV Profit.
When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed. It is our job to bring you news that truly matters. At Profit 360, we cut through the clutter, the long street deals, finance and policy news that could shape your tomorrow. The newsmakers, the trendsetters, and the innovators. In 30 minutes, we've got you covered. So stay ahead, stay informed, and stay profitable with Profit 360.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed. It is our job to bring you news that truly matters. At Profit 360, we cut through the clutter. The Long Street deals, finance and policy news that could shape your tomorrow. The newsmakers, the trendsetters, and the innovators. In 30 minutes, we've got you covered. So stay ahead, stay informed, and stay profitable with Profit 360.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed. It is our job to bring you news that truly matters. At Profit 360, we cut through the clutter. The Long Street deals, finance and policy news that could shape your tomorrow. The newsmakers, the trendsetters, and the innovators. In 30 minutes, we've got you covered. So stay ahead, stay informed, and stay profitable with Profit 360.
Headlines you start your day with. What matters worldwide?
Well, the bounce back in markets, but more importantly, I want to see two things. One, I want to see the contributors on the Nifty 50, and I also want to see the heat map of the Nifty 50. So the contributors, quick switch. You've seen Infosys, Reliance, ICICI Bank, TCS, Bharti, and HDFC Bank lead the pack now. In terms of points contributors, it's been a huge shift that we've seen. And even in terms of the heat map, we highlighted how just 10 stocks were gaining at the start of this show. Now you have 35 stocks gaining in comparison. The entire heat map has changed in a matter of exactly 30 minutes, and that's what's really standing out currently. But let's stick to the themes. Consumption is our next theme that we're going to discuss. There's obviously a note by CLSA on Juniper Hotels, where CLSA is positive. Anushi here to break that down, and we'll try to also understand from Avinash as to which pocket of consumption is the most interesting one. Anushi, first you.
Right. So, Harsh, if you look at a pretty strong target on Juniper Hotels, that is what we are seeing. Strong commentary on the part of CLSA. They've initiated an outperform rating with a target price of 430, which is 70% of an upside. So, a couple of reasons that they have stated. Firstly, the company is the largest owner of Hyatt Group affiliated hotels, with holding about a 19% of a market share here. And asset owners like JHL, you mentioned about the consumption pocket that's positioned to benefit from the current sector upcycle. Do remember that currently what is happening in the hotel and real estate sector, demand is currently outpacing the supply growth, and this is what we've been seeing in the last 2 to 3 years as well. And they expect this. Most of these hotel players that we've had a conversation with expect this cycle to last for another 3 years as we speak. So asset owners like JLH, that's Juniper Hotel, continue to remain on a stronger position. Now what they're also doing is expanding their operations through brownfield developments and acquisition. So they're estimating a 16% of an EBITDA CAGR over FY25 to 27 on these higher occupancy that we speak. And brownfield expansion, which you just spoke about, is expected to drive growth further beyond FY27 as well. So solid commentary coming on from CLSA, outperform rating and a target price of 430, which is a 17% upside.
Right. Thank you, Anushi, for that. Avinash, so the stock has corrected nearly 32% from its record high level of around 538 rupees. Now, your view on that?
I think, from a longer term perspective, I think definitely the stock looks pretty attractive, considering the fact that, the tailwinds in the hotel and tourism sector still continue to be quite solid. And this second half, typically from October to March is supposed to be a pickup quarter. So I won't be surprised that you could see better numbers for quarter three. Overall, I think, the hotel and hospitality market is growing quite rapidly. The supply crunch is still there. Average room, prices have also been moving up. So I think to that extent, I think clearly, as rightly pointed out, asset owners who have got nicely located, properties and pretty high occupancy level should definitely do well. So I think this is a play where, possibly one can, look at it from a consumption standpoint. But I think clearly, if one were to look at the short-term upside, maybe it may not come in. Maybe you could possibly have to wait for the next 12, 15 months. But numbers for FY25 and 26 are likely to be quite strong. So, these are stocks where I think you need to give in a lot of time and patience before, the story and the earnings actually play out fully.
Okay, time and patience. But I'm not just going to talk pure play consumption. I'm also going to talk about something like a PVR Inox. More media than consumption, but consumption nonetheless, because Pushpa 2, there's plenty of excitement. We spoke with Kamal Gyanchandani of PVR Inox Pictures, and he shared insights on the growing anticipation with regard to the film and the impressive pre-booking which has been pouring in. In fact, he calls it a record release. Listen into a slice of that.
We're seeing a lot of curiosity, a lot of excitement around the film. In fact, the advance sales, which opened about 3 days back, the response has been unprecedented. And by the way, this year has been a year in which we saw Kalki, which did massive performance at the box office, Three, which turned out to be another big film, Singham, Bhool Bhulaiya, all of these films. When I compare Pushpa's response to the films that I just spoke about, response is nothing short of unprecedented. And I think we are looking at not just the biggest grosser for this financial year. This could possibly be the biggest film that we've had in our business. So very excited, very thankful for the response, and eagerly looking forward to watching the film.
Avinash, two pointed questions. Lots of ways of playing the consumption. One is, of course, hotels. You answered that to a certain extent. But then there is QSR. There is your traditional FMCG, the HUL and the likes. You have shoe manufacturing companies. You have consumer durable companies. And you also have stocks like a Zomato and Swiggy, platform companies to play the consumer theme. How best do you suggest one plays the theme? And what's your key top 2 to 3 recommendations if one were to play the theme through the way you are suggesting one should play it?
I think, Harsh, two themes which we like is obviously the internet theme, Zomato, Swiggy, and the other one is the pure QSR plays, which are available in the market. After a very long time, we are seeing that, outdoor activity, that is a dine-out facility for most of the QSR players, has started improving. So within this space, we have been telling our clients to look at stocks like Devyani International, which is a part of the Varun Beverage, promoter group, and has been doing pretty well. I think the stock has been beaten down, but I think they have the KFC brand, and I think they have been doing pretty well. Very aggressive rollout expected over the next, say, 12 months. So here, I think one small allocation can be done. I think possibly FY25, 26 should be a good pickup year for them. And as far as the internet companies are concerned, we still continue to be positive on Zomato, because we feel that, the management of Zomato has now realized that they have to be profit focused. Blinkit is also now going to be soon profitable. And I think the demand not only from the urban markets as well as the metros, but even from tier 1, tier 2 cities has increased significantly. And I think here Zomato has a better lead compared to Swiggy. Swiggy came out with recent numbers, where they narrowed their quarterly losses. But I believe that from a like-to-like basis, Zomato could possibly give in a better risk reward, considering the fact that, here the management is tried and tested. And I think in the next, say, 2 to 3 years, we could see, a very strong kind of profit trajectory, because this space is not crowded, just 2 players. And I think obviously market looks at data points, rather than just looking at the narratives. In case of Swiggy, it is just the narrative which is playing out. The numbers have yet got to improve, in terms of cash flows, in terms of profit. So Zomato would be a good pick from this space. And obviously from the QSR space, Devyani International. I think from a longer term perspective, investors can definitely consider these two stocks.
Right. So Zomato and Devyani. Okay. So now let's shift our focus to Patanjali. Now we spoke to the CEO Sanjeev Asthana on the company's progress in the HPC business and more. Listen in to the slice of the conversation.
So the business is already integrated from November 1st this year. We are in the process of getting all the other systems sort of working. The sales continue, at full pace, and we are very confident that this integration will be successfully done. And we'll start reporting the results from this quarter onwards. And for this quarter, we'll get 2 months of results of HPC business as well.
Right. So with regards to the integration now, that's the home and the personal care business, which we call the HPC business, how much of a revenue that you're eyeing from here, which will come in the current financial year?
So look, the business last year was about 2,800 crores, a little less than that. And this year we'll get a full 5-month window on that. So we're anticipating that we should do close to about anywhere between 800 to 900 crores of business. And from next year, April 1st, 25 onwards, we should be fully onboarded. And we expect to grow that at 15% year on year. That's the target that we have.
Right. So initially, when we were talking about the HPC business with you as well, when you had got the notes, the idea was to garner around 1,100 to 1,100 odd crores, if I'm not mistaken, from HPC. So is this due to any delays that you've cut it down to 800 crores of the contribution that will come in, or am I missing something?
No, not at all. I think the only part is that, the early part of, the period, when we sort of acquire a business, there is some sort of adjustment time, that the lead time that is, that's already always there. So I'm not anticipating any slip ups or otherwise. I think 1st December onwards, we are fully on course. So the business typically does about 225 odd crores a month. We anticipate pretty much in the 5-month window, we should be very close to that number. It's just a conservative estimate that I gave you, that 800 to 900 crores is definitely given. And barring some changes, we could also hit that 1,100 crores, which you are pretty confident about.
Right. Moving on, another aspect that if you talk about FMCG companies as a whole that are striving with from an input cost perspective is the way palm oil prices have been panning out, right? Now, how are you looking at that segment? Because how does it benefit a company like yours, basically?
So there are two sort of paths to the oil palm. So one is that high oil palm prices are very beneficial for our oil palm plantation business. Basically, that works on the international prices, which are benchmarked, and based on that, we buy our fresh fruit bunches. So it is beneficial both for the farmers as well as for the company. That's one part. The second is that a business like ours, which typically operates on a long-only basis, which means that we are buying ahead of time and then selling. And if the prices tend to spike up, it is normally very beneficial to the company. But that is a one-off benefit. But longer term, we believe that the prices are going to stabilize, which they are right now. And the benefit which is accrued in this quarter, part of that will accrue in the next quarter as well. And then the market will stabilize itself at the new benchmark levels. So overall, but the problem statement here is, which is, for a lot of companies which are the FMCG space, this inflation also gets into the higher cost structures in business like biscuits, confectionery, wherever the oil palm usage is very high, including soaps and otherwise as well. So that part, the companies have to calibrate their strategy, their buying strategy on how they do. So two parts of it are very beneficial for the company. One part, we need to deal with it. We need to figure out a way of being more efficient. And that is what the company is working towards.
Right. So if you have to look at the revenue contribution that you get from palm oil plantations, right? Are you expecting that to increase as well? Because you've already expanded your cultivated land by over 5,200 hectares and you're aiming for almost 0.5 million hectares over the next 5 years. That will cover 60% of the palm oil requirement in the country. So what is the strategy going to be from here on, and how will it impact revenues and margins?
So it's very positive. Oil palm plantation as a specific business. Currently, we have about 80,000 hectares which are planted, of which nearly 30% of the area is between 0 and 3, which means we've got a fairly young plantation. Every year, we expect the EBITDA addition to our business of by almost 10% each year. And year 4 onwards, we expect a substantial uptick. So, for example, we made last year about close to 190 crores on the oil palm plantation. This should continue to increase at the pace of 10% year on year for 3 years. And every year when the new set of plantations start to fruit and they start to sort of get delivered to us, our margins will continue to increase. And longer term, the plan on 0.5 million hectares that the strategy is, it should give us more than 1.2 million tons of oil. It should be hugely beneficial for the company. And for the next 25 years, it could potentially give a margin profile of anywhere between 800 to 1,000 crores on almost a consistent basis for 25 years.
Okay. Moving from this portion, if you look at e-commerce and quick commerce trends, right? How are they auguring in terms of growth for you? Because 12% of FMCG volumes come from modern trade, e-commerce and quick commerce. Are there any plans to increase it further? And if yes, at what cost?
So currently, we have about 2% plus sale, which moves through quick commerce, e-commerce and D2C. We have stated that before, that we'd like this to be doubling over the next 2 years. So there's a full effort which is going on for our overall sale. We would like 4% of the revenues coming from e-commerce categories. And we'd like the current share of 6% of the modern trade to go up to 8%. So we should be 12% plus between e-commerce and modern trade. And that's a very stated intent that we have. There's a full work which is going on. Our presence on the social media, on the digital commerce platforms has increased substantially. We are deploying a serious amount of resources and money there. So we're pretty confident of meeting our objectives of doubling our e-commerce revenues.
Right. And how do you play the FMCG part of the business? Because that has been under pressure. Across categories, you're seeing pressure specifically from an urban perspective. Rural, probably there is some bit of a pickup that has come in. Rising costs again in terms of palm oil and wheat are hurting that business of yours, right? So how are you going to balance that out? I mean, in terms of FMCG as a business as well.
There are two parts to it. I mean, clearly there is a stress, we can witness. There's a slowdown in growth. It is not degrowing. There's a slowdown in growth in the urban consumption sort of basket. So the two, and rural, to the contrary, has been positive. So overall, a company which has got 60-40 share, I mean, we do 60 in urban areas and 40 in rural. So while it is supportive to rural, there is some sort of signs of, challenge that we see in urban areas. But there is an enormous amount of opportunity which the company has. Our reach today is, about 3 million outlets. So we are not saturated by any stretch of imagination. There's a lot of scope to improve through, as an omni-channel strategy which the company follows. So whether it is the general trade, modern trade and e-commerce, which I spoke about, so we are reasonably confident of achieving 10% growth in the foods FMCG space and about 15% in the HPC. And that is a stated intent with which the company is working. First half was a little more challenging. We're getting into the next half, which is, more sort of festive season. Winter months typically are very supportive to, a lot of our products. So we're pretty confident of, meeting that objective growth target that we've set for ourselves.
Okay. And when you talk about even the nutraceutical part of the business, your target still remains 100 to 125 crores for FY25 with a 25% margin? Or do you think it could probably outpace that as well, taking into consideration the pace at which it's growing?
Look, last quarter was, turnaround of the nutraceutical business. We made, 5 crore margin as well on that, on a very small base. So while margin is not significant, but in terms of the restated, sort of reoriented business in nutraceuticals, I think it's a great validation. So we are committed, to still maintain that pace of anywhere between 100 to 125 crores. I think the last quarter is going to be very critical for us in how it plays out. But the confidence is that 25% margin and base number of 100 crores and aggressive number of 125 crores, we should still be able to meet for the full year.
Right. Another.
Okay, so that's of course the conversation with Patanjali, but let's talk about the last theme which we are to discuss today. It's on the MPC actually. The MPC is underway, and the outcome is what everyone will be looking at, and that will come in tomorrow. Pallavi is here with what we can expect in terms of the outcome tomorrow. Will we see a rate cut finally? Pallavi.
Right, thanks a lot for that. Well, it promises to be an exciting MPC. The decision will be out tomorrow morning. Now, this is shortly after a bit of a GDP shocker. We saw GDP growth ease to a 7-quarter low, and this was at a time when we saw inflation for the month of October spike to over 6%. Let's remember the MPC's target is for plus or minus 2%, and the last print was well above that. Now, just for some perspective, let's start with what the consensus view is. Now, according to a Bloomberg poll of economists, of the 49 economists polled, just about 7 expect a rate cut of 25 basis points, with the balance expecting a status quo. Now, the benchmark lending rate or the repo rate is broadly expected to remain unchanged at 6.5%. But most economists do expect easier liquidity conditions, possibly by way of a CRR cut. Now, let's have a look at what some key voices are saying. Now, for instance, according to Citibank, elevated inflation does make a December rate cut unlikely, but there can be an explicit acknowledgement that growth has been slowing and that also needs support. Citi also believes that the RBI will consider a CRR cut as a step towards easing and also for loosening recent pressure on banking system liquidity, which we have seen. So that's Citibank's views coming in. On the other end, of course, we have those like Nomura who are actually out of consensus, but they do expect that because of the GDP shocker print that we have seen and a subdued forward inflation outlook, there can be chances of a 25 basis points rate cut this time itself. Let's look a little bit deeper at what's changed from the last policy to this. First up, of course, GDP growth. Like we've mentioned, it fell very significantly to 5.4%. That was for Q2. This was largely led by slower industrial GVA. We also saw private consumption as well as capex slow down. The lower than estimated growth has also prompted a whole host of economists to lower their expectations for the full year, which means that for the full year now, expectations are anywhere between 6 to 7%. Let's remember the RBI is at 7.2%, but it is very likely that it will revise its full year forecast as well. GVA, which strips out indirect taxes and subsidies, is estimated to have grown 5.6%. Now, coming to the next important print, inflation print, like we've mentioned, 5.6% was what we saw 6.2% on inflation last, but we are seeing some easing momentum in food prices, and that could be something that could provide comfort to the MPC as well, and it could expect lower prints going forward, but we can see a little bit of a rise in what is expected in terms of its inflation forecasts as well. So there again, chances of a revision.
Very interesting, because there's just so many moving parts, and a lot of this is looking forward, right, Pallavi, rather than looking back. While we've broken down data looking back, looking forward, it's going to be very interesting as to how the RBI is viewing this data. They looked at a growth print of roughly 7% in Q2. It came to at 5.4%. So clearly growth likely the priority. How they are going to express this is going to be extremely interesting. With regard to what Nomura feels, and that's the note that's dominated headlines for some bit of the morning. They expect a 25 basis point rate cut. That's completely against the consensus. They are expecting a 100 basis point rate cut in the first half calendar year 2025. So according to them, merits for that rate cut is that your in any case having a growth problem. Inflation is concentrated in certain pockets, and to be specific, they said that out of the 290 items within the inflation basket, 64% was below the 4% mark on a year-on-year basis where inflation is concerned. So it's it's the few goods and services which are basically pushing inflation higher. That's the first point they make. The second point they make is, why would the RBI not cut rates? Is because you will see rupee depreciation. Now, interesting point that Nomura makes is that the RBI has enough forex reserves to take care of that. So that again should not be the concern. The largest concern here for the RBI should be growth as per Nomura, and therefore the focus should completely be on growth, and therefore they are calling for a case where the repo should be cut by 100 basis points in the next 7 to 8 months. Whether that comes out or not, we'll have to wait and watch, but certainly making a healthy case on the Indian macro front, maybe not on the global. Let's also quickly talk about what possibly could be the impact in case of a CRR cut, because that is very likely. Liquidity is stretched and squeezed. What happens if there is a cut in the CRR? A cut in the CRR, firstly, and I'll talk names here. First, a 25 to 50 basis point cut in the CRR could provide NIM support. That's one. Second is it's positive for banks with a lower LCR, which is liquidity coverage ratio, and a higher LDR, which is a loan to deposit ratio. A 50 basis point cut in CRR will likely benefit the most some of the PSUs, PNB, SBI, BOB. Those are the three biggest beneficiaries of this. And of course, we'll have to wait for Q4. If a CRR cut of 50 basis points were to happen this time around, we'll have to wait for Q4 for this to translate, because it will come out only in the Q4 numbers. Operating profit will go up by a 2%, 1.5% and 1.2% as a result of this, because they are sitting on excess cash reserves which can be deployed in higher yielding products. Now you're seeing on the private banking side, the biggest beneficiary being Federal Bank. Then you have an HDFC Bank and an Axis Bank. All of these will gain anything around 0.8 to 1.2% in terms of tailwind to operating profit as a result of this. But will nullify as well, because you will at some point see a rate cut come through, and a rate cut will mean that yields for some of these banks will fall. As a result of that, a repo rate cut, biggest impact, again, you'll start off with Bank of Baroda. You'll see a 3.5% hit on net interest income as a result if a 50 basis point rate cut were to translate. Second, a Federal Bank will see a 4.5% NII dip as a result of this. An Axis Bank will see a 3.5%, and SBI will see nearly 2.8%. And a PNB and a Kotak also around 2.7 to 3.6%. But the larger hit will be the net worth, which is your last column, which is on that list. The net worth hit will be anything between 1.5 to 1% on the top 6 of these banks in terms of impact. So that's all of the impact which could happen as a result of a rate cut or a possible CRR cut. A rate cut could obviously also lead to real estate coming into focus. Some of the rate sensitives coming into focus, including NBFCs, will come into focus as well. But with that, of course, we'll have our eye on the MPC. It'll be interesting to see how tomorrow plays out. But for now, completely out of time on this edition of Hot Money. From Varsha, myself, everyone who puts the show together, thanks so much for watching. Stay tuned to NDTV Profit. More action on the other side.
When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed. It is our job to bring you news that truly matters. At Profit 360, we cut through the clutter. The Log Street deals, finance and policy news that could shape your tomorrow. The newsmakers, the trendsetters, and the innovators. In 30 minutes, we've got you covered. So stay ahead, stay informed and stay profitable with Profit 360.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed. It is our job to bring you news that truly matters. At Profit 360, we cut through the clutter, the long street deals, finance and policy news that could shape your tomorrow. The newsmakers, the trendsetters, and the innovators. In 30 minutes, we've got you covered. So stay ahead, stay informed, and stay profitable with Profit 360.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed. It is our job to bring you news that truly matters. At Profit 360, we cut through the clutter, the long street deals, finance and policy news that could shape your tomorrow. The newsmakers, the trendsetters, and the innovators. In 30 minutes, we've got you covered. So stay ahead, stay informed, and stay profitable with Profit 360.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and
markets trade higher, fueled by a sharp up move in the IT and financials. Most sectors trade in the green, with media index being the top laggard. Fadnavis returns as Maharashtra CM for the third time to take oaths today in Mumbai after Mahayuti's massive election victory. Zomato shares meanwhile rally to an all-time high. Bernstein analysis gives it an edge over Swiggy. All eyes on the RBI policy meet. RBI Governor Shaktikant Das to announce MPC's decision tomorrow amid rate cut speculations. Pushpa 2 hits theatres, but Hyderabad premiere sees tragedy with one death and a child injured. Welcome to NDTV Profit. You're watching Market IQ. My name is Rucha Sumaya, and we'll move on with how the markets are looking right now. Well, sharp up move in the markets is what we could see. Well, the market started with largely on a flat note, but then, as we can see on the chart, Nifty 50 up by almost a 0.5% in trade. Now let's look at the sectoral movers. Nifty IT, Nifty Banking Index is what is making the Nifty 50 trade in the green. But the top laggard being Nifty Realty, also pharma, media, energy is what are trading in the red. But let's look at the constituents which are driving the Nifty 50 index up. Well, up in the green, we have the likes of Titan, TCS, Adani Enterprises, almost up by 1.5% in trade. This is also followed by the likes of Bharti Airtel and HDFC Bank as well. But the constituents which are which are down in the red. We have Bajaj Auto down by about 2% in trade, SBI Life, Cipla, which is dragging the index down. Now, this comes after Bajaj Auto, wherein UBS said that Bajaj Auto might cut prices on the Freedom motorcycle, and this could mean potential downside to street estimates. But remember that this came in out yesterday, and since then Bajaj Auto has been trading down. But with that, this is the ongoing second day of RBI meeting, which will conclude tomorrow. And with that, let's have a look at the Nifty banking index. Well, the banking index is also being doing well in the trade, which is up by almost 0.5% in trade. Largely constituents are trading in the green. This is led by SBI, Kotak Mahindra Bank, Axis Bank, ICICI. All the top names in the green is what we could see, but names like PNB, Bandhan Bank, Fed and IDFC first down in the red, but not much, marginally down in the red. But let's move on to talk about the big IT sector. All the constituents in the green, and the up move is led by Persistent Systems and Infosys. Now remember that CLSA came out with a note wherein it has upgraded the target price for Persistent Systems and Persistent, Infosys, both. Persistent actually, it hit 52-week high, and Infosys almost near to its 52-week high is what we could see on our screens, up by almost 1.2% in trade is for Infosys. None of the constituents in the red. Nifty IT booming in trade. But let's shift our focus to telecom. Well, the big update over here, Vodafone Idea to sell its remainder 3% stake in Indus Towers. Both of these stocks, actually, Vodafone Idea and Indus Towers, opened 5% up during the start of the trade. But now, if you can look, if you can pull up the Vodafone Idea chart, we'll see that it has paired gains. Now it is down by about 6% in trade, and even Indus Towers very much in the green during the start, but again paired gains, just marginally up in the green is what we could see. But a few stocks which I want to highlight based on the news. Well, Suraj Estate is up by about 3% after it purchases land in Mumbai for 100 crore. Bharat Forge QIP launch of 1650 crore at 4% discount. Bharat Forge not doing really well, down a tad bit as we can see. Here we go. Followed by Ratnami Metals. Well, Nalanda sells 1.1% stake, though SBI MF picks up 1%. This stock is a tad above in the green. Lastly, let's look at the sectoral gain. Actually, let's look at the stocks which are buzzing, gaining stocks, FMCG stocks, very much in the green. Zomato, Swiggy, both hit all-time high. Zomato up by almost 4.5% in trade, as we can see. But Swiggy up by 9%, hit a high of almost about 9%. Swiggy doing really well since a couple of days now. Castrol India is the one stock which I want to highlight, which is doing really well since the last 3 to 4 days, up by 6% just in today's trade. Really good move in Castrol since last 4 to 5 days. But down in the red, we have names like Oil India, Sona, BLW, which are not doing really well. But let's shift our focus back. Well, we'll talk about banks. Banks are in focus as stage is all set for MPC outcome tomorrow. Harsh is joining now with us to tell us what Nomura is expecting. Well, it is expecting RBI to deliver rate cuts of 25 basis points. And what does this mean for the markets, Harsh?
Well, let's talk, of course, about what Nomura is saying, 25 basis point rate cut on the repo, and what that will mean on certain stocks. Citi has broken that down for us. But first off, I want to focus on CRR, because the cash reserve ratio is going to hold the key with regard to liquidity push within the system. And, you know, as per Citi, essentially, a CRR cut would entail at least some amount of support when it comes to margins for some of the banks. It's positive for banks with a lower LCR, which is a liquidity coverage ratio, and a higher LDR, which is loan to deposit ratio. So you'll have some of those banks benefit a little bit more than others. Let's pull up some banks where CRR is concerned, which will aid numbers. First off, the top three on the list are all PSUs, and that's likely also why we've seen that move on the PSU counters, PSU banking counters. PNB, SBI, BOB. any move on the CRR 50 basis points or more could well benefit some of these banks by 1 to 2% with regard to where their operating profit is concerned. So operating profit could see a jump of at least 1 to 2%. This is of course starting Q4 if it were to happen in this meeting, which is in December, because it will start to impact the numbers only post the operating or operationally reducing the CRR. So that's one. On the private banking side, Federal Bank, HDFC Bank, Axis Bank could be the three key beneficiaries in case of a CRR cut. And anything between 0.8 to 1.2% is what your operating profit would spike by as a result of a 50 basis point cut. Now, in terms of the repo, if the repo is cut by 50 basis points, you could see a mix of banks impacted, and here the impact will be adverse because you will start to see loan yields getting adjusted pretty much immediately. Bank of Baroda will be the first one impacted, 1.5% of net worth wiped off, 3.6% with regard to impact on net interest income. Federal Bank is the other one, 4.5% of NII as well as 1.3% of net worth. SBI, Axis, PNB and Kotak. So it's a mix of both private as well as public, and likely these are the banks which will get impacted.
Right, Harsh, thank you so much. As we can see, Nifty Banking Index pretty volatile trade today, but now seem to have been recovered from the initial losses. But let's shift our focus to Divi's Laboratories. Well, this stock is down about 3.5% in trade. One of the laggards on the BSE is what we could see. But why is that so? We have Varsha joining in with more details.
Right. Thanks, Rucha. So the news is the US Federal Circuit Court rejects Novartis' bid to block rival Entresto. Now, Entresto is a hard drug which is manufactured by an innovator company called Novartis, and Divi's makes API. So Divi's is a CDMO player for this company which makes API, that is the active ingredient of this product, to Novartis. Now, the news is, so few months back there was this news that the generic version of this drug will be so there's this company called MSN Pharmaceuticals which will come out with its generic version of this product, Entresto. Now, Novartis tried to stop MSN Pharmaceutical from selling a generic version of its drug, claiming that it violated their patent. However, the court ruled against Novartis because they couldn't prove that the MSN product used the same specific part of the drug's active ingredients that their patent protects. So now, the whole thing is the judge agreed with MSN and said Novartis didn't provide enough proof, and this is the reason we are seeing that Divi's is down, because Divi's CDMO contracts with Novartis for this drug contributed almost 8% to the total sales and 19% to its CDMO sales for FY24. Also, Citi actually has a different view on this. So a few days back, Citi came out with a report wherein they said that even if the generic version of this hard drug comes out, Divi's should not have a problem, because Divi's plays on this product with respect to volume. So Divi's is the only company which actually manufacture this product in a volume and has a large economies of scales, and Divi's is the only company which has a cost advantage when it comes to all the APIs that it sells. So even if generic version comes out, Divi's won't have problem according to Citi, because Divi's will be providing this API to all the generic companies. But Street has a different view, and so Street is expecting that if the generic version comes out, Divi's may lost its customer, or the sales for the Divi's may go down.
As we can look at the stock, well, the stock has given healthy returns, up more than 60% in last 1 year and up by about 35% in last 6 months. But let's shift focus to the two FMCG sector stocks which have hit fresh 52 weeks high. We have Zomato and Swiggy. Well, if we look at Zomato has given 5% returns in just today and about 13% returns in last 5 days. Well, Swiggy is up by almost 30% since its listing. But Bernstein has come out with the note comparing both these names and which stock should one have in their portfolio. We have Mahima joining in with more details of what the report says.
mentioned, Bernstein has preferred Zomato over Swiggy, and they've rated it outperform with a target price of 335. Now, overall, if we see the performance year on year, Zomato has outpaced Swiggy in terms of all its metrics. But sequentially, we've seen that Swiggy is kind of catching up even in terms of operational metrics. Now, in terms of the key highlights of the reports, in terms of comparing the two, Zomato has a wider city presence than that of Swiggy, and it also has a deeper penetration in tier 2 plus cities, which is kind of getting them higher monthly transacting user as well. So Zomato has an upper hand over here, but Swiggy has a higher frequency of users, as well as Swiggy has a higher stickier customer base than Zomato. Now, these two reasons are because Swiggy has one integrated app for all its services, whereas Zomato has 3 different apps for its quick commerce, food delivery, as well as the ticketing business. Now, in terms of the quick commerce, particularly Blinkit has 1.5 times higher monthly transaction users than Instamart. So here Zomato has an upper hand. And lastly, in terms of gross order value per restaurant, that is here again higher for Zomato, and we've seen that Swiggy has been losing its market share in the past few quarters as well. So this is the overall comparison for the two of them, and the overall summary of what the note is about.
Thanks for that, Mahima. But let's look at what kind of returns have Nifty 50 given. Up by almost 10% in last 6 months and 17% in last 1 year. But we'll move on to this IPO bound. IKS Health is facing oppression and mismanagement allegations. 2 shareholders of Rekha Jhunjhunwala backed company have filed petition in NCLT. Charu joins us with more details.
Hi, so what is happening here is that 2 shareholders collectively have filed a case before the National Company Law Tribunal of Mumbai, saying that they were basically excluded from the company's AGMs and a notice about these meetings were not sent to them. Now, these AGMs resultantly saw a resolution to have some financial approvals and appointment of an auditor, which is PwC. These shareholders, who have a total of 70,000 shares, that is 0.04% of shareholders, have gone up to the Company Law Tribunal, saying that the results of this AGM should be invalidated, and as an interim relief, these results should not be considered as long as the proceedings of this said case take place before the NCLT. However, on the other front, IKS has also filed a caveat before the NCLT and served it upon the shareholders' lawyers, saying that there should be no development in the case until they are given an opportunity to be heard. So let's see how this plays out. We have been told this information via case filings, filing receipt, and some sources in the know of the matter. So the case has not yet been heard or admitted, but let's see how the first hearing takes place and where it goes.
Right, so that's from the sources of NDTV Profit. But moving on to a market opinion now, as I mentioned, Nifty 50 gave around 8% return in last 6 months. So whether you should invest in the markets now or not, well, we spoke to Gautam Shah earlier today, who talked about the same and whether one should invest in the bull markets, and he gave his top pick. Listen in.
In bull markets, you don't work hard. I think chemicals has been a very complex basket. You know, it's had a lot of stop starts multiple times. It tries to do well, it tries to get into a trend, and then just falters and comes off. In fact, as we speak today, there are many chemical stocks which are near 52-week lows and very few names which are near 52-week highs. So I think it's a very complex trend. There is no real clarity that they will come back. There are few standalone names that we like. For example, a PI Industries or a Tirumala Chemicals, which we have backed in the last 3 to 6 months. But if I look at it as a sector as a whole, I don't think there is any great opportunity based on today's data. If things improve over the next 3 to 6 months, I will look at it, but I don't want to go that route. But the other sector which I like, and we've been pushing it for the last few months, is real estate. I think some of the top stocks there, whether it's a DLF or a Macrotech or a Oberoi Reality, wonderful chart, great story, and I think smart money is chasing it. Fundamentals are right up there. I think it could be one of the bigger winners along with metals over the next 6 to 12 months.
Along with metals, real estate is what Gautam Shah prefers. But let's shift focus to politics. Devendra Fadnavis is set to take oath as Maharashtra's Chief Minister today. Following his nomination by the BJP's core committee, this decision was made ahead of the party's Maharashtra legislature meet. Eknath Shinde, the former Maharashtra CM and Shiv Sena leader, has agreed to serve as Deputy CM under Fadnavis. Well, the Mahayuti government's swearing-in ceremony is set at 5 in the evening at Mumbai's Azad Maidan. We have brought you the details from the ground. Over to you, Radhika.
Arrangements have been put in place. It's going to be a historic grand oath-taking ceremony that's set to take place in Azad Maidan at 5:30 p.m. today. Immense security. We're talking about at least about 4,000 security personnel and of course 50,000 people expected to attend, including 2,000 dignitaries. Yes, Prime Minister Modi, Amit Shah, JP Nadda, Nirmala Sitharaman, of course Chief Ministers from several of the NDA states, including Nitish Kumar, Yogi Adityanath, of course, will be present, and even opposition leaders in Maharashtra, including Uddhav Thackeray and Sharad Pawar, have also been invited. Not sure whether they'll attend, but it is going to be a historic, epic oath-taking ceremony, considering it is after a long wait, and also considering the landmark win Mahayuti secured this time. We've seen all kinds of back and forth discussions, deliberation over the last few weeks, suspense building up over who the chief minister is, and now it is Devendra Fadnavis, the man of the moment, who will become the Chief Minister of Maharashtra for the third time. Eknath Shinde, who was not really ready to give up that post, ready to give up the post yesterday, also supporting Chief Ministership of Devendra Fadnavis, putting up a united front, putting up a we are together front, something that Mahayuti leaders have been showcasing in the last few weeks, despite differences and minor disputes over portfolio. So the next big question, as you said, is about Eknath Shinde. Most likely he will be the Deputy Chief Minister along with Ajit Pawar, but he's also vying for some important portfolios, including home and finance. Will Eknath Shinde secure the key portfolios that he wants? Because he is under pressure from his set of MLAs to get more in his bargain. He couldn't secure chief ministership post, but will he get home is something that remains to be seen. Key portfolios not yet decided. How many ministers will take oath apart from CM, DCMs? Not entirely sure. Maybe it's just the three of them who will be taking oath, and then more discussions and deliberations may happen as to who is going to get what. There is a tentative formula that has been worked out based on the winning numbers of all three parties. We're hearing that BJP may get 22 berths based on its winning numbers, and also NCP 9 and Eknath Shinde Sena to get 12 berths is what we are hearing. But a lot of deliberations and discussions going on as to who is going to get plum portfolios, and Eknath Shinde certainly playing hardball here because he wants the best for his MLAs and leaders, considering it is not a Sena leader who is going to be the chief minister this time around. But yes, grand oath-taking ceremony, Mahayuti showing an extremely united front, a very dignified front by all the three leaders, despite some bickering that had happened, and despite the suspense building up over chief ministerial and deputy chief ministerial position. But as they said, it's all is well that ends well, and our next chief minister is going to be Devendra Fadnavis, but portfolio discussions will be ongoing at least for the next few days.
Okay, well, thanks for that. But speaking at the Asocham event, Chief Economic Advisor Nageshwaran said that the corporate sector should move away from the word jugaad to make India buy the word for quality. Listen in.
The other thing for the corporate sector to focus on is that to make India a byword for quality. Several countries today which are held out as beacons of quality, such as Germany and Japan, etc., did have not so great reputations in the past, but they made the transition. India also has to make the transition, and for that we need to also abandon the recourse to the use of the word jugaad. I think it is like suboptimal approach.
Well, shifting our focus back, Man Industries is all set to add value to the steel pipe complex in Abu Dhabi, UAE, and in addition to Saudi Arabia facility, which is likely to be commissioned in July FY26. Well, we caught up with Ramesh Mansukhani, the chairman at Man Industries, about the impact of this new facility on their operating margins. Listen in.
Because of Saudi government growth, Saudi Vision 2030, is encouraging us to start the local production over there because they are discouraging the import, the pipes, particularly for the oil and gas sector. Normally, they do not want to approve any company out of Saudi. And it encouraged us last 1.5 years before we decided to go ahead. It took a little bit long time to take the land, power, equipment, etc. Now our plant is going in the full swing, and we are expecting to start the production mid of 2025. This is an integrated plant, will produce HSW pipe, LSW pipe, as well as to coating facility also over there, coating complex. And the total outlay we are expecting between 600 to 650 crore. The most of the money, some amount is borrowing and some amount by our internal accruals. So that is a plan to come down over there, and it is a reason also because the value addition products, local government, that is a compulsion for us to continue the market over there.
So you said that close to 650 crore.
650
so
crore,
what is the debt to equity ratio that you are looking at? And also now that only 6 months are remaining, what percentage has already been spent and what's remaining?
The equipment is already bought, land we already taken, development is going on, and you can say because of lot of LCs etc. over there, so total money how much is spent I cannot say, but I can say the work is pending for 6-7 months to start the production over there.
Okay.
Yeah.
And how much equity you have raised put into this?
Our company is planning to put 250 crore rupees.
Okay. And that is already raised. You are planning to.
Yeah, we have already that money with us only.
Okay.
And the bank commitment also there, and bank is supporting the project, and the project will be completed in 6 months.
Okay.
Yeah.
So you said that Saudi government has some basically hindrance as far as importing steel from other countries is concerned, and they have also put some anti-dumping duties. I think similar structure is being followed by other countries also, say in Europe and the US. So do you think this plant will help you to expand to other countries?
Yes, right now in Saudi 15% import duty is there, but apart from 15% import duty, they are discouraging a lot to import. So that is another problem. They will not give the order, they will not approve you if you do not have the local manufacturer. And this we encouraged by the Saudi government movement, 100% equity now allowed by the foreign company. The earlier it was the local partner compulsory, but as per the new policy of the government, now we are the 100% owner.
Okay.
Yeah, this is a plus point also. The local partners over there, it was compulsion earlier, which they have given the concession.
Well, that's from Mr. Mansukhani. Man Industries up by almost 3.5% in trade today. But that's all that we have on the show for now. From myself and the team who has put this show together, thank you very much for watching. Do stay tuned to NDTV Profit. Lots more action on the other side.
When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed. It is our job to bring you news that truly matters. At Profit 360, we cut through the clutter, the long street deals, finance and policy news that could shape your tomorrow. The newsmakers, the trendsetters, and the innovators. In 30 minutes, we've got you covered. So stay ahead, stay informed, and stay profitable with Profit 360.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed. It is our job to bring you news that truly matters. At Profit 360, we cut through the clutter. The Long Street deals, finance and policy news that could shape your tomorrow. The newsmakers, the trendsetters, and the innovators. In 30 minutes, we've got you covered. So stay ahead, stay informed, and stay profitable with Profit 360.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed. It is our job to bring you news that truly matters. At Profit 360, we cut through the clutter. The Long Street deals, finance and policy news that could shape your tomorrow. The newsmakers, the trendsetters, and the innovators. In 30 minutes, we've got you covered. So stay ahead, stay informed, and stay profitable with Profit 360.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed. It is our job to bring you news that truly matters. At Profit 360, we cut through the clutter. The Long Street deals, finance and policy news that...
Hi, thanks so much for joining in. You're watching the Mutual Fund Show on NDTV Profit, and my name is Alex Matthew. This show gets you actionable insight on everything mutual fund related, whether it comes to selecting the mutual funds that go into your portfolio or broader strategy. And in fact, the latter is what we're going to be talking about on today's program. It's been a bit of a theme this week. My colleague Neeraj has been speaking to chief executive officers of mutual funds and asking them how the construction of a portfolio should change, how strategy should change given everything that's happening on the global side as well as what is happening domestically as well. Of course, some aspects of that include the imminent start of a Trump presidency and how that will affect global trade and indeed India. Joining me in studio today is Ashish Somaiya, who is the Chief Executive Officer of White Oak Capital AMC. Ashish, thanks as always for taking the time, and thanks so much for coming to the studio.
Thank you. Thanks for having me.
So, you know, that saying, we live in interesting times, I don't think that has changed over the last several years, and that continues to be the case. But as we head into the next year, what are the key factors that you're paying attention to?
So, you know, I always tell clients and advisors that, you know, the risk is in your portfolio. The risk is not in the markets, right? It's very natural and very normal for everybody to look for risk in the markets. So, you know, everybody, like you rightly said, that, you know, something will change when the presidency in the US changes, correct? But unfortunately, it's very difficult to forecast, right? Like, I'll give you an example. Somebody was telling me, and you know, a lot of people say this, that when Mr. Trump becomes the president, then how will it be for China? Right? How will it be for geopolitics? So I asked the guy, are you the same person you were 4 years back?
That's a good question. And that certainly the answer is no.
Yeah. So our views change. And you know, we are ordinary people. I mean, you're talking about the American president, right? So his views change, his team changes, correct? And it's known that he's somebody who believes more in bilateralism and in deal making rather than multilateralism and, the world order and those kinds of things. So yeah, some things will change, but the reality is that we don't know what goes on in his mind and what goes on in Mr. Musk's mind. And, it's not possible to forecast, correct? So that's why I tell people that, everybody looks for risks in the markets and everybody looks for risks in a Trump presidency, whereas the risks are pretty much in your own portfolio. Right? So getting to the point, like why did I say this, is because if you see, forget all of this and look at client portfolios. I'll give you just a simple example. If you take the market cap, the equity market cap, you'll realize that in the last 15 years, on an average, large cap has been 70% of total market cap, right? Right now, large cap is 61 or 62%.
Yes.
And somewhere in 2013, large cap was 77 or 78% of total market cap. So now, Alex, if somebody says that, I'm a neutral investor, I'm not aggressive, I'm not conservative. So my large cap allocation should reflect market weights. If I'm a very aggressive guy, I'll have more money in small and mid cap. If I'm a very conservative guy, I have only large cap. But somewhere for a moderate guy, your portfolio allocation should reflect the broad market. And then you may be, some plus minus. But in the last 12 months, till 31st October, in 12 months, mutual fund investors put 3.5 lakh crores into pure equity funds.
Yes.
Take a wild guess how much of that was large cap.
I know that most of it was sectoral and thematic funds.
It's only 4% large cap. So if you add 50% of large and mid cap funds and 60% of flexi cap funds and 30% of multi cap funds, and you do all of that, you'll realize that less than 20% went into large cap funds. Like you rightly said, 40% or 50% went into thematic funds, and then a whole bunch into small cap, mid cap and stuff, right? So long story short is that, look, you and me can keep debating about Trump presidency, but if people are going to put all their money into micro cap, small cap and few themes like defense, PSU, energy and utility, then you know where the risk is. It's not in the presidency of US. The risk is already in your portfolios, right?
So then let me ask you this, Ashish Somaya, you as an investor, of course, you have your own risk profile and your own requirements for why you invest. But as you get into 2025, are you tweaking your portfolio in any way? Are you anticipating that certain things will change? Or have you already done that, expecting that things will change?
So, if you ask me, say, what I have been telling people and what I would do for my own portfolio also, is that, get the portfolio into the center of the market. Right? The market is very much 60-70% banking, financials, IT, consumer, healthcare and all these kinds of things. Like I already said, the market is pretty much 60-70% large cap, right? But what is happening is that people's portfolios have been getting allocated more and more into some corner, crack or crevice of the market where they think that they're going to get outsized return, right? And in the last 3 years, rightly or wrongly, in the last 3 years, that's worked for them. But like we spoke earlier, you have to shoot where the rabbit will be, right? Not, where it was. So I would tell people that bring the portfolio back into the center, meaning that, get a bit more neutral weight when it comes to the market. You're definitely underweight large cap. So rebalance in favor of large cap. You're definitely in all the hot sectors of the last 3 years, which were the high beta, cyclical, commodity, the conglomerates, and, the PSUs and stuff, right? In the last 5 years, the banking and IT index and say maybe consumer, they've underperformed Nifty. This defense, PSU, etc. has given 3 to 4x of Nifty. But if you see the last 3 to 6 months, the market has already reversed this. The darlings of the last 3 years are 20-25% down from the 52-week high.
Right.
And the non-consensus laggards or dogs, they are 20-25% up from their bottom. So it's not so much a market correction. The headline Nifty may be 7-8% down, but there is a violent rotation and there is a correction which is already played out. Look, the Nifty may not correct, but if your favorite sector is 20% down and the sector you're not even looking at is up 20%, it's a correction.
And for you, it's definitely your portfolio is going through something.
So I'm just saying that, for next year, before next year, I would just tell people to revisit their asset allocation in all forms and formats, whether it is large cap, mid cap, small cap, whether it is a sectoral balance, whether it is overexposure to equity. I think we've had a dream run. I'm not pessimistic about the upcoming year or so, But I just feel that, you can't keep playing a soccer game in the penalty area. I mean, for 70% of the time, you're passing the ball and it's the middle of the field. I mean, people have been in the penalty area for far too long.
That's a fair point. Speaking of rebalancing, this is actually a question that I'm asking more representatives of mutual funds, either from the actual management side, or of course you will also have a perspective on how the fund manages the money right now, what the strategy is right now. What is the BAF strategy right now? In that, is this tending more towards underweight on equity, more on fixed income? And the reason I'm asking, the context of course, is that today we had a brokerage saying we could see a cut in interest rates when the RBI Monetary Policy Committee's outcome of the meeting comes out tomorrow. Of course, that's way too near term. But directionally, we are heading into 2025 with the expectation that interest rates are going to come off. That's good for bond yields.
So, I think this is all a bit counterintuitive. Like, see, till now what is happening is we actually got less than anticipated earnings data.
Yeah.
We actually got, unexpected GDP numbers.
Yes.
Right. And the market is stoic or, Teflon coated.
Yeah.
Correct? And people are expecting that maybe some liquidity adjustment, but they don't expect RBI to cut rates. Now, how the market works is that if RBI cuts rates, people will think, oh, gosh, what do they know which we don't know?
Yeah.
So let's not jump to conclusions about any of this, right?
Sure.
I mean, if there is an equal chance, smart guys will say, oh, maybe it's worse than we thought. How come these guys have become dovish, right?
Yeah.
So all these macros are really tricky. Really tricky. It can cut both ways.
Sure.
Correct. You see, we spoke Trump presidency. In 2016, market was nervous Mr. Trump might win. In 2020, market was nervous Mr. Trump might lose. And now market is excited that he has won. So I don't give much credence to...
it's like reading tea leaves, is it?
Yeah, I mean, it's just market has moods, correct? So I would put it this way, that, even the monetary policy, I mean, it'll be good if they act on it. It's good if there is a change of stance. But I don't think that the market is running away in a hurry. Market has been on a tear for quite some time. You asked about balance advantage.
Yes.
So some parts of the market has been on a tear. But, look, funnily, if I look at Nifty, 5-year CAGR of Nifty is 15%.
Yes.
And 5-year EPS growth of Nifty is 16-17%. So why I said come back to large cap. Nifty on its own is not looking like it's crazy, because there are some components of Nifty which have given 2-3x return, and some parts of Nifty which are underperforming.
Yeah.
So when I say rebalancing, it's just that get to the cheaper parts of the market, get to relative value, and our balanced advantage fund is indicating 53-54% equity, which is not aggressive, but definitely we are not running away. So all of this is just about reducing risk in the portfolio, not entirely leaving the market. That's the point.
Because the Nifty 50 ultimately is less than the 5-year average at this juncture.
Yeah, exactly.
Interestingly, another aspect is the steadiness and continuity of investments. And I'm speaking to you about this because it was indeed White Oak Capital's study on SIPs and continuity of SIPs. Ultimately, that strategy has stood the test of time. You want to go through that?
Yeah, see, if you really see the whole learning, if you take the whole history, it's, let's say in March 2023, when we had that Silicon Valley Bank, Signature Bank, etc. Now, today, if you see, people are consistently investing 25,000-26,000 crores per month, right? We'll get November numbers, we'll see. But I can remind you that as recently as March 2023, if you go back and see the discussions, there were some signs of people stopping SIPs and people thinking, look, I'm contributing for 12 to 15 months or 2 years, and now, after 2 years, the value is negative. So every once in a while, these kind of things will come up. But ultimately, why do we do SIP? We do SIP because there will be a point in time when market will do something unpredictable and we need to invest at every level, correct? So, I think right now people have been very, very consistent. You are seeing consistently rising SIPs. You are not seeing failure rates or stoppages.
Yeah.
So this is great. But I think people need to keep that in mind if there are any eventualities which we don't know about. That's the key.
Okay. Last point, and I've spoken to your team about your multi-asset fund as well.
Yeah.
And it's an interesting take on the multi-asset fund. It's not conforming to what a lot of people are doing in the sense that it is diversified and truly diversified in that sense.
Yeah, it's a genuine,
Yeah, so what are the strategies that are being employed there that you can probably take through to the rest of an individual's portfolio if required?
See, I think one of the biggest mistakes which people make with multi-asset funds, everybody, advisors, AMCs, investors, generally, that's just my perspective, that a lot of people make this error, which is that they have some presuppositions of how an asset class will do.
Should do, yeah.
Correct?
Right.
That's not the point. I always compare asset allocation to chemistry, right? If you mix 2 or 3 different substances, it produces a 4th substance.
Yes.
The 4th substance doesn't look like any of the 3 which you put in as ingredients.
Yeah.
It may derive some properties from each, but when it combines all of those, it has a different life of its own. It looks very different.
Yes.
Correct? So that's how asset allocation is supposed to behave. So what happens is today, if, like say in our asset allocation fund, we didn't start with any presupposition that gold will do well or that we should have equity 65% because equity taxation.
Yes.
We didn't do any of that.
That wasn't the objective.
That was not the objective. We just started building it ground up, saying that, okay, if we want low volatility and we want something which will be an option for people who otherwise find it a struggle to put money in fixed income. See, there was a point in time people used to put 3-year money into corporate bond funds and gilt funds and so many of those things.
They don't do that anymore.
Right? Now they don't do it because it is fully taxed.
Yeah.
So you have to artificially construct an asset allocation such that it will give you the low volatility experience if you hold it for a couple of years, and it can give you acceptable rate of return. So then the allocation comes very different.
Yeah.
It comes like, more like 10 to 40% gold, 15 to 45% equity. So just take an example. Last 3 months, a lot of multi-asset funds have given negative return. We didn't give negative return.
Right.
In the month of October, BSE 500 was down 6.5%. Our return was positive. In the month of November, gold was down 3.5 to 4%, but our return was positive. So I'm not saying that you should assume it will give positive return every month, but I'm just saying that asset allocation should be viewed like chemistry. Right?
And it's downside protection.
Absolutely.
The last point that I want to raise with you is because you have the pulse again, and we are on the 5th of the month, we will soon have the numbers, but there were murmurs that said that, of course, October nothing happened, the numbers were spectacular. November, perhaps there was a little bit of selling. What was visible in the kind of trends that you saw?
So see, when you see the numbers, I would imagine, I won't be surprised if there is a reduced gross inflow number, but that should also be kept in mind. I actually counted there were only 18 working days in November.
Interesting.
Right? There was Diwali and the month started with weekend, and then there were 2-3 more holidays and it ended with a weekend and those kinds of things. So only 18 working days in November. Second thing, I don't see any sign of redemption. There was no such exaggerated, nothing unusual I observed, but yes, I did observe that the gross equity inflow might be
a little lower.
Yeah.
Interesting. But I think I'm curious because I also heard that the net number is not going to suffer too much.
Yeah, I mean, and I always insist that we should see gross number, redemption and net separately. So that because we know the actual, because each of those is a variable. Net is just, net, it doesn't say anything.
Ashish, thanks so much for joining me in studio. Pleasure speaking with you as always. Insightful conversation.
Thank you.
All right, let's move this conversation forward. In fact, Ruchi Sankhe, investment advisor at Infinity Advisors, joining me right now. Ruchi, thanks so much for taking the time. And I hope that you caught some part of the last conversation that we were having in the studio with Ashish. What kind of advice are you giving to your clients, to people that come to you for advice heading into the new year?
I guess, in terms of portfolio construction today, as we've seen, the mid cap and small cap segments have not really corrected much. Really, the large caps are the ones who have taken some correction. So we are currently really not basically underweight on the mid caps and the small caps and overweight on large caps. So the construction of the portfolios is happening accordingly. We're also, not wary with the kind of volatility that we've seen in the past. And so we are also trying to stagger in the flow of investments for our clients on the equity side. And as rightly Ashish was saying, there are many other funds that you can incorporate in the portfolio, which will give a little bit, in terms of riskiness, reduce the riskiness of the portfolio. So the alternative hybrid funds and multi-asset allocation funds have also come into play, and those are also being incorporated in portfolios as we stand today. So that's how we are looking at portfolio construction as we go in the new year. A little, safe and perhaps staggered over a longer period of time now.
Yeah, particularly because of what we saw post-August, right, Ruchi? Because I think a lot of portfolios that might have been aggressive at the start of the year have actually fared not too well. Have people come to you complaining, saying that, oh, we've seen significant drawdowns?
Yeah, so well, there are significant drawdowns, but many of the equity investors understand that these volatilities can be short-lived, and the way to evaluate this portfolio is really over a longer period of time. So it was not something that equity investors, when they get in, don't expect to see. Yes, there have been significant drawdowns, and that has concerned investors, but they are also here to stay. So they realize that this may not be a long-lasting kind of an impact on the portfolios. So staying invested is really important, and not taking any decisions at this point of time to withdraw is really important. That's how we work with our investors to ensure that they kind of stay patient and invested in the markets.
Ruchi, just zooming out a little bit and looking at everything that's happening across the globe, of course, you have a scenario in Europe which is not particularly great. You have political drama in parts of Asia. You have a Trump presidency that is in the offing. But at the same time, you have the data that is indicating that the US economy is performing better than some had anticipated at the start of the year. When you give your clients advice on how they should treat the international aspect of their portfolio, first of all, what percentage would you say is appropriate to have in a portfolio? And give me examples as to how you would have that inclusion. Would it be through passives?
So yes, a mix of both, Neeraj. We are doing some passives as well as some actives. Just to come back to your first question, the kind of proportion, it's usually between 5 to 10% on the international side. That's what we advocate. And, we've got the NASDAQ, Motilal Oswal NASDAQ ETF that we've used for investing in the international markets. Even the Franklin India Feeder Fund in the US markets, as well as some funds like the Parag Parikh Flexi Cap, which also have certain part of their portfolio invested in the international markets, is also a good way of accessing it. Of course, again, it goes without saying, given that these funds are treated as debt funds, it makes sense to hold these for a longer period of time. So we have been taking exposure more in the US and the international fund route through, let's say a Parag Parikh Flexi and the feeder funds. Those are the typical ways, but not more than 5-10% is what we've done. We have used the LRS funds as well for investing in the international markets, and that's a more efficient way to do so. So whatever additional that's required over and above the LRS that's been sent, these are the routes that are being used.
Yeah, interesting. I guess that's a topic for a conversation for another day. That LRS route is quite an interesting way to play global markets.
Oh, I'm sorry.
Yeah, no, certainly no. I'm saying that it's a conversation that we can have at length. May not be able to do it justice right now, but I'm saying from the perspective of the fixed income side of your portfolio, a lot of people have transitioned to using hybrid schemes to have that allocation because of the tax nature of it. But ultimately, we're talking at a time, Ruchi, when you could see an interest rate shift. You could see interest rates move down as early as this week, some might say. If not right now, then you're talking about early next year, where you're seeing interest rates going down. And so from that perspective, playing duration might actually be beneficial at this point. We've been saying this all of this year, but this is coming to a head finally. How are you advising your clients to play the fixed income side?
Yeah. Firstly, apologies, I called you Neeraj instead of Alex. I'm sorry about that. But more than that, yes, you're right. We are creating. See, the issue that has happened is because the tax advantage has completely gone away. And there is a big now difference. When you invest in a debt fund, you're actually paying taxes at marginal rates. Whereas when you do a hybrid fund, you end up paying similar to equity taxation, which is 12.5% at the end of 1 year. It eats away a lot of returns if you do it directly in the debt funds. Having said that, you're absolutely right. We are expecting interest rates to come off, and a certain part of exposure in the debt category can be taken through the gilt funds and the long tenor debt funds. And we are evaluating those as well, depending upon the client portfolios that are have debt exposure. A lot of investors are actually moving into hybrids and taking debt exposure through the hybrid category. But wherever we have debt exposure, corporates and long-term corporates and gilt funds are definitely being incorporated in the portfolios on the debt side.
Okay, let's jump to some of the questions, Ruchi, that we've got. The first one's from Vimal, and he is 50 years old. He's looking to invest in mutual funds for the purposes of his son's wedding. And he's asking for a suggestion on some funds. His period is, his investment horizon is 5 years. His target amount is about 25 to 30 lakhs. What would your suggestions be?
Yeah, I think as we've been speaking in the show all along, at this point of time, if he's starting to create a portfolio, some of the segments have really run up on the equity side. Obviously, I'd like to create a portfolio which is more, growth oriented, so that he can get returns in this portfolio. The investment horizon also 5 years is reasonably, decent in terms of investment. So you would have more equity. So I would create at least a 60 to 70% equity portfolio, and perhaps the balance 30 to 40% could be through a hybrid route of investing, where there may be debt exposure, so that there's a little bit stability to that portfolio, and he doesn't get caught up if there is extreme volatility in terms of withdrawals. But I would create more in the large cap segment, or even a flexi cap fund, where the fund manager is taking the decision as to how much to invest in large and mid cap segments rather than us doing so. So I would say it should be more large cap oriented, around 60 to 70% equity, and incorporated with some multi-asset, equity savings schemes and flexi cap funds. So that's how I would create it at this juncture. I would stay away from small cap and mid cap at this juncture, and really do it only through the flexi cap route.
Okay, Ruchi, you've named this categories. I'm not asking you to give recommendations, but the schemes that you like in these categories?
So in the flexi cap, obviously my all-time favorite has been Parag Parikh flexi cap, but the HDFC flexi cap has also been doing very well. So those two funds I like in the flexi cap. And HDFC flexi cap, of course, today would have only about a 46 to 47% exposure in large cap. So it is still more mid cap and small cap oriented. But that's a good way to take exposure in those segments rather than taking it directly. In the large cap side, actually, I like a Mirai Asset large cap. It has a quality bias, and it's growth at a reasonable price. I would consider a fund like that. I would also incorporate some index funds. So there are lower cost funds in terms of expense structure, which will give you Nifty link returns. So those would be more on the equity side. And on the equity saving side, I would incorporate something like an ICICI Pru savings fund, because that actually has a net long exposure of only between 15 to 20% in equity versus a 33%, which most equity savings funds have. So I would look at something like that to get more safety and more tax efficiency in the portfolio on the debt side.
Got it. All right, Ruchi, thanks so much for joining in. Pleasure having you on the program. And in fact, that brings us to the end of this edition of the Mutual Fund Show. Thanks so much for watching. Do stay tuned. This is NDTV Profit.
When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed. It is our job to bring you news that truly matters. At Profit 360, we cut through the clutter, the Wall Street deals, finance and policy news that could shape your tomorrow. The newsmakers, the trendsetters, and the innovators. In 30 minutes, we've got you covered. So stay ahead, stay informed, and stay profitable with Profit 360.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed. It is our job to bring you news that truly matters. At Profit 360, we cut through the clutter, the Wall Street deals, finance and policy news that could shape your tomorrow. The newsmakers, the trendsetters, and the innovators. In 30 minutes, we've got you covered. So stay ahead, stay informed, and stay profitable with Profit 360.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed. It is our...
Hello and welcome. Thanks for tuning into India Market Close here on NDTV Profit. I'm Harsh Saita. Quick check on where markets are at. We've had a very good day where the Nifty is concerned, and if you can pull up the intraday, of course 200 points higher, 0.8% up on the Nifty, just to mark that out. But that's how the intraday looks. We're at the day's high now, and just that 30 minutes of trade, which saw that very steep rise, almost 150 points in just those maybe 15 to 20 minute kind of patch of trade. Thereafter, we've just built on those gains, sitting now very pretty where the benchmark is concerned. The broader markets not looking this rosy. I'll come to that. There you go, that's the mid cap, 0.4% higher. We're not at the day's high there, but we're off the day's lows, so definitely a positive. The small cap index also 0.5% thereabouts higher. But let's first off zoom in on the Nifty 50 in terms of the heat map, because it's reversed sharply from midday today. We were just about 10 to 11 stocks in the positive. Now we are nearly 40 stocks in the positive, 39, in fact 11 in the negative currently. And look at some of the heavyweights packing a punch. There's Infi, there's TCS, Titan, of course, among the other names, but it's a pack which has done well, which is IT, and you can see some bit of Bajaj Finance and the financials as well dominating this row, along with the heavyweights, Reliance, ICICI, Kotak, all of those doing well. So the contributories, if we can pull that up, will likely look that way. Dominated by IT names, HDFC, of course, part of that pack, but Infi, TCS, and if we can just pull up the intraday chart on Infosys in particular, I just want to try and mark that out, because from the bottom we've seen a very healthy bounce, pretty much the same trajectory as the Nifty 50. That's how the graph is essentially looking. Let's pull up the heat map with regard to sectors as well, because sea change since midday again on this count as well. Little bit of tepidness on the realty index. Pharma too slightly negative in terms of its bias, but you look at the stronghold, IT as well as banks. You can pull up the Nifty Bank for us in terms of the chart. It's 0.6% higher, but within that as well, the Fin Nifty also participating 0.6%. But IT is definitely the sector of the day. That's the Nifty Bank chart. Again, the bounce very similar to what we saw on Infosys as well as on the Nifty 50. That's how the Nifty Bank is evolving. While it's even Steven in terms of the advances and declines, but the heavyweights are packing a punch on the advances side of things. Kotak, SBI, Axis, ICICI and HDFC. So the heaviest of the Nifty banking in terms of weights, all packing a punch on the green. Now, I want to quickly also zoom in on the BSE 500 companies in terms of gainers, losers. Those are some names which we will talk about today in trade as well. But let me quickly bring on board both Kush Bora from kushbora.com as well as Rajesh Palvia from Axis Securities. Going to break down the kind of move we've seen today. Kush, what a strong move today. What do you make of it?
Hi, Harsh. A very good afternoon. Hello,
Good
Rajesh.
afternoon.
Well, I think the buy on dips that we've been discussing for a couple of days has worked rather beautifully, hasn't it? Now, I think once past this 24,300 mark, which now seems like some distance away, also past this 24,500 mark, I think Nifty is headed for 24,800 and 25,000 kind of levels. We were a little concerned about the PCR being overbought at 1.3, which has now cooled off, had cooled off to 1.1, and now is in a fairly comfortable space. So I think even from that perspective, you can take heart from the fact that it's not really approached overheated territories despite the kind of recovery that we saw yesterday and the move that we saw today. So I think for me, Nifty is on a very firm footing. I will continue holding on to any long positions that I have for targets of 24,800 and 25,000.
Okay, Rajesh, your take on this one?
Good afternoon, Harsh. Good afternoon.
Very good afternoon to you, Rajesh.
So looking at the momentum, especially on the option expiry day, and now Nifty managed to surpass 24,500. So I think this really can extend, and the way short covering has triggered during the today's session, I think this really can extend to 25,000 level. So next target for Nifty, we are projecting towards 25,000 level. At this juncture, one can hold their long position with stop loss of 24,450. That's the stop loss. Target is 25,000 level. On the Bank Nifty also, very strong buying action we have witnessed in last couple of days. The way Bank Nifty is trading about 52,500, 53,500. I think if it's able to hold this level, I think we could see a new all-time high trajectory very soon for Bank Nifty, and possible really can extend to 54,000, 54,500 kind of level also, because large cap banks are also participating in this really. And since last couple of weeks, we have seen very strong buying action in most of the large cap banking space. And ahead of RBI policy, I think Bank Nifty is ready to, move further higher, and maybe we could see a new all-time high trajectory very soon for Bank Nifty.
Okay, so Bank Nifty is what you're betting on, Rajesh. Just a quick follow-on. Bank Nifty, you believe private sector banks or PSU banks? What will lead the charge?
Yeah, so it's both PSU and private bank both are looking attractive at this juncture. From private sector bank, HDFC Bank, ICICI Bank are looking very attractive, and the way these two stocks are showing strength on short to medium term structure, we believe that these two banks can take further lead from here onwards. And from PSU Bank, I think SBI is also at above near-term breakout level, and the way SBI is holding above 850 level, I think here also we could see really and the possible really can extend to 900, 920 kind of level for SBI also. So these three large cap banks are looking promising, and that's why it is giving us confidence that by the contribution of these three banks, Bank Nifty may attempt to give breakout to new all-time high trajectory also.
Right. Now, one sector that stood tall right from the get-go today, Kosh, is the Nifty IT. And what a move we've seen, especially among the large caps, Infosys, TCS. If you can pull up the constituents just for perspective. Kush, let me come to you. What can we expect from the IT index now going forward? 700-point move on the IT index today, 2% up both in Infy and TCS.
Well, I think new highs on the cards. If you see, there was this brief resistance around that 44,200 mark. That was seeming a little difficult to surpass. But now with the comeback of, as you said, the big boys Infy and TCS, there is a possibility that new highs are on the cards. The sector has been in favor, especially ever since President-elect Trump came into power. So I think from here on, the big boys will start playing major roles. But we still prefer the likes of persistent in the in the mid-tier also emphasis, that has been one stock that we've discussed time and again. So we'll have our eyes on some of these names. But between Infosys, TCS, and HCL Tech, if I were to rank, for me, HCL Tech is first. Then you've got TCS, and then I would rate Infosys. So that's the pecking order for me. Good to see some of these big names participating. So along with HCL Tech, I will have Persistent and Emphasis on my radar, from the tech space.
Very interesting. And Kush picks for this afternoon.
Two of them. Federal Bank is one of our picks. Has been for some time. We had previously discussed this for a target of 205. That has been easily surpassed. Today, the stock is consolidating with a mild negative bias, but overall the trajectory is very positive. So from a near-term perspective, you could look at targets of 219 and 222. On the downside, your stop losses at 212. Also from the chemical space, we are seeing some traction return to this space after a round of profit booking. So Sudarshan Chemical makes the cut. If you see the last 10 to 15 sessions, the days on which the stock has ended higher has seen a very interesting delivery markup opposed to the days when the stock was down and the volumes are very thin. So very clear signs of accumulation on this one. It could turn out to be a very good positional bet as well. But from a trading perspective, you could look at 1190 and 1250 as your targets. 1070 is where you place that stop loss.
And what about your picks, Rajesh?
So Harsh, first stock is Greaves Cotton. If we analyze on the monthly as well as on the weekly chart, after a long consolidation, now a stock managed to give breakout of its near-term consolidation range of multiple supply zone. The way stock has shown buying interest in today's session and the breakout on the daily chart is giving us confidence that this stock is now ready to again move back to its all-time high trajectory on a positional perspective. But for trading point of view, I think one can buy this stock for upside target of 220. Keep your stop loss around 194. The second stock is Cyient. This is the new entrant in the F&O segment. If we analyze on the Cyient, stock managed to give breakout of its previous swing high. Long build-up was there in the previous day also. Today, follow-up buying action is also taken place in this stock. We believe that this rally can extend and possible target towards 2040 we could see in the near-term perspective. One can buy with stop loss of 1925. And the third stock is CSC. Overall, long-term structure is bullish. We have seen some corrective move in the last couple of months. But again, the way stock managed to give breakout on the weekly chart of falling trend line, on the daily chart, stock has formed a rounding bottom sort of formation. The breakout is already there. So we believe that CSC may extend its gain. Possible target 205. One can keep stop loss around 185 to buy CSC also.
Very interesting. Switching and putting the spotlight now on consumer durables. There's an interesting note by Goldman Sachs. They're expecting the realty-driven demand for both electricals as well as durables to accelerate. Which stocks are set to benefit? Which ones do they believe one should avoid? Mahima here with all of those.
Right, Harsh. It's like you rightly mentioned, it's a very interesting note. But before I move on to the stocks, a bit of context as to what the note is actually talking about. As you rightly mentioned, they expect real estate-driven demand for electricals and durables to accelerate by FY26. And what they're saying is that premiumization will continue across categories. They expect above trends growth in these sectors, but below trend margins and ROEs. Now, in terms of the domestic manufacturing, they see increased domestic manufacturing in various categories. Now, coming down to stocks, for Voltas, they hold a sell rating with a target price of 1500. So, it's a downside of 9%. They expect air conditioners demand momentum to continue. However, demand to sustain, they also expect that demand will sustain due to a higher base. But Voltas valuation pricing is optimistic in terms of growth. The next one is Crompton Greaves Consumer Electricals. They've given a buy rating with a target price of 500. So this poses a 20% upside for the stock, and the Crompton stock, what they're saying is highly leveraged to real estate upcycle, and the risk reward right now for this particular stock looks attractive according to Goldman Sachs. Havells India is the next counter, where they've given a target price of 1990 with an upside of 16%. They're saying that it has the most diversified portfolio, and premiumizing will also benefit the uptick in real estate for this particular counter. Lastly, Symphony Limited is rated neutral by Goldman Sachs and given a target price of 1480. This poses an upside of around 11% for the stock. What they're saying is they're neutral on Symphony because it's a very weather-dependent company, as well as the international outlook right now for the company is a bit uncertain, which is why they're neutral on Symphony. So these are the 4 stocks that they've given their view on in the consumer durable space, and this is what the note is all about.
Interesting. Any views on any of these counters, Kush?
So I think Havells is perhaps making a good comeback on the back of short covering. It had a massive drubbing for some time now, but if you see it's made a good base. It's trying to recover and it's resisting near that 200-day moving average. So I think once that is passed, 1750, 1760 zone, then I think there's a good clear run up until 1870 and 1920 kind of levels also positionally. So Havells is making a bit of a good comeback. So I'll have that on my radar. I'm not sure if this was discussed, but Titan also seems to be recovering quite smartly. It's broken above some of the downward sloping channels and trend lines. So Titan is something that I will have on my radar from the consumer durable space.
Okay, we're also joined by Vineet Bulinchkar. This afternoon. Thanks, Vineet, for joining in. I wonder, I'm not sure if he, of course, head of research, Ventura Securities. But Vineet, this Goldman Sachs note on consumer durables, they're expecting real estate demand to drive growth both in electricals as well as durables. Don't like Voltus as much, but they like Crompton Greaves, Havells. I'm not sure if you heard that entire thesis which Mahima put out. But any of these stocks, and what's your take with regard to this entire space and sector?
So, I think Polycab and Crompton Greaves are very well positioned to do well from these. Havells definitely is also a beneficiary. But, I'll go more with Crompton Greaves than with Havells because Havells historically has seen a very choppy period. And if you do a DCF valuation, you will find that, there is a 25% downside. But, this stock has defied cash flow valuations. And, the expected PE multiple for this entire sector also applies to Havells. And on a 2-year forward basis, it comes out to about 45 PE while the entire sector is going at 60-65 multiple. So Havells, to that extent, on a relative valuation basis, becomes a reasonable buy. But I am not comfortable with this stock because as I told you, the cash flows do not justify these valuations. So we will go with Crompton Greaves and also with Polycab.
Polycab, you're comfortable with regard to valuations, Vineet, because trading at 60 times plus, trailing 12 months, but 60 times plus.
So I think Crompton is much more, we are more comfortable.
Okay.
Crompton.
Yeah, take your point. Okay, fine. Let's quickly move on. We have, of course, another brokerage note which we've spoken about pretty much through the day. CLSA outperform on Juniper Hotels. Their target price indicating roughly a 17% odd upside. Anushi joins us with the rationale on that one. Anushi, interesting one because the hotel space and initiating coverage note coming from CLSA on a smaller kind of a name.
Yeah, it's definitely an interesting note that has come from CLSA, wherein we are seeing a 17% upside, as you mentioned. Now, a couple of factors as to why they've given this outperform rating. First is company is the largest owner. Just for context, it's the largest owner of Hyatt Group affiliated hotels with a 19% of a market share here. What it essentially means, it's asset owner positioning, which is expected to benefit from the sector upcycle that is going on in the hospitality space. If we look at the last 2-3 years for context, demand has clearly outpaced supply, which is leading to this growth for not just these asset developers, but even the companies which are in the management space as well. So that is one factor that one should be watching out for. Other than that, they're also expanding their operations, and this they're making through brownfield investments and also other acquisitions. So they are estimating a 16% of an EBITDA CAGR growth over FY25 to 27 on these higher acquisitions as we speak. And FY27, beyond FY27, what is the bigger picture which is driving the growth? Is of course the brownfield expansions that are taking place today. So these are a couple of sectors, a couple of points that we should be watching out with the growth in the hospitality space that we are seeing. for Juniper Hotels, and thus the 17% of an upside that the CLS has given.
Rajesh, any of the hotels on your list of stocks which you'd want to look out for?
I think Indian hotel always comes first when we discuss on the hotel industry. I think the way Indian hotel has delivered, a rally in last couple of months. I think the way stock is holding the ground at across all time frame, stock is almost at all-time high trajectory. I think this hotel can continue furthermore upside. Possible target on a positional perspective, we could see towards 900 to 950 kind of level. A very strong buying action in this stock in last couple of months, and we believe that one should use any minor decline to be used as a buying opportunity. Our positional target is 900 to 920. On the downside, 765 should be used as a stop loss for the holding this position. Again, on the hotel pack, if we analyze that, GVK is also looking very attractive. The way stock managed to give breakout on daily, weekly time frame, I think here also we could see further more traction. Possible target towards 390 to 410 we can see in near term to short term perspective. So Taj GVK is also looking promising with stop loss of 345. And again, some of the hotel, like, as mentioned in the, commentary, like Juniper, that stock has also, after correction, managed to give breakout on the weekly chart. Falling trend line breakout is already happened in Juniper also. And now if his stocks continues to hold above 370, there is a possibility of further more buying action to initiate in this counter, and then possible target towards 420 to 430 we can see. So Juniper is also one can buy with stop loss of 370.
Sure. Vineet, it's the one sector which hasn't done much over the last 6 to 8 months. Of course, Indian Hotels has done very, very well. But outside of that, really large cap stock, we've seen a slightly tepid performance after the rally that we've seen over the last couple of years. Is this a good entry point? And if so, where would your bets lie within this? There are not too many names to talk about, but out of the few that we have, something like Chalet, Lemon Tree, Juniper, EIH, Indian Hotels, I think these are 5-6 top names.
So I think Chalet has clearly got a 20% upside from what we think about that stock can really do well. I think EIH could be one play which can grow aggressively because, they have got properties which are absolutely premium. And once the operating leverage plays out, these companies do really, really well. So I think I would not be surprised if EIH goes up by another 30 to 40% from current levels.
Okay, so bullish on EIH. Let's switch focus there from hotels, hospitality to pharma. Divi's Labs in focus, stock trades under pressure. Novartis failed to establish the difference with regard to their patent infringement suit. And Varsha obviously here to give us context. Divi's supplies to Novartis and therefore the impact on the stock. Varsha, give us perspective. Also, tell us about the fact that you also seem to suggest that there could be some bit of positive trigger as well possible where Divi's is concerned.
Yes, Harsh. So I'll just start with the news. So the news is that US federal court have rejected Novartis' bid to block its rival drug, that is Entresto. Now the whole point revolves around one product, which is a hard product named Entresto, which is manufactured by an innovator company, Novartis, to which Divi supplies API of this drug to Novartis. Now, there was this news few months back that MSN Pharmaceutical is going to come up with a generic version of this hard drug called Entresto, which will actually, so this can be a negative for Novartis, and in turn negative for Divi's. So the Novartis tried to stop MSN Pharmaceutical from selling the generic version of this product, claiming that it violated its patent. However, the court ruled against Novartis because they couldn't prove that the MSN product used the same specific form of active ingredients that their patent protects. Hence, the judge agreed with MSN and said that Novartis didn't provide enough proof. Now, Divi's as a CDMO player of the Novartis of this product contributed almost 8% to the overall sales of Divi's in FY24 and 19% to the CDMO sales of Divi's for FY24. But you know, Harsh, maybe Street is taking it in a negative way, but Citi sometimes back said that even if the generic version comes out, Divi's should not have a problem because Divi's manufacture this product at a large scale and at a large volume, and Divi's is the only player that has a cost competitive advantage. And if the generic version comes out, Divi's will be the sole supplier for this generic version as well. And Divi's also came out with a clarification that there is no material impact of this news that has been floating around to the company.
Right, thanks so much for that, Varsha. Vineet, let me come to you on this one. Divi's known to overcome challenges coming their way. It's a company which is seasoned to do this time and again. Do you think that they will be able to overcome this bit of speed bump? 3% knock on the stock as well. And in terms of relative valuation, the stock has already seen a very strong rally. You believe value here?
I think the stock can move sideways because of this kind of news flow that has come in. And because the valuations are already quite premium compared to the entire sector. One more worry for me on the pharma pack is the fact that, Trump yesterday made announcements that, he would like all pharmaceutical products to be manufactured in onshoring. So there could be a little bit of sideways movement on this entire sector, especially the companies which have got a huge exposure to the US markets. So until this, you never know what Trump is up to. And obviously he's bargaining from a position of strength. So given all these facts, I think that the pharma pack will underperform. And rightly so, given the fact that, over the last few quarters, it has been an outperformer while the market has tanked. So don't expect too much on this stock from the current levels, especially given the headwinds because of what kind of negotiations happen regarding, onshoring of manufacturing facilities.
Very interesting take, because this is not a take we've heard in the last couple of days from anyone. In fact, we've only heard positive views with regard to Divi's. But what I have to do is I have to slip into a break. We're going to take views from Kush as well, because I want a technical take on this one, both Kush and Rajesh. But we'll get that on the other side of this very short break. Stay tuned.
When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed. It is our job to bring you news that truly matters. At Profit 360, we cut through the clutter, the long street deals, finance and policy news that could shape your tomorrow. The newsmakers, the trendsetters, and the innovators. In 30 minutes, we've got you covered. So stay ahead, stay informed, and stay profitable with Profit 360.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed. It is our job to bring you news that truly matters. At Profit 360, we cut through the clutter. The long street deals, finance and policy news that could shape your tomorrow. The newsmakers, the trendsetters, and the innovators. In 30 minutes, we've got you covered. So stay ahead, stay informed, and stay profitable with Profit 360.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed. It is our job to bring you news that truly matters. At Profit 360, we cut through the clutter. The long street deals, finance and policy news that could shape your tomorrow. The newsmakers, the trendsetters, and the innovators. In 30 minutes, we've got you covered. So stay ahead, stay informed, and stay profitable with Profit 360.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed. It is our job to bring you news that truly matters. At Profit 360, we cut through the clutter. The long street deals, finance and policy news.
The party seems to have started, even if we don't know why. It looks like we're all invited. I'm talking about what's been happening in the markets this afternoon. 24825, the Nifty now above the 24,800 mark. You're watching India market close, and it's been an astonishing recovery in these markets. Are we celebrating a possible 25 basis point rate cut? There is a brokerage house today which says that maybe the RBI will step in and cut rates. Tough to say, but could be a reason why the Bank Nifty is over 500 points up. Let's pull up the intraday chart of the Nifty first before we get into the details, because yes, this is a banking story, this is an IT story, and this is why you're seeing that kind of a boom. The sharp rise near the day's highs right now, close to the day's highs, above the 24,800 mark on the Nifty. Truly astonishing. This is the bottom of that cliff, and look at how markets have roared through the morning. We should pull up the Bank Nifty as well and look at where that trajectory goes, again near the highs of the day. A cursory look at the heat map will explain what really is going on, and then we'll see if this is happening to the broader markets as well. Pretty much a sea of green with a few exceptions there. One IndusInd Bank and an SBI Life there. Bajaj Auto hurting because of a UBS note to which they responded, saying no, we haven't cut prices of our freedom, etc., but that's still hurting. Look at the top line, and it's all about tech. I mean, is this the second Trump, party or excitement that we're seeing? Perhaps 3% up on Infosys, TCS, all the big boys leading the pack. Wipro, they're doing excellent as well today. HCL Tech, all of it. Interesting to see HUL up there this afternoon, joining the party. M&M doing pretty well as well. But if you look at the Nifty contributors and see where that strength is coming from, even an RIL about 1.5%, it's HDFC also contributing rock solid. So look at the top four, the big names really coming in. Some red over here, but not too worrisome. I would say SBI Life, HDFC Life, etc. was expected a lot of regulatory issues right now in this entire space. I want to pull up the advanced decline ratios for you for just a second and give you a sense of what's happening there. It's been a war between the bulls and the bears, quite a tussle right now, the bulls on top. So if you look at the broader markets, it's not like there is celebration all round. The bulls still itching to move forward. So let's pull up the mid cap and the small cap indices while we are at it. And yeah, the Nifty mid cap not doing badly, but nowhere close to the kind of roar that you're hearing from the Sensex right now and the Nifty. 0.5% up on the small cap 250 as well. Quick look at the top gainers and losers before we take a snapshot of how Europe seems to have opened, and then of course we'll come to the details of the day. Angel One, there's a rebrand, there's a mutual fund foray, a lot happening there, 6.5% up. Granules, the recovery after the kind of clarification they've given is fairly impressive, and of course quite a few names there as well. On the downside, Vodafone is, I think, beaten up today after selling some of their stake, the 3% stake they have in Indus Towers. Street hasn't taken to it too well, and Divi's Lab also seeing pain continuing. Quick look at European markets before we move with the rest of the show, and just to get a sense if this is now cheer across the board. And yes, seems like green there, enough green there, despite everything that's happening in France, doesn't seem to have hit too much, at least today. Neeraj also joining in now. Neeraj, Harsh, we're setting up for a full house and an exciting afternoon.
Yeah, an exciting afternoon for sure, Tamanna and Harsh. Good afternoon to both of you. It's interesting that it is not that you would have anticipated that if there is a pre-policy rally, then all kind of banks will participate. PSU banks are not necessarily participating today as well. Nifty Bank is 1.1% at the high point of the day and taking the markets higher. But PSU banks are a bit quiet because they've had a bit of a rally in the last few days, and in today's session, absolutely flat. So IT is leading the charge higher, and whether it's the read-through from Salesforce or a couple of brokerage notes that have come in, but that gain in IT is really, really remarkable. But it's great because it's getting broadening out, because if you anticipated one index to spur the market and the market to crutch itself on one or prop itself on one leg, that isn't happening, which is actually a really good sign.
Yeah, absolutely. And the kind of comeback we've seen with regard to both banks, IT also slightly more tepid midway through the day today. But the bounce back, 2.5% up on IT now, Neeraj. And banks as well have really come to the party. 1.1%. We're at the day's high, both where banks and IT are concerned. And when those twin engines work, generally, you will see markets, especially the benchmark, go up. Tamanna.
So markets are looking exciting. What do you do next? Vineet Bolinchkar, Rajesh Palvia, Kush Bora with us this afternoon, and I'm sure you've already done your index check, but let me reiterate, and Rajesh, I'll start with you. 24,800 has been crossed decisively. Markets at days highs right now. What next from here? Are you seeing a further up move? Would you have a long position? What would you do next?
So definitely we will carry our long position, Tamanna, and I think the next target immediately we can see towards 25,000 level. The way buying interest has emerged in the market in today's session, especially shorts are already squeezed, and short covering action take out Nifty about 25,800, 24,800. I think this really can extend further, and maybe in today or by tomorrow we can see a level of 25,000 level also. Now trailing off stop loss towards 24,650 would be the strategy at this juncture to hold the long position for Nifty. And for Bank Nifty, I think we are almost preparing for new all-time high trajectory for Bank Nifty. And we believe, I think if the expectation which is already there on the street for rate cut, if that happen, I think possibly we may see a new all-time high for Bank Nifty also tomorrow itself. So both indices are looking bullish. One can carry their long position as broader market is clearly giving a sign that, again, this is the renewed buying interest or, fresh energy, which is already playing out in this market. And I think this really can extend further.
Extend further, long on the Nifty, says Rajesh Palvia. We've got Abhay Agarwal with us as well, Managing Director at Piper Serica Advisors. And Abhay, let me come quickly to you and ask you what you are seeing as a mood changer since this afternoon in the market. Curious to know your views. Is the street now seriously expecting a 25 basis points from Governor Das tomorrow? And then what if that doesn't happen?
No, hi, Tamanna. I think clearly mood has, I think when we opened in the morning and last couple of days and this week, in fact, we saw sharp outperformance by small and mid-cap indices over the large-cap index. And I think what we are seeing today is probably a catch-up to that. And it looks like some kind of a basket buying, because this kind of sharp moves across the board comes when there is a basket buying by a large institutional investor, probably a foreign investor. So I think some of it is reversal of FPI flows, money coming back, people who were underweight on the market compared to the benchmarks, increasing their weight, portfolio weight. Secondly, I think there is a strong expectation now that there will be a 25 basis rate cut, in fact, more possible, and a guidance also from RBI that they would do whatever they need to do to make sure that economic growth comes back to its normal trajectory. So I think that is what is keeping the investors, excited and adding to their positions right now.
Abhay, good afternoon. So I know that you were almost nearly fully invested, and therefore you must be happy with the moves. But if the RBI and the MPC sounds dovish, as you said that there might be happening, whether or not they cut the policy, maybe they just do a CRR cut and then sound dovish, is that good enough for investors to stay heavily long Indian markets, or do valuations still remain a concern?
No, I think on the valuation side, I don't think we are in the aggressively overpriced zone, Neeraj. So I don't think the first worry is really about valuation. It is more to do with growth and, is there a structural problem with our growth or a cyclical problem? So if RBI comes and convincingly says that, look, yeah, we will do whatever we need to do to make sure that, the growth comes back, even if it means the deficit goes up slightly, I think that will be a good message for the market to hear. And that will also put the ball back in the court of the government, especially the finance ministry, when they meet for the GST committee meeting on December 21st, to focus on driving consumption by reducing taxes of all kinds and putting more money back in the pockets of the consumers, so that the consumption-led demand comes back. So I think once RBI is done, everybody will wait then to hear from the government, especially the GST committee meet on 21st, to see further support to growth from the government.
Okay, so the way I see it, the positives are now being priced in as we speak. The possible negatives could be if there is perhaps a not so rosy commentary from Governor Das, if there is no sign of a rate cut, a CRR tweak or anything in sight, maybe that could be. And if any of those slightly frightening predictions on GST or those reports on GST come true, so then those could be the possible, clouds on the horizon. But on the other side, Abhay, what do you think is working, and is this going to be a bank IT-led story, or are you seeing the mid-caps participating at some point?
Yeah, I think on the bank and IT, we will definitely see some new highs being made, because both these sectors, especially banks, have underperformed. So I will not be surprised if value buyers start seeing opportunity there and some money comes back. But I think in a country like India, it's a growth market. The whole country is a growth market, and that's where you need to have the mid caps and small caps adequately represented in your portfolio, because those are the ones which will give you multi-baggers. The Infosys, TCS, HDFC banks, they will give you returns, but they will not give you the multi-bagger returns over the next 5 years that small caps and mid caps, astutely picked mid caps especially, will give you. So I think over a longer horizon, definitely the mid cap and small caps will continue to outperform the large caps in a market like India.
Okay. Thank you so much for that, Abhay Agarwal. That the mid caps will continue to outperform the large caps, but today is all about the large caps, because what we're seeing in the markets today is just phenomenal. Kush, What's the Nifty strategy right now? The Nifty and the Bank Nifty strategy?
Continue to hold your long positions for levels of 25,000, 24,800 is there. I am very strongly holding myself back from saying I told you so. I was hoping you would, but no, continue holding on for 25,000. Perhaps around those levels, you might see some profit booking on the Nifty. Bank Nifty, I completely agree with Rajesh. 53,500 was our first target. Now we're gunning for 54,400 and then some. The big smile. Are you finally going to say it?
Yeah, no, you said you were holding yourself from saying I told you so, but you couldn't. So then now tell us what next. What is the next target to which you can come back and say I told you so, or that one pick to which you can say I told you so?
So I'll hold this view for Nifty. 100 is the level that you play for in the near term. You might see some profit booking around this level because there is this medium-term congestion zone as well, plus a round figure, hovering, that always plays from an option perspective, if not a technical perspective. So I'll play for Nifty, but for targets of 100 for now. On the upside, I am more constructive on Bank Nifty. Have been for some time. That this break above 50 to 300 has given the much needed push, to this index. So if you want to go long, still the preferred index to go long is the Bank Nifty, which is ready and ripe for levels of 54,400. Once that is taken out, you're looking at the 55,000 as well. And now this 2-month long support resistance zone of 50 to 300 will start acting as the support. So that's your stop loss.
All right. Okay. So all eyes on the Nifty currently. Vineet, if I can come to you, one sector that you're most constructive on and that you would bet at this point of time from a medium to long term perspective?
Eyes closed. Because the big four daddies of the US markets are putting up data centers to the size of gigawatts. So you're going to see massive investments happen there, and there's going to be a $40 billion investment by just these large players over the next few years. So I think data center stocks are really going to do well. Black Box, Anant Raj, marine electricals, all these stocks are going to definitely do well.
Interesting one. We'll be with IT because that's the top performing sector in trade today. And positive commentary from tech majors, revival in banking could actually favor the IT sector overall. Rucha tells us why it might be a good time to actually start to see possible upgrades in IT and what that case is for those upgrades. Rucha.
Right, Harsh, thank you so much for talking about Nifty IT. And Nifty IT is up largely because Salesforce is up about 12% overnight because it upgraded the lower end of its guidance. Now, number one, this is a positive read-through for Indian IT. Now, remember that Accenture is also one of the international names that we track, and its outsourcing segment is also what we track. So that will be another thing to watch out for. But as you mentioned, what will be likely levers for an upgraded Nifty IT is number one, Trump presidency, largely positive for IT because of the lower tax rates that can support the margins. However, visa costs is what could be impacted. But a thing to note here is that many IT companies like Infosys, TCS and such majors have reduced their reliance on H-1B visa employees, so not much of an impact over here. Number two, Fed rate cut decisions to be watched out for because in case rate cuts happen sooner, this would allow clients to accommodate more IT spends and hence this could translate into revenue for the IT names. Number three, positive commentary by most of the IT majors in the second quarter is a big positive because these IT companies were largely talking about how the problem of deal wins conversion into revenue is now in the past. Number four is the banking segment, which is the biggest segment. The revenue from where most IT companies receive a majority of its revenue is now up in the green, seeing green shoots in the banking space. Most of the IT names had posted positive QOQ growth in the banking space in the second quarter, except for TCS, which largely posted a flat revenue growth. But yes, positive commentary from the management and clients accommodating IT spends because of higher room in budget is what is to be watched out for.
Okay. Thanks a lot for that, Rucha. Thanks for bringing in this. Now, Vineet, would there be, just taking Rucha's piece forward, right? Would there be a first amongst equals of companies which have a positive read-through out of what Salesforce has said, because the street was working with maybe a Persistent, maybe an LTI Mindtree amongst the ones which will actually be key beneficiaries of a trend like this? How have you read into it?
So I think, I would go more with the BFSI space looking good because there's a lot of recovery there. And most of the Indian players have got good exposures to BFSI. And, that was a kind of an underperformer in the portfolio. So we are seeing that come back by. And the name Persistent, LTTS, and all the standard names will definitely do well. There is no one particular stock which you can single out. All the majors, they have got good exposure to BFSI, and hence they would be doing really well.
Okay. Interesting. So the moves in some of those have been very spectacular. So that's to be watched. Those are to be watched out for as well. Yesterday the charts of, almost everybody was on the show, on the closing show, were speaking about. We talk about the good things. Let's also talk about what is not done well. Divis, for example, right? Down in trade today. Yesterday, almost everybody was bullish on Divi's Lab, saying that the stock is likely to go very high. Of course, there's a fundamental reason why this has happened. So Kush, my question to you is, because you were amongst those who were bullish, but not to blame here. It was just an unforeseen event which has come and hit the stock. My question is, it's seen buying from the lows of the day. What would you do if you were long in Divi's? Would you cut off your losses, or do you believe the bottom buying gives you confidence for more upsides?
Sure. So you're right, Neeraj. I was bullish on Divis. I continue to remain bullish on Divis. And if I didn't see the news today, whatever has happened, on the fundamental or the business front, I would still maintain this view. And the reason being that this stock is no stranger to seeing sharp volatility, or even perhaps dipping to the 50-day moving average, which it has done in I think about the last couple of months, about 4 or 5 times, and then reviving from there. Precisely is the move what you're seeing today. There was the sharp dip, came close to the 50-day moving average, and has recovered from there on. Now the momentum bit that is missing will perhaps come in once this double top of 6,300 is taken out. So yes, the buying that we saw from the lower levels is itself testament that there is fair degree of strength in this. I think whatever news has come to some degree has already been absorbed. Whatever little is perhaps should be done in a day or two's time. Fresh buying, I would suggest that hold up until 6,300 is taken out, because the stock might just consolidate. But to your question that if you have a position, what do? You continue holding on to this. A positional deep stop loss will be today's low, which is close to the 58.75, 58.50 mark, and continue to hold on to this one. Fresh momentum above 6,300.
All right. And Vineet, let me come to you. You're not positive with regard to Divis. At what price would you start to get constructive or positive?
So, I would wait out for the event to play out, actually, on what Trump would like to do. As I told you, that the pharma sector has really played out quite nicely over the last few quarters. And while the major market has started playing up, I think the pharma stocks will kind of, being a defensive play, would underperform the market. And with this event, as I told you, where they would be negotiating and possibly finalization once he comes to power. So for me, for another month, I would not be overweight on Nifty Pharma. So I would not like to wager on where I would like to buy this stock at what levels.
Divis in focus, fine, but looking at the entire pharma pack, and we'll come to Aurobindo as well in a bit. Positive news for Aurobindo Pharma. Divis down 3%. I'm talking about Oro Pharma, which has had some good news, no big reaction though right now. Rajesh, I'm wondering if you're looking at either of these or anything in the pharma pack, or there's too much else that is exciting which has caught your attention.
No, definitely from pharma space, I think Aurobindo Pharma, after correction now, it's consolidating in very tight range. On the higher side, 1300 is the steep resistance for the stock. Once the stock crosses those levels, then yes, there could be really further towards 1400 to 1450. On the downside, the immediate support is now placed at around 1180 kind of level. So that level needs to watch. But as of now, for Aurobindo Pharma, structure is weak. But on the pharma space, I think Lupin can be looked at. After the correction, now stock is managing to give breakout of its falling channel on daily chart. And the way the breakout has happened and now stock is holding about 20-day moving average, we believe that Lupin can extend its gain from this space and possible upside towards 2200 to 2250 we could see in near-term perspective. So Lupin can be looked at with stop loss of 2070.
Okay, so Lupin or with a stop loss of 2070 is what Rajesh is doing. But why is Aurobindo Pharma in focus? It's got a US FDA node for the acquisition of the Pazopanib tablet. Varsha joins us to tell us why this is important. Varsha?
Yes, Tamanna. So its subsidiary company Eugia Pharma Specialties has got an approval for the cancer product. Now they're going to manufacture Papofenib, which is a cancer product, 200 mg. Now this is equivalent to or similar to the drug which is being manufactured by Novartis Pharmaceuticals. Now this product is expected to be launched in Q4 FY24 and it has an estimated market size of around $106 million as of October 2024. Now, as per the Aurobindo, now this is the 179th ANDA approval that the company has got, and just on the numbers, how H2 will pan out for the company. So they are confident on maintaining growth momentum, and they are expecting H2 FY25 to be better. Now, this on the back of scaling up of their Eugia 3 facility to normal level, which had a problems in the recent past. Now they're expecting Q3 and Q4 to be better when it comes to generic injectables, which was not good in Q2, and their R&D cost is likely to be in an uptrend way for the next few quarters.
Okay. So while we talked a fair bit about pharma, I think another stock that we want to focus on, another space is capital markets. Look at what's happening with BSE today. In fact, let's pull up BSE, Angel One, CDSL, all of it on a roar, and this is not just a coincidence at all. In fact, Neeraj highlighted this. Neeraj, very interesting note from IIFL that all the fears when the F&O provisions came into place from the 20th of November, some of them at least seem unfounded.
Yeah, so I mean, it's an observation that they have made, so full credit to them, that the volume trajectory continues to remain better than what was anticipated or feared. You could even call it feared. They've used the term expected, of course. The initial numbers are showing minimum impact on premium turnover. There's a sharp increase in premium ratios, which has resulted in a decline in notional turnover. Now, viewers, remember, notional turnover is the total value of the trade, but it's actually not the premium increase or the increase in the premiums that the exchanges get. What exchanges are interested in is that a notional turnover be lower, if it may be, but premium turnover is higher. And that is exactly what's happened actually, because the lower notional turnover, there is lower notional turnover, which would imply better margins for exchanges. The notional turnover for BSE is up about 133% week on week, but the premium turnover is up 183% week on week. So there is clearly maybe, or this arguably could be one of the reasons why these stocks are so active in today's session, because as Tamanna said, it's not just BSE, by the way, which is up 11%, but a clutch of other capital market plays which are doing this. Now, Vineet Bolinjkar, you track this space closely, I'm sure. Is this, or could this be one of the key reasons why such activity in the capital marketplace, including Bombay Stock Exchange stock?
Can you come again? I missed
the volume trajectory, Vineet. Apparently, the volume trajectory has not been as bad as it was feared. And in fact, the notional turnover may be even lower, but premium turnover is very high week on week.
For the BSE, right?
Yes, for market-wide per se.
Yeah. So, if you look at BSE as a stock, what differentiated BSE from the NSE was the fact that, they did not have a very vibrant F&O market. And with BSE launching futures, and if you see the way after Bank Nifty has gone, out from weekly settlement, the way BSE garners volumes and the volatility that is there, I'm expecting BSE futures on the Sensex to become the proxy play for the Bank Nifty, for the ones with the extra adrenaline. And that is going to contribute to increasing volumes on BSE. And if you see the market share of the two players, I think it is widely skewed in favor of NSE. And because of that, I expect the BSE volume to pick up. And hence, we continue to remain positive on BSE for that.
Okay, Rajesh, view on BSE, and let me add a few of the other players, 361 WAM, Angel 1 doing well, MOSL, but I mean, of course, not the kind of move that you see on an exchange, because this is about essentially appetite not going down despite an increase in lot size, premium, etc., no big difference, enough appetite over there. But any of these you like, and view on the BSE stock?
So definitely BSE, CDSL and Angel One, all three stocks we like at this juncture. All three stocks are having a very strong bullish structure on a weekly as well as on the monthly chart. And we believe that, BSE can extend further gain. The way stock has shown buying interest with volume, I think there is a possibility that, stock can extend its gain. Again, it's a new entrant in F&O also. So a lot of new participation in the derivative also in this counter. So BSE could be a stock where 5400 to 5500 would be the next target. At this moment, one can hold position with 4950 as a stop loss. Even Angel One, after a correction, now stock has found a base. And looking at the daily, weekly time frame, we believe that if stocks continues to hold above 3120 level, there is a possibility that here also rally can extend to 3400 to 3450 on a positional perspective. So BSE, Angel One, CDSL, all three stocks are looking good. So I think one can hold on and carry the long position in all these three counters.
Now, meanwhile, while we're all celebrating great premium turnover, etc., look at what's happened to the markets. Pull up the intraday of the Nifty, and actually, the chart is not giving you the full picture. It's quite a sharp fall that has come in. Nifty just 56 points up. I mean, 24,800, 24,600, all of it has evaporated in just a few minutes, 346 points down. I mean, I wonder if there's any fundamental reason for this happening so sharply or not. But I don't know. This is looking like a bit of a rocky market. Any comments, Kush? Because we were talking about 25,100 10 minutes ago. Is the picture changing for you?
Not at all. This is an expiry play. We've got a lot of other weekly expiries that have been squashed, and Nifty remains. So it's just that the premiums were elevated, and you've just crushed those premiums. Market has made a habit of building on open interest at certain strikes, making it appear that those levels may not be crossed. In the morning it was 24,500, 600, and 24,800 as well, for that matter, on the call side. Those writers were taken to cleaners for a while. Then on the downside, it was 24,500 put option. Now it's the turn of the put option writers to perhaps bear some brunt of the market fall. Not at all concerned about the kind of sharp downtick that we are seeing today. The broad view still remains 24,800 perhaps now will act as the first target, and then 25,000.
Kush, the target has been revised down a fair bit from 25,100 to 24,800. But okay.
I would say the target has been reiterated, because now you've got a fresh shot at it. So if you don't have a long position, you could create one with a stop loss of 24,300 or targets of 24,800 and 25,000.
Okay, we'll take a very short break. But Vineet, I want to thank you for joining us on this leg of the show. On the other side, we continue the conversation. Is this expiry jitters that we're seeing? How should you prep yourself for what's going to be an important day tomorrow? We have Gurmeet Chadda joining us as well. All of that after this break.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
When the whole day passes like a blur, the news